Well, sir, our next topic would be derivatives. The exam point of view, weightage obviously quite important. Conceptually also important. There are number of questions are also very huge, and there are a lot of models in this. But conceptually, if you understand, there are few selected questions, sir. Those questions, if you are able to solve and master, almost all the questions flavor will be covered in that. Any question in the exam, you'll be able to handle it. Only thing is, this comes with a little bit of theoretical stuff. I mean, that conceptual level, that if you understand correctly, sums will not trouble you. Questions, it is not like leasing question where you have to solve so many calculations. That kind of scenario will not be there. It's all in the concept. How neatly you understand the concept, that much easy the questions will be. No size, no, you can randomly pick up any question in these two chapters, futures, options, and derivatives questions. None of the questions will exceed one side of a page. The answer will be very small and cute, but concept is very high. So anyway, so derivative definition officially is, it is a financial contract or instrument which derives its value from the value of an underlying. That means he's saying that a derivative is basically a contract, and this contract ka value is dependent on something else. That something else is called as underlying. Now, if this underlying ka value fluctuates, a derivative ka value also fluctuates, because your contract ka value is dependent on something else. Sir, who is that something else? That something else can be, it can be share of a company, it can be a commodity like gold, silver, onion, soya bean, wheat. This can be taken as the base. It can be currency, dollar, pound, euro, yen. Then it can be index. It can be interest rates. Now, if you observe, among all the 5 underlyings, whatever I have written, one commonality is there. What is that commonality? They all are going to fluctuate. They all are going to fluctuate. You take anything, sir, share ka market price will fluctuate, commodity ka prices, gold prices, silver prices, copper prices will fluctuate, currency values change, index points, nifty sensex points, they will fluctuate, interest rates fluctuate. And when these things fluctuate, your contract either you will be having a gain or you will be having a loss. Your derivative ka gain or loss is linked to the fluctuation in the value of something which is called as underlying asset. Since your contract is taking shape based on the number of that particular variable, this contract is called as a derivative contract. Now, if I want to enter into a derivative contract, how should I enter? There are two places where you can enter into derivative contract. One, you can enter into a derivative contract on the stock exchange. These are called as exchange traded derivatives. Or you can enter into derivative contracts by constructing a derivative contract directly with the opposite party. This is called as over the counter derivative contract. Now, in exchange traded derivatives, sir, see, when you have to enter into a contract, at least how many parties are required? 2 parties are required. So there is this fellow, this guy. These two fellows want to enter into derivative contract. But if they want to enter into derivative contract through stock exchange, in between them, exchange is standing there. Exchange is standing in between. That means the parties do not know each other. He will think he is doing something in the exchange. He will also doing transaction in the exchange. Of course, they both know that opposite side somebody else is there, but that somebody else is who, his name, Insta ID and all, we will not know. So this will be purely, exchange is acting as a middleman. Okay. So whereas over the counter, sir, the parties trade directly. The transaction happen directly there. Here you know who is your opposite party, what is mode of settlement, everything you people will decide. Here terms and conditions are decided by the parties themselves. Decided by parties. Here terms and conditions are set by stock exchange. So here parties know each other. In over-the-counter contract, in exchange contracts, parties do not know each other. That's the main difference. Now, exchange-traded derivatives are only two. Either it will be option contract or it will be futures contract. Now, exchange-traded derivatives is over, only two. Now, coming to over-the-counter contracts, you have here multiple, because if you private contracts, people can create different type of contracts like they want. In that, most popular contract which every one of us know is forward contract. Whatever forward contract we studied in forex chapter, that is a classic example of a derivative. Imagine, sir, I enter into a contract with the bank to buy $1,000 after 3 months at the rate of $1 is equal to 85 rupees. That means I already locked the price of buying dollar at what rate? 85. Now, if I am agreeing to pay 85 rupees for $1 today only, means contract is entered today only to buy dollar on a future date, I have done this with some anticipation in my mind. What is that anticipation? In future, dollar rate may increase. That's the reason I agreed to lock the buying price of the dollar at what rate? 85. But what if dollar price did not increase? It has fallen down. In that case, I'll feel bad for this entering into this contract. There is a loss on entering into forward contract. Similarly, you may ask again also, whatever you thought might be true, you thought that dollar rate will become 90, you entered into a contract to buy dollar at 85 only. Eventually, dollar turned out to be 105. When everybody is buying dollar at 105, you nicely can buy only at 85. You are in a happy position. That means whether you are gaining or losing is dependent on what now? Exchange rate of dollar. That means your contract value is clearly dependent on dollar rate. So a forward contract is also a derivative. Only thing is, a forward contract we just study in a different chapter. That's all. But that forward contract is a derivative only. There is no difference at all. Next. Another example for this is interest rate swaps, which we'll study in a different chapter altogether called as interest rate risk management. In that, we'll study a small concept called as interest rate swap, easy only. Then there is something else called as currency swap. Then there is something called as forward rate agreements, interest rate cap, floor, collar, swaption. These are all various examples. Now, presently, what we will do is, we will cover exchange traded derivatives ka understanding. That means how options contract, how futures contract traded on stock exchange will work, how to price them, how to value them. If you enter into that, what will be your gain, what will be your loss, e kind of stories we will study first. This, if you know this one, your base is set for this learning these swaps and all, but that we'll have to do it in a separate chapter. Why you are doing it in separate chapter is, always, sir, interest rate derivatives are packaged separately. You take any book, local book to international book, it will be packaged separately only, even in your study material. Because things what impact the gain or loss here and things what impact the gain or loss here are slightly different. That's the reason those questions are kept separately. Anyway, let's first talk about exchange traded derivatives. In that also, first we'll start with options, because conceptually options is heavy. Compared to futures, options is conceptually very high. But questions wise, very simple. Option ka questions are all extremely simple, extremely easy, provided your concept is good. Futures, sir, concept is very small. Just one side of a page, maximum 2 sides. That much only concept. But questions, there is no limit. Number of questions, lot of applications is there in futures. So each particular contract has got its own advantage. It's difficult to get into, but once you understand, sums are easy. Are easy to understand, sums are difficult. So somehow you have to balance both. Anyway, let's come to options contract. So in a typical option contract, there are two parties here also. One party is called as holder of the option. Another party is called as writer of the option. Now, this fellow who we are calling him as holder, this holder fellow will have a right. A writer guy obviously will have a obligation. If one fellow is having a right, another fellow obviously will have a obligation. Sir, what right he is having, what obligation he is having, that we will see in the next level discussion. Time being, just understand that There are two parties who are entering into a contract. One fellow is clearly having a right, another fellow is having a obligation. Now, if this kind of contract is there, why will this guy first of all enter into this contract where he is giving right to somebody and he is accepting a obligated position that he will do? Because this holder fellow, sir, on very day one pays some consideration to the writer. That consideration is called as option premium. You must also understand the option premium only also called as value of the option. Because I pay premium to the other person only, that other person gave me a right and he accepted a obligation. Indirectly, from writer point of view, if you think, writer accepted money and sold the right to you. That is the reason this fellow is also called as seller of option. This fellow, the holder, he is called as buyer of. Very confusing things when we go inside, sir, but have a clarity right now only. Holder is called as buyer. Writer is called as seller, not of share of the option contract. The option contract, two parties, one buyer, one seller. Holder only called as buyer of the option. Writer only is called as seller of the option. As such, we don't use these words buyer seller frequently, sir. We will stick to holder writer only. But if suddenly any question uses the word I sold an option, at the time suddenly you should not blink. If you sold an option means you are a writer. Don't think that I'm selling share and all. Selling an option is different. Selling share is different. Have a clarity there. So till here basics, sir. Now that parties are over, now let's next discussion types of options. So we have two type of options. One type of option is called as call option. The other one is referred as a put option. Now, in the call option, again, like how we have discussed, we have a holder, we have a writer position here also. Similarly, in put option also, we will have a holder of put option and a writer of a put option. Now, you have to understand this point very clearly. If you are a holder of call option, a holder of call option will have right to buy. So right to buy what? A contract, whatever asset is written, that asset. That can be share, that can be currency, that can be commodity, that can be index, that can be anything. Right to buy underlying asset at, like how forward contract forward rate is predetermined price, like that options contract we call it as exercise price or also called as a strike price. Since it's also called as exercise price, it is denoted by capital X usually on a future date. So at a later date, call option holder is having a right to buy. Now if you come to put option holder, he will also have right only, because holder will always have right. But only thing is this time it is not right to buy, this is right to sell the underlying asset at predetermined strike price at a future date. So from this you must understand that holder of call option is having right to buy, holder of put option is having right to sell. Now, sir, why are you not talking about writer? Writer also we will talk, but there is nothing much to think now. It is easy. If holder is having right to buy, then writer will have, ideally it should be right to sell, but he is not having right to sell. He will have obligation to sell, because you accepted money. You can't get a right now. You will have a obligation. So this fellow will definitely have a obligation to sell the underlying asset. At what rate? At strike price. If holder exercises the call option, you cannot enforce your right to sell. You don't have a right to sell. In fact, if the other party wants to buy, then you have to sell. You cannot say that I want to sell, come and buy. You don't have a right to sell. You only have a obligation to sell. This is about writer of call option. Coming to writer of put option, go to holder of put option is having what? Right to sell. So this fellow will have obligation to buy. He'll have obligation to buy the underlying asset at strike price. Of course, only if the holder exercises the put option. If you exercise the put option, then only that fellow will have it. So your remembering point of view, sir, remember this one. Holder point of view, you remember both cases. Writer automatically it will be the opposite position. Okay. Now, carefully see. Call option holder is having right to buy. Put option holder is having right to sell. He right to buy, right to sell is on what? On the at price is strike price, but what on the underlying asset? That underlying asset usually in this chapter will be share. Sometimes index also will be there. Commodity related options are reality low there, sir. Questions we will not find. Commodity futures you will find lot of them. Anyway, just because here right to sell is there, don't call him as seller of the option. That's a mistake people do. He is having right to sell, not option. Right to sell share, the underlying asset. But he right, how did he get? By paying money he got. That's why this holder is always called as buyer of the option. Even before I telling you call put, I already called him as what? Buyer of the option. Writer always is called as seller of the option. So where students get confused is buying, selling share in the option, right obligation. Are they different? Are the underlying asset? Option paper contract. Option paper is a contract. A contract you are a buyer or seller is different thing. So holder always is the buyer of option. Writer always is a seller of option. Because you bought the option only, you are having either a right to buy or a right to sell the underlying asset, depending on whether it is a call option or put option. Share level your rights obligations are different. Option paper ka buyer seller are different. Okay, right. So this is about basic meaning, sir. Now, for understanding call option, suppose we take a call option on Reliance Industries share. So RIL share is our underlying asset. Strike price, let's say 2,500. The scene is not there, but anyway, 2,000. Maturity 3 months. So this is your call option, sir. If this option is there, obviously there is a holder also, there is a writer also. There is one fellow who is holder, other fellow who is writer. Now, at 3 months time, your future spot rate, spot price of RIL share, one price I am taking above strike price, let's say 2,600. Spot price of share, another case I am taking below strike price, let's say 1,600. Two scenarios we are showing. Now, between the two parties, only one fellow is having a right. One fellow does not have a right. He will have only obligation. Now, since it's a call option, holder of the call option will have what right? Right to buy. At what rate? 2,000 rupees has a right to buy. Market rate is how much? 2,600. So, buying the share under call option is advisable or beneficial for him. So, action of the holder only is relevant for you. And when market share is trading at 2,600, I have a right to buy the share only at 2,000 rupees. So, since the spot price is greater than strike price, this fellow will exercise the call option. Now that he is exercising the call option, how much benefit he is visualizing that 2,600 ka share, he is able to buy only at 2,000. Our benefit is called as payoff. Formula for that is SP minus X, 2,600 minus 2,000. Which is equal to 600. Now, this fellow is holder, this fellow is writer. One fellow is happy, another fellow is sad because market share is 2600, but I have a right to buy only at 2000. I am exercising the option, therefore cheaply I am buying the share. Very clearly holder is happy. But think from writer's angle, share whose worth is 2600, he is now forced to sell only at 2000 rupees. Definitely writer is not happy, he is sad. Third point. Next question is settlement. Now, a call option contract, settlement means closure. How this call option contract will be closed? Now, in reality, overall two possibilities are there. One is called as physical delivery, which is called as gross settlement. When you do gross settlement, sir, whatever you wrote in the paper, literally you have to execute it. That means I agreed to buy share. Okay, buy. He will sell. And you agree to pay how much? 2000. This fellow is smiling, this fellow is sad. You are buying share of 2600 by paying only 2000, therefore you are happy. For him it is opposite, he is sad. This is called as physical delivery. Literally share cut delivery will happen. Next one, either this. The other one is called as net cash settlement. Net cash settlement, what will happen? There is no share, nothing. Simply losing party will pay money to the gaining party. So, what is the amount of pay of 600 rupees? 600 rupees we deliver. Is sad. Sir, should I do physical delivery or net cash settlement? In our questions, listen carefully. In reality, position is different. Exam point of view, position is different. Exam point of view, sir, all the sums by default are based on this one. In exam point of view, by default, everywhere they do net cash settlement. But in reality, sir, if you take any call option on put option on underlying asset share, compulsorily you have to take physical delivery if you stay till the maturity date. In fact, if tomorrow is the maturity date, today the broker will ask me, alright, do you want to intend to take physical delivery? Yes, sir, I want physical delivery. Then bring the money into the account first. Because if you say I will buy and ultimately you don't have money to buy, the other fellow will be making the shares ready for delivery, no sir. So in reality situation is different. But in books point of view, exams point of view, sir, everything will happen or presented as if there is only net cash settlement. Now, sir, but this is reality. Why are they doing this? Listen, whether they do this or you do this, your face of feeling is changing. Huh? Since still gain or loss is same, no sir. The party who has to gain will gain, the party who has to lose will lose. So how they are losing, effectively if you see, that is not changing. So this does not have any impact on your options ka valuation and all. That's the reason nobody bothers about how options are settled in exam point of view, even though reality is different. Now example, here underlying asset is what? Reliance Industries share. That fellow gave me delivery of Reliance Industries share, I took it. What if the underlying asset is not share, underlying asset is interest rate? How will I take delivery? Interest rate ka delivery will give. I don't have a choice now. I have to anyway do with net cash settlement even in real life also. Why to go till interest rate? Imagine underlying asset is Nifty. I have a call option on Nifty for 23,000 rupees. Okay, I exercised. I have a right to buy. I exercised. Come, get delivered Nifty to me. How will you give Nifty to me? Nifty is not share. Infosys is a share. Reliance is a share. Nifty is not a share. How can you deliver it to me? You can't. Then what will happen? This will happen. So in reality, this also happens. This also happens. Exam point of view, only this will happen. So this is about when option is exercised. Now, I have a right to buy at 2000, but market rate is 1600 only. So here spot price is less than strike price. So this fellow will lapse the call option. Sir, if you lapse the call option, what is the benefit you are getting because of call option? Means nil. You are not getting any benefit because of call option. Sir, I am buying cheap. No sir. Array sir, buying at the market at 1600, you could have done even without call option also, no. So with the call option, how much benefit did you get? Means nothing, no benefit. So in this case, sir, he is sad, he is happy. So holder is happy, sir, holder is sad, and writer is happy. Because holder is sad because he paid what? Premium, but option did not materialize ultimately. So my money, whatever I paid, that went loss for me. And for writer, obviously that is a free gain. Now that option A not exercised, there is no settlement also. So how will you settle, and a question A will not come because option A is lapsed prima facie. Okay, so this is regarding call option. Now same story, you help me for put option, then we'll write summaries for all this. Put option, underlying asset Infosys share, exercise price 1600, maturity let's say 2 months. So spot price at 2 months, let's say is 2200. Spot price at 2 months is 1200. First one, sir. Action of the holder. Put option, sir. Put option means holder is having what? Right to sell. At what rate? Right to sell what? Infosys share. At what rate? 1600. I have to right to sell something at 1600 after 2 months. But after 2 months, actual market price is 2200. When market like can sell it at 2200, will I go and sell the same share under put option 1600? No. In this case, I will lapse it. So I will say the spot price is higher than the strike price. So put is lapsed. Now that put is lapsed, if you come and ask me, sir, what is the benefit you got because of put option? I'm very angry now. Zero. Now coming to settlement. Option A lapsed. What settlement? No settlement. So come to the other case. Market rate of the share is 1200. If I want, I can sell the share in the market also at 1200. But under put option, I have a right to sell it at 1600. Obviously, selling it under put option is beneficial for me. We will exercise. So this is that case where spot price is less than the strike price, or strike price is more than the spot price. Therefore, put is exercised. Now that put is exercised, definitely benefit is there, because benefit is there only exercised in the first place. No. So a payoff ka formula for put option is x minus spot price. So x 1600 minus 1200. So the benefit I'm enjoying is 400. This is your payoff. So the settlement, how will it happen? Again, two possibilities. One, either we can do a physical delivery or net cash settlement. When you go for a physical delivery, you are a holder, that fellow is a writer. You had a right to sell and you're exercising that. So sell Infosys share to that fellow and he will give you an amount of 1600. You are extremely happy, that fellow is sad. Because our share ka market value is only 1200. But that fellow purchased the share from you at 1600. He paid 400 rupees more to you. Second choice you have is, or second possibility that can be there is net cash settlement. When you do net cash settlement, e share and all business will not be there. Outrightly cash settlement. So I win, you lost. Pay me 400. That's it. So the same story, sir. Net cash settlement or physical delivery is there here also, here also. Now, when you take call option, sir, on the maturity date, only two things are possible. Either market price will be above strike price or below strike price. Put option also same thing. Above strike price, below strike price. Can't market price be exactly equal to strike price? It can be. Coincidentally, they both can be same also. Imagine, sir, when they both can be same, payoff will be how much? 0. Because your payoff is either x minus spot price in put option or call option SP minus x. Any which way, payoff will be 0. When payoff is 0, it's as good as option is lapsed only. Okay, so if I should summarize this, spot price greater than strike price, spot price less than strike price. Call option, put option. So whatever we have just now discussed, call option, when will it be exercised, sir? When market price is higher than the strike price. Spot price should be more than strike price, then only we will exercise. Put option will be exercised when market price is less than strike price. How to easily remember is, rising market, call will be exercised. Falling market, put will be exercised. Remember like this. This also you can remember. You can take an example and keep in your mind many ways. But easy, sir. Rising market, call option will be exercised. Falling market, put will be exercised. In the remaining two scenarios, calls and put will be lapsed. Now tell me, sir, if at all option is lapsed, then payoff is equal to 0. But if option is exercised, then definitely you will have payoff. Now a payoff, how to calculate? Just now we have done. That depends on, see, payoff ka easy thinking is, ignore the formula for a moment. How much benefit you are getting, that is called as payoff. But as such, formula also helps you later on. So we should know the formula. So if it is a call option, if it is a put option, if it is a call option, payoff is equal to spot price minus strike price. Because 2600 ka share you are buying only at 2600 rupees. Positive answer if you have to come, you have to get SP minus X only you have to do. Similarly, for a put option, payoff is equal to X minus spot price. So I have a right to sell at 2000, market list is, I have a right to sell at 1600, market rate is 1200, then only 400 will come, X minus spot price. So this is about payoff. Now, you tell me, payoff is inflow na outflow na? Think correctly and answer. Payoff is inflow na outflow na? If you are saying inflow, then that means you are assuming yourself as a holder. Then you are right. But for a writer, it is a outflow. So payoff is good thing, bad thing, depends on who you are. If you are holder, then payoff is good. If you are a writer, payoff is bad. Because payoff is there means option is getting exercised. So, and what about premium? Inflow, outflow. Premium is outflow for the holder and inflow for the writer. So, when I calculate net gain or loss to the holder, what's the benefit holder can get is payoff. Payoff he will receive. But he paid a cost called as premium. Premium paid. Similarly, net gain or loss to the writer, for him the income is premium. Premium received minus the payoff what he has paid. This is net gain or loss ka formula. E basic level questions also are getting tested in the exam, sir. Last 1-2 exams, if you see, they gave you that you took a call option or a put option, strike price is something, premium is something. On the maturity date, 5 possible prices are there. Get me net gain or loss. Whatever we have discussed till now, based on that, at 7 marks you can score. That level, basic level questions are also getting tested. Top end questions are also coming. Of course, we have to study everything ideally. So this is that. Before we go into valuations, one small point, understand this. Guys, there is a call option. Focus only on call, put later on will take up. Some share, underlying strike price is, let's say, 300. Premium is, let's say, 50 rupees. This fellow here is a holder. This fellow standing here is a writer. Now, carefully think, starting from holder point of view. A holder, did he pay 50 rupees or not? Premium paid, then only he became a holder. He believes that option will be exercised, option will be lapsed. Ultimately, if I believe that option will be lapsed, I'm not stupid to pay 50 rupees and buy the option, no. So if I'm paying something, which means I intend to recover that. And when will call option ka payoff you will get? Only when call will be exercised. And when will call get exercised? When market price is higher than the strike price, then only call option will get exercised. So prima facie, you should know that this fellow is having a bullish view. He believes that share price will rise. If share price rises, call option will be exercised. I will collect payoff from the other party. Adi holder ka plan. But a writer has altogether different view. If he also believes the same thing, he is not stupid to write a option, because option will be exercised, I have to give payoff in future. So I am somebody who believes that share price will fall. So basically this fellow will have a bearish view. Two parties with opposite views only will form a contract here. If both have the same intention, there is no point of entering into contract. No, so nobody will enter like that. Now, next thing. Tell me, sir. If Mark, correctly think and answer. If spot price is 301, okay, you are holder. Spot price is 301. Are you happy or sad? Think completely, peacefully. There is no prizes for guessing quickly. Think correctly and answer. You are sad. Is option getting exercised? Yes, option definitely gets exercised, because I have a right to buy at 300, market level price is 301, definitely I'll exercise. I'll get payoff also. How much? 1 rupee. But you paid how much? 50 rupees. So definitely overall you will suffer a loss of 49 rupees. Definitely you are sad. So just because option is exercised, you are not happy. If you want to be happy, option should be exercised with an amount of payoff which should be more than 50. So share price should grow beyond 300, but not 301, 320 and all will not help. It should cross something like 350. If it cross 350, then only you will get a gain. What if exactly spot price is 350? This 350 exactly is no gain, no loss situation. So we are going at now break even price. Break even price for a call option is equal to strike price plus premium. Sir, why are you doing plus? I am doing plus because call option will get exercised only when share price increases beyond strike price. That's the reason plus. But it's put option I would have added, I would have deducted this. Now, if break even price is that price where the net gain or loss will be 0. So this is that price where the net gain or loss would be 0 for holder and also for the writer. So in our example, that is 300 plus 50, which is equal to 350. If market price is exactly 350, sir, on the maturity date, you will exercise the option. You will get payoff of 50 rupees also, but you already paid how much? 50. So overall gain or loss is 0. Writer point of view, he is not sad either, just because option is exercised. Why? Option is exercised, he will pay payoff to you 50, but he already collected 50 from you already in the starting, so he is in a happy position only. Means overall no gain, no loss for both. So break even price is not for holder, break even price is for both the parties. Similarly, if I now take up a put option custody, put option, let's say strike price is 1000, premium paid is 100. Again there are two parties, holder, writer. Now this holder knows that the option will be exercised. That is the reason he paid premium and purchased it. And since it's a put option, put if it has to be exercised, market price should fall. What did we discuss? Rising market calls will exercised, falling market put will get exercised. So if put has to be exercised, share price should fall, and it should fall below 1000. So this fellow is now having what view? Bearish view. And this fellow obviously will have a bullish view. He believes that share price will not fall, put will be lapsed, entire premium is my profit. That's what that fellow will be dreaming. Anyway, so if option has to be getting exercised, price should fall below strike price. Suppose, sir, spot price is 999. Definitely put will get exercised. But are you happy? No. Why? Share price fallen down by 1 rupee only below the strike price. So you will get payoff also 1 rupee, but you already paid premium of 100. So you'll suffer a loss of 99. You wouldn't want that. So you want share price to fall more than 100 rupees from the strike price. So exactly if it falls like this, break even price is equal to strike price minus premium. Strike price is 1000, premium is 100, break even price is 900. If market price is exactly 900, then you will have neither gain or loss. Definitely your put will get exercised, you'll receive 100 rupees payoff, but you already paid 100 rupees only, net gain or loss is 0. Writer point of view, he already collected 100 starting, now he is giving you a payoff of 100. In that case, his gain or loss also will be 0. So, this is about break-even points ka formula. Now, call option, break-even point, which is X plus premium. All this starting we calculate and keep. Okay, now ultimate maturity date, sir. If the spot price on maturity date, if it is crossing the BEP, that means share price increased not only beyond strike price, it increased beyond my break-even price also. In that case, sir, definitely holder will gain, and 100% writer will definitely lose money here. This scenario. If spot price is equal to break-even price, in that case, at the break-even price, sir, no gain, no loss for either of the parties. But if spot price is less than BEP, then option may be exercised, but still holder will definitely suffer a loss. So, this call option ka dynamics, sir. Call option, think from holder point of view, it's easy to remember. Holder wants share price to increase first starting. Share price to increase beyond what? If it increases beyond strike price, option will get exercised. But if it has to recover your premium also, then it has to increase beyond your BEP. If it increases beyond BEP, then definitely holder will gain. If holder is gaining, automatically writer will be losing. If share price is below BEP, then definitely holder will be losing, therefore writer will be gaining. If it is at BEP, no gain, no loss. Now like that only, you think opposite and tell me for put option. Wait a moment. Put option ka break even price is what? X minus premium. The only thing you have to remember in your mind is holder of put option will exercise the put when the share price falls below the strike price. If it falls below the strike price, he will exercise. But if he wants gain, then it should fall below break even price. So first scenario, my spot price is below break even price. Definitely holder will gain. And if holder is gaining, automatically writer will suffer a loss. Right. Next scenario. Spot price is equal to break even price. In this, obviously, there is no gain, no loss to either of the parties. The moment spot price is higher than break even price, definitely holder will lose in this. Sir, how much will be his loss? That depends on what is the spot price, but definitely he will lose. And if holder is losing, definitely writer will gain. So this is a story of call, put, when to exercise, when to lapse, whether they are having bullish view, bearish view, how to compute payoff, after computing payoff, how to compute net gain or loss, and which market price the holder will gain, which market price the writer will lose, all this stuff we have discussed. Now, general points, sir. If you are a holder of call option, when will you gain? When share price increases. And share price increase can go to what number? It can go to infinity. It can go to any number. There is no limit on upward movement. Since upward movement is limit is not there, holder of a call option, sir, his maximum gain is equal to unlimited. Why is it maximum gain is unlimited? Is because his gain is linked to upward movement of the share price. For that, there is no limit. Therefore, it is unlimited. And holder of the call option, maximum loss he will suffer is nothing but the premium. Because holder always maximum loss is premium. Because I already paid premium. Worst scenario, what will happen? Option will be lapsed. Whatever money I paid is gone. the maximum loss. Now same thing, if you see opposite side, writer of call option. A writer of call option, sir, for him maximum gain will be this one, which is premium. Maximum gain is equal to premium. For him maximum loss is equal to unlimited. Sir, this is the dynamics of call option. Whereas when you take put option, if you are a holder of put option, here also one point is common for you. Maximum loss is always equal to premium. Worst case, what will happen? Your option will get lapsed, whatever money you paid, gone. Writer point of view, that's the best thing that can happen to him. Writer of put option, he always wants option to be lapsed, so that he will enjoy whatever money he received, that only will become his profit. But when you come to maximum gain in case of put option, should be a little careful here. Here we cannot say unlimited. Reason, put option your payoff is dependent on what? Dependent on share price ka fall, and share price cannot fall down to minus infinity. No, share price can fall down only to 0. Now tell me quickly, what is the payoff formula for put option? Good. Strike price, spot price. Strike price minus spot price. Now what is the best possible thing that can happen for a holder of put option is share price falling down, falling down, falling down, falling down. It can fall down to 0, not beyond that. Worst case you imagine, sorry, best possible case imagine, which is share price becoming 0. If share price becomes 0, what is your payoff now? X minus spot price, which is X minus 0. So your payoff is X, strike price. Your payoff is strike price. But I don't want your payoff, I want your gain. To get this gain payoff, I paid premium minus premium. This is a formula for maximum gain in the case of put option. But this formula coincidentally is equal to break-even price of put option also. The break-even price formula of put option and maximum gain in case of put option, they both are worked out using the same formula. There's nothing to get confused, sir. Here we are talking about maximum gain. That was different. What is this one? If gain or loss has to be 0, how much should be the price? This is, if price is 0, how much will be my gain? They both are two different things. Here we are talking about gain. There we are talking about share ka price. They both are different things. Coincidentally, a formula looks similar, but it has got no connection at all. Here share price, when it becomes 0, how much gain will you get? There, if gain or loss has to be 0, how much should be the share price? You are computing two different things altogether. Here I am computing gain, there I am computing share ka price for 0 gain, 0 loss. Formula looks similar, that's all, but they are purely coincidental. There is no logic and all for that. Now coming to this, only will become the maximum loss for the writer. Sir, these things also MCQ point of view important, sir. Although in main questions we will not get to see any of these applications, MCQ point of view, max gain, max loss, unlimited points, these are all important. Now, easy to remember how, look at this. Holder, sir, always maximum loss is premium. Let it be call option, let it be put option. Because he paid money, worst case he can lose that money. Writer point of view, best case also is that only. Maximum gain of writer, maximum loss of holder, fixed, sir, which is equal to premium amount. Now you have to remember the max gain of call option, max gain of put option for the holder. Now in that call option is easy. Why? Call option ka gain depends on share price ka upward movement. There is no limit on that. Share price goes to unlimited, my payoff also will be unlimited, my gain also will be unlimited. Therefore, call option maximum gain to the holder is unlimited. If holder is gaining unlimited, writer is also looking at a maximum loss of unlimited. This one alone you have to carefully remember. X minus premium, which is nothing but BEP formula also is coincidentally same. So with that, we have completed the basics of our option discussion, sir. Okay. Now In this, ultimately, before we go into main discussions further on option valuations and all, what you have to remember in your mind is call option and a word the moment you see, your mind should tell you right to buy. Put option a word wherever you see, your mind should tell you right to sell. That's all we want. If formulas appear, nothing is required. Everything will naturally come to you when you look at the numbers and all. Common sense will work. Call option, right to buy at strike price. Put option, right to sell at strike price. Obviously, holder point of view. Right trick, it will be opposite. Don't think from both the points of view at once. Unnecessarily confusion will come. Over a period, slowly you will evolve. The thinking will be easy. Well, now, purely based on this also, some questions are there. So in that also, one or two questions we can try. Then we will go into options ka valuation. Come to question number 4, please. We'll go through this one quickly. Seventh one is also a better question actually. Anyway, first, fourth one we'll handle. The equity share of VCC Limited is quoted at rupees 210. Today's share price. A 3-month call option is available at a premium of 6 per share. So if you want, you can buy a call option on this share as underlying asset by paying a premium of 6 rupees. Similarly, a put option is also available at a premium of 5 rupees per share. That means he's talking about a call option and a put option. For both of them, underlying asset is VCC Limited share only. Ascertain the net payoff to the option holder of call and put. So you are a holder of call option also, put option also. He is telling you that strike price in both the options is 220. Strike price is fixed. But market share price can be 200, 210, 220, 230, 240. So he has given you 5 prices. He has given you strike price. He is asking what is the gain or loss in this position. Now, you are holder in both the cases, sir. You are holder of call option also, holder of put option also. Think only once first. Let's say holder of call option. What's the strike price? 220. So which means you have a right to buy at 220. Now, when market price is 200, will you exercise, sir? No. When the market price is 210, now also lapse. 220 also lapse. Call option will be exercised only when the market price is more than strike price. So if you look at the call option story here, for this market price, this market price, this market price, I am lapsing. When I am lapsing, my payoff will be 0. Whereas here and here I will exercise, a difference will be my payoff. 230 ka share I am able to buy at 220, therefore I am having a gain of 10 rupees. Here I am having a gain of 20, but this is like gross profit. To earn this, you have to pay premium. How much premium did you pay? 6 rupees. 6 rupees is outflow in all the 6 cases, all the 5 cases. So everywhere 6 rupees is outflow only. So here if you see this fellow, minus 6, which is nothing but the premium paid, money lost when the option is lapsed. When the option is exercised, payoff will come. A payoff will recover your initial cost of 6 rupees. So that's how 4 and 14 came. Likewise, for put option also we can think. In case of put option, I have a right to sell at 220. Since I have a right to sell at 220, market price is 200. Definitely I will exercise the put. I will receive a payoff of 20. Market price is 210. Still I will exercise. I will receive a payoff of 10. But from here onwards, market price is better than my right to sell price. So I will sell in the market only. Put will be lapsed. So here onwards, put will be lapsed. So 0, 0, 0. In all the cases, whether call or put is exercised or lapsed, premium already you paid. So that's an outflow. Payoff received minus premium paid is your net gain or loss. So he's asking for both call option holder, put option holder. Come to this question, sir. Question number 7. He questioned one very old CMA exam question only. Mr. X writes a call option. See, you are a writer of call option. Sir, all of you have to think, otherwise it will be difficult. Writes a call option to share at an exercise price of 60 for a premium of 12 rupees. So first of all, the call option, strike price 60. Then The share price rises to 62 at the time the option expires. Now in this sum, sir, you are Mr. X. Mr. X is a writer. Whether you are holder or writer does not matter right now. Always whether option will be lapsed or exercised, that who will decide? Holder will decide. So you think from holder point of view first. Now holder has a right to buy at 60. Market low price is 62. Will he exercise or not? Yes, he exercises. How much payoff is visible to you? 2 rupees. Now come to reality. You are not holder. You are writer. The holder is exercising the call option. So we only have to give him an amount of 2 rupees payoff. But I already collected premium of how much? 12. So what's the gain or loss formula? Premium received minus payoff paid. Premium received is 12. Payoff paid is 2. My net gain is 10. First scenario. Second scenario. Mr. Y buys a put option. Tell me, who is he? Mr. Y buys a put option. Buyer of an option is always holder. So Mr. Y is the holder of put option. Strike price 80, premium 8.5. So this fellow has a right to sell at 80, holder. The share price falls to 60 by the time option expires. Tell me, sir, the holder has a right to sell at 80. Market price is 60. He will definitely exercise. How much payoff? 20 rupees payoff. Now you tell me, you are a holder or writer? You are a holder. So at 20 rupees you will receive, and you already paid a premium of 8.5. Net gain is 11.5 rupees. Next, sir. Mr. Z writes a put option. This fellow is a writer of put option now. With an exercise price of 80, premium is something 11 rupees. The price of the share rises to 96 rupees by the time option expires. Now put option will give the holder what? Right to sell at 80. But market low price is 96. When market low share is trading at 96, he will sell at 80. No. Put option ka holder will lapse. So payoff will be 0. Who are we? We are writer. So payoff payable is 0. Premium I already received how much? 11 rupees. 11 rupees entirely will become my profit. This is that. Next. Mr. XY, again, this fellow is also a writer of put option. Strike price 70, premium collected 8 rupees. Price falls to 48 by the time option expires. So put option holder has a right to sell at 70. Market price is 48. Definitely he will exercise. Payoff is 22. After computing payoff, you ask yourself, who are you? In this sum, we are a writer. Payoff is 22. Payoff is an outflow for us. We have to pay 22. But we already received 8 rupees. So 22 outflow, 8 rupees inflow, 14 rupees net loss. Like that you have to work out. Are we clear here? Right. Next question, the concept point of view important, sir. In this total 10 cases are there. To start with, 4 cases are enough for us actually. Come to fourth point. You have to fill in the blank, sir. Call option they only gave. Exercise price not given. Premium not given. But maximum loss to the holder is 1225. Always holder ka maximum loss is what? Premium. So premium number we know now. Holder's maximum gain not given. But it's a call option. If it's a call option, the maximum gain he will get is unlimited. Writer maximum loss he gave. Okay, fine. Writer's maximum gain. A writer at the best, his gain will be only premium. Beyond that 1 rupee also he cannot gain. So which would be 225. Break even price of call option he only gave. What is BEP formula? Call option X plus premium is equal to 1725. X plus 225 is equal to 1725. X is equal to 1500. Missing figure, MCQ is also important. Next. Move on to this one. The previous one. Put option, sir. Exercise price not given. Premium not given. Holder maximum loss given. Holder maximum loss is nothing but what? Premium only 4 rupees. Holder's maximum gain is 16. So you must know max gain in a put option ka formula. Max gain for holder of put option is BEP formula, which is X minus premium. X minus premium is equal to 16. x minus 4 is equal to 16, x is equal to 20. Remaining all he filled up a no. Last break even price is missing. This put option break even price maximum gain formula both are same 16. X minus premium 20 minus 4 16. Next. Try this one. Which type of option he did not tell you. Strike price not given, premium not given, holder maximum loss not given, holder's maximum gain not given, but writer's maximum loss is given. If writer maximum loss is unlimited, holder's maximum gain is also unlimited. Now that it is unlimited, it has to be only call option. And writer's maximum gain is given as 18. Writer can maximum gain only to the extent of premium amount, not more than that. So 18 is a premium, which is also the holder's maximum loss. And finally, he is telling break even price of this call option is 138. Strike price plus premium is equal to 138. Strike price plus 18 is equal to 138. Strike price is equal to 138 minus 18, 120. Are you able to follow, sir? Whatever we have discussed, we are just trying to do. See, e kind of sums when you do, what will happen is your basics will be very, very strong. Exercise labs, maximum gain, maximum loss, BP points, basic data, if it is clear, options will not scare you. Basics should be very strong. There is no doubt in that. Okay, do the last one. Put option, sir. Strike price is 900 given. Premium amount not given, but holder maximum loss is 180. If holder maximum loss is 180, that only is the premium. And holder's maximum gain, sorry, that's one last one, correct. Holder's maximum gain. Now that's a put option. What's the formula? X minus premium, 900 minus 180, which is equal to 720. Writer's maximum loss. Writer's maximum loss, writer's maximum loss also will be 720. Writer's maximum gain will be premium 180. Overall break even price again 720. Same story, sir. We can handle this. You do the rest of the thing. This one, sir. See, December 2024, 7 marks. What question came? You see, the market received some information about Zinton Limited. The up with MS, okay, something with not that, sir. Tie up, sir. Okay, tie up with MNOS Limited, a MNC. So is Zinton and this second company MNOS, they both are going to tie up and market lo some rumor came. This has induced the market price to move up. Whether true or false, we don't know, but share price jumped up. If the information is false, Zinton Limited stock price will probably fall dramatically. To protect from this, Mr. Johan, an investor, has bought call and put options. Now you see, sir, there is a particular share whose price has increased recently based on some rumor. If that rumor is true, share price will increase further. If the rumor is false, share price will fall down. This fellow is standing today and he wants advantage on either side. He feels that, okay, share price rises, call option will get exercised, I'll buy one call. If at all share price falls, put option will get exercised, I'll buy one put. So he purchased one call also, put also. So that either the rumor will be true or rumor will be false. Somewhere he will gain. So that's what his plan is. But in this, what is the side effect? You will not gain on both sides. You will not gain. See, call and put both will never be exercised at the same time. Either call will be exercised or put will be exercised. See, the rumor is either true or false. If it is true, call option you are happy only. But put la premium paid is gone. If rumor is false, put will protect you, but call ka premium is loss for you. So you cannot be over smart. This strategy risk is there. Only one will become true. Anyway, he purchased one 3 months call with a strike price of 150 for 10 rupees premium and paid 6 rupees per share premium for a 3-month put with a striking price of 140. So call premium, put premium, call strike price, put strike price they have given. And this fellow purchased 100 shares, underlying asset 100 quantity. See, sir, since these are exchange traded contracts, if you go and tell that, sir, I want to buy Reliance Industries ka call option on one share, They will not give you. There is something called as a lot size. Minimum contract value will be there that you have to take. Minimum 500 units, 75 units, 2000 units, depending on the share price. Exchange will fix that. That is something which you should not remember, and all exchange will tell you that. So in this case, his betting is on how many shares? 100 shares. Assess the investor's position if the tie-up offer bids the price of Zinton Limited stock to 145 rupees in 3 months time. Okay, very well. You have to do it on your calculation. Tell me guys, 145 rupees share price went up, sir. Market lo share price is 145. I have a call option with a right to buy at 150. Exercise lapse. Call option payoff is 0. Gone. Leave it. What about put option? Don't even think about it. A put lo you have a right to sell at 140. Market lo price is 145. Both gone. Call also gone. Put also gone. Whatever premiums you paid in both the options, totally loss only, no? How much premium did you pay, mother? 10 rupees there you paid. Here 6 rupees you paid. 16 rupees overall. 16 into 100. Per share 100, 16. Total 100 shares, no? Over Katam loss. 1600 rupees loss. What he thought is it will fall below 140 or rise above 150. His luck is in between. This is called as straddle. Okay, anyway, continue. Analyze the investor's position if the tie-up offer program fails and the price of the stock falls to 110 in 3 months. Now that share price has fallen down below 140, definitely put will exercise. Call, don't even think, call is lapsed. Premium total paid 1600. Again and again we need not calculate. Just to work out payoff of put option. Put option you have a right to sell at what? 140. Market low price is 110. So payoff is 30. 30 into 100. 3000 rupees payoff will come. Overall I paid 1600 rupees premium. Net to my gain is 1400. Clear? Next. Analyze the investor's position if the tie-up offer is successful and the price of the stock rise to 153 in 3 months. This time it crossed 150. Therefore, call will get exercised. 3 rupees payoff you will get into 100. 300 rupees only. Put will be lapsed. Don't even think about it. 300 rupees inflow. 1600 rupees outflow. 1300 rupees loss. These came, sir, in the exam. After discussing students, people, we do all this binomial model, Black-Scholes model, 1 period, 2 period, put call parity, everything you learn. Ultimately, that fellow asks payoff based question. This is also important. As long as you get marks, how does it matter for us? Important stuff. Well, okay. Now, listen to the stories now. This is, sir, each chapter basics are only this much, whatever you studied. Valuation of option, your questions are based on this. Valuation of option ka meaning is determining call oblig put premium. A premium calculation only is called as option ka valuation. Now, in this total, 4 methods are there. One dummy method is also there. The first one is called as normal direct method. A method in reality does not exist, sir. This exists only in your books. But the method has got its own advantage. So we retain that because 1 or 2 questions can be solved using that and it will set up the base of thinking basically. That's the reason. As such, technically there is no method, is wrong also. Coming to the main one, the first one, important one, is binomial model. A binomial model, see the name itself is telling bi means this particular model does the valuation of option believing that on the maturity date, share price can be either one high price or one low price. That fellow will consider only 2 possibilities. So, that's the reason it's called as binomial model. In this binomial model, again, 2 methods are there. Both are important. You have to learn both because the question will not ask you to simply work out option valuation under binomial model. That fellow will very clearly specify which method you have to follow. Both the methods will give you same answer, but still you have to learn both the methods separately only. The first one is called as risk neutral model. Second one is called as riskless hedge approach. This second method only also called as portfolio replicating model. Suddenly in the exam, if they use this different name and all, don't blink. That is that only. Then we have something called as theoretical boundaries of option. Not a very important discussion, but definitely part of syllabus. Theoretical boundaries, look at the name. This theoretical boundary, you will never get the value of the option. You will only know minimum and maximum value. Call option ka bare minimum value, top end value. Exact value, e method will not give you. Similarly, put ka minimum value, put ka maximum value, exact value, e method will not give you. Next. Fourth method is called as put call parity. It is important, sir, for your exam. Put call parity theory. And finally, Nobel Prize winner, Black-Scholes model. That's all, sir. If 5 models, if you learn, then your option ka valuation is over. We can jump off to futures. One small good news is our syllabus and past exam questions and all predominantly revolve around valuation of option. Nobody will ask you to application of options questions are relatively less only. We don't have almost negligible. Application means how to use option for hedging. These kind of questions are not there. But when you go into futures, valuation is small only. Their application of futures is very, very large. Here applications is not there. A premium calculation if you do, they are very happy. So, if 4 or 5 models you have to work out. In this, the first method introduction you see first. Sir, like how you did fair value of bond, which is present value of future cash inflows, fair value of share, which is present value of future cash inflows, like that only, if first method, normal direct method, this fellow believes that your value of the option, let it be call or put, it can be anything, is equal to. Sir, if you are a holder, if you buy a call option today, in future what inflow will you get? What inflow will you get? Dividends you will get. If options exercise, what will happen? You will get payoff. That's the only inflow. A payoff certain or uncertain? Uncertain. A payoff will come only when the option is exercised. Otherwise, payoff also will not come. It will be zero only. So that's why your future inflow is what? Payoff. That too, it is not a certain payoff, uncertain payoff. So we call that as expected payoff divided by 1 plus PIR, present value of expected payoff. If you are using continuous compounding, then, or else why to write unnecessarily here, here only will write, or e power r. E power RT you will use when it is a continuous compounding. E value 2.71828, I already told you this. Right, now, sir, how to compute expected payoff? Now, in these two cases, sir, again, depending on all the questions I have seen, I'm summarizing like this. Question provides information about expected spot price of the share on maturity date. Means strike price anyway they gave you. Future ka spot price number also the question only gave you. That means what, sir? You know strike price, you know spot price also on the maturity date. All you have to do is what? Work out payoff and discount it. Simple. So in that case, payoff in call option will be such a spot price minus strike price, or if it is put option you are talking about, then it will be x minus spot price. That's all. Very, very straightforward. But sometimes questions what they will do is, sir, instead of giving you future cost spot price, question provides multiple spot prices and probabilities. If it is given like this, how to calculate expected payoff is work out payoff in each price and then multiply with that probabilities. In this, what you should avoid is expected spot price, because multiple prices are there, multiple probabilities are visible. We tend to go and multiply both of them. Never do that. So do not compute this one. Do not compute expected spot price for the wrong. This mistake, if you avoid, you are safe. Sir, how is that a mistake? Here we did that only. No, I'll show you all that, sir. Just watch the numbers. All this is there in the part of your concept book, sir. Okay, just watch the numbers. Sir, we are talking, let's say, about a call option who is having a strike price of, let's say, 300 rupees. Case 1, question came and told you that at 3 months, expected spot price is 360. Therefore, how will you compute now? Expected payoff is equal to expected spot price minus strike price, which is equal to 360 minus 300, which is equal to 60. This is okay. This is not wrong. It is perfectly right. When there is only one spot price, you worked out. Now, how he got 360 is irrelevant for you. But if the question gives you data like this, call option, strike price is equal to 300, and that fellow tells you that your spot price at maturity can be 260 also, 280 also, 300 also, 340 also, 380 also, with their probabilities they gave you. 0.1, 0.1, 0.2, 0.1, 0.4, or how much is over 40, 40, 80, 0.2. In this case, sir, just because question share price probabilities both are given, if you go and multiply them and work out expected spot price, that is wrong answer. Now, how that is wrong answer? Let's work out here and show. Expected spot price based on this is equal to, multiply and tell me, sir. Having calculator, forgot. 26, 56, 30 into 0.4, 380 into 0.2, 324. Expected spot price is 324. Call option strike price is equal to 300. Therefore, payoff is equal to 324 minus 300, which is equal to 24. This is wrong. Now, why is this wrong is, when you do like that, sir, you are indirectly assuming that a call option is exercisable at all the prices, because in 324 all the prices are there, no? That means you are comparing 300 virtually with 260, 280 and taking the difference also, multiplying with that probability also, whereas call option will not be exercised at 3 prices. Therefore, you computing expected spot price is wrong. So what should I do? First, I should work out payoff. So we have a right to buy at 300. Market low price is 260. We will lapse, exercise. Now what you do? Marry these two fellows and directly get the expected payoff. Share price you should not work out. If you work out share price, then you are indirectly assuming that call option is accessible at all the prices, which is not true. So expected payoff will be is equal to payoff into probability. 4416 is 8 is 30. The correct number. Is the wrong number. Clear, sir? Now imagine one very different scenario where in 3 numbers placed, sir, you are having 310, 320, 330. Then you apply any method, answer will be same, because the option technically is exercisable at all the possible prices. You're getting it, sir? So if question gives something like this, you don't have a choice. You just assume that all the possible prices that are considered into that framing of 360, at every price option is exercisable. Therefore, this is correct only. But when the question wantedly gives you this, don't do this one. The wrong. Clear? Okay, this is one method, sir. E method lo expected payoff you worked out correctly only, and question only will give you one discounting rate. Use the discounting rate and bring that payoff to today. Expected payoff means option value on the maturity date. I want option premium as on today. So you have to discount it back to today. That's all. So based on this, a couple of questions are there. For example, the question is one such question. Question number 11. Question number 12 also is a similar question. Or else let's come to 12th question first. Go through it. Both are similar, sir. They are not very important, but they have come in the past. A 6-month call option for a share has an exercise price of 38 along with probabilities and prices at expiration date as below. So 5 probabilities are given, 5 share prices are given. He is talking about a call option, maturity 6 months, strike is 38. Now 5 prices they have given. First question is asking, what is the expected price of the share after 6 months? He is not asking option value. He is not asking payoff. He is asking what? Share price ka future expected value. So multiply. You multiply all this, and sir, you told not to multiply. I did not say not to multiply. I said don't use that price for option ka payoff calculation. Simple expected spot prices, there is no problem. Up to here is correct. But this is wrong. Right? So that fellow is not asking you payoff. No, why are you worried? So you simply work out, multiply these two. You will get some number 40. 40 is expected share price. Of course, I will not use that. That's a different thing. B point. What is the expected value of the option? Now he is asking value of the option means today. Expected value of the option means future date ka value. So this is still he is asking you expected payoff only. Because sir, if you have to work out value of the option today, discounting rate question they have to give. No, they did not give. We can only work out only up to expected payoff. So payoff how to work out? Go to each price, compare with your strike price. Tell me, sir, you have a right to buy at 38. Market low price is 30. Lapse. Here 2 rupees excise. Here 6 rupees payoff will come. Here 12 rupees payoff will come. 2 into 0.3, 6 into 0.25, 12 into 0.10. Ultimately, you will have 3.30. 40 versus 38, if you compare, 2 rupees will come. That's the wrong answer. 3.3 correct answer. Are you getting it, sir? He wantedly made you compute this one, so that next step you will use that. That's where you should be careful. Then he is asking, what is the value of the option assuming interest rate is 12% per annum? Payoff is on which date, sir? Maturity date, which is in our example 6 months later. If you want option value today, what should I do? That payoff I have to discount it back by 6 months using some rate. Debit also same thing. He's saying that 12% but continuous compounding. Since it is continuous compounding, instead of dividing with 1 plus PIR, you will be dividing with e power RT. That's all. That is this question, sir. Now, If first model, which is normal method concept is over. Next we have to go into binomial model and all. But before we go into that, first understand why a method is flawed. A method one problem is there. What is the problem is? You expected a payoff, all that you will compute correctly only, but the discounting rate what you are using, our discounting rate, there is no scientific proof. There is no method to work out how to identify the required return from options. See, required return from share if you take, CAPM formula is there, RF plus beta into RM minus RF. Whenever you bring a share valuation, you have to use this as discounting rate. If you talk about bonds, how I will know? For example, you are trying to value one new bond. You are trying to value one bond of an existing company. How will you know what is your required return? What you will do is, suppose e bond is some AAA rating, AA rating, some rating will be there. A particular bond, similar company ka bond, it is trading in the market at what price, you will go and see. From that, another bond you work out to ITM. Then you will understand that, okay, e kind of risk people are expecting so and so percentage, let's say 12%. So now this company which is issuing bond, this one is also having the same risk. From this bond also, I also want a return of 12%. So there is a scientific method of working out your required return. See, when we went to capital budgeting chapter, your required return there was WACC. Because you are bringing your money from equity and debt both put together. If you have to satisfy their expectations, you have to earn at least WACC. So required return, if you have to use it as discounting rate, our required return some base should be there. This method la, this discounting rate, how did you get? Question la 12% they told I used. But in reality, sir, like how share ki you have a required return calculation, bond you can work out a required return calculation, project you can work out a WACC calculation, like that, option valuation discounting rate does not exist. It does not exist. That's the main problem why option valuation is difficult. Sir, why so many methods? Bond valuation, so many methods are there. Only one method only, no? Why so many methods here? The reason is that only option ka required return is not there. That's a whole problem. The entire drama of option starts because discounting rate is not there. Sir, some discounting rate we cannot use like that. Then it won't be fair value. Sir, is share ka discounting rate is there, no RR? That only we will use for call option on that share also. No, sir. Compared to share, option is even more riskier. Since option is more riskier than the share, we definitely want a higher required return. Now, how much higher you want, there is no method for computing this. Sir, imagine you purchased a share for 100 rupees. You held the share for 1 year. Share price fallen down to 90. Are you happy or sad? Sad. You purchased something, share price fallen down. Fallen by how much? 10 rupees. So if I ask you how much loss did you make? 10%. 10 rupees loss, 10% loss. Clear? Leave it. Next, what I did is, thinking that our share price will increase, instead of buying that share, I purchased a call option on that share. You purchased share at 100, thinking that share price will grow, did not grow, fallen down. Your loss is how much? 10%. I thought I am smart. What I did, people are buying share, let me buy option. I purchased option. Call option I purchased. Correct only, no, sir. Rising market, call only will get exercised. No, call I purchased. For purchasing call, I have to pay premium. I paid 7 rupees premium. I paid. Hold the option for 1 year. After 1 year, market share price is below the exercise price. Call option lapsed. Whatever 7 rupees I paid, loss only, no. You lost how much? 10 rupees. I lost 7 rupees. Correct? Which one, sir? Call option I pay only premium. No, I will not buy share. Call option I paid premium of 7. I have a right to buy share. I don't have share. I waited for 1 year. Share price did not exceed the exercise price. Call is lapsed. Call is lapsed. My entire 7 rupees is loss for me. For you, loss is how much? 10 rupees. For me, loss is 7 rupees. But amount terms say my loss may look less. But look at your investment. You invested how much? 100. 100 rupees, 10 rupees gone, 90 safe. So your loss is only minus 10%. My 7 rupees I invested, entire 7 gone, 100% loss. You understand, sir? Share price fallen by 10 rupees for you also, for me also. But your loss is 10 rupees only. My loss is 100%. Your loss is 10%. Share investment risky. Option investment risky. But option is more risky. More riskier. Are you getting it, sir? That's why share ka required rate I cannot use for option ka discounting rate. Suppose past we will talk. Same story. Market price from 100 today went to 120. 120. You purchased for how much share? 100. Share price gone to 120. You gaining by rupees, percentage terms 20%. I paid 7 rupees. Purchased option. Strike price 100. Market low price 120. 120 share price, I have a right to buy at 100. I'll definitely exercise. Payoff is 20 rupees payoff. Premium paid 7. Net gain 13. So I made 13 rupees gain on an investment of 7 rupees. My return is how much? 185.71%. You earned how much? 20. My return 185%. Are you understanding, sir? You are also playing on the same share. I am also playing on the same share. You are playing in cash market on the share. I am playing in options market. Are you understanding the risk element, sir? Small fluctuation in the share price, my entire money can go. Suddenly I can make 185% return also. Obviously, option is more riskier than the share. So share ka discounting rate, RR, whatever is there, I cannot use for options. That is the whole problem of option valuation. Sir, then what are all these methods? Surprise is, so many methods are there. No, first method is a stupid method, that is. Now you understood, sir, why it is a bad method. Who will give required returns? Sir, wrong. Leave it. All methods, sir, you know who is a discounting rate? Risk-free rate. Sir, just now only you proved that share option is more riskier than share. So instead of discounting with a higher required return, you are discounting it with. How is it right? That's why these are all called as option valuation models. Real. They are all fake models, sir. They all come with lot of assumptions, dummy creations, paper existent. Final answer correct. But entire process is fake. How can you use RF as discounting rate? RF will be used as discounting rate for risk-free assets. Risk-free asset, most risky instrument. But I don't know how to work out RR. Since I don't know how to work out RR, you build fake models. A fake model option is also one of the player. You create that in such a way that our entire model is risk-free. And you discount it using RF. Once you discount everything to today, you will eliminate everything, remaining whatever is there as option ka value. This kind of cheating method we follow for option valuation. So that is a whole background story. Anyway, what you do is, the basics of option, without valuation of options, remaining basics you revise and come. Just remember that, sir, only one thing, the option is purely betting game, sir. Purely betting game. Let's take call option. The holder says, share price will rise. If it rises, I win, you pay me money. If it falls, I lose, but I will not pay you money. One side betting. I win, I receive money from you. I lose, I won't pay money. Look at this example. My strike price is how much? 2000. I betted 2000. Share price will cross 2000. You said that much scene is not there. Bet. Ultimately, share price went to 2600. I won. You paid me how much? 600. Second scenario, 1600. I lost. I will not pay you anything. One side betting is option, sir. Put option also same story. I told share price will fall. Bet. Share price really fallen down. You pay me money. Share price risen. I will not give you money. Sir, if one side bet, who will enter? You will enter, writer. Because I first pay you some premium. This is one side betting. Futures contract two side betting. But premium will not be there. Gain also possible, loss also possible. Call option, sir, the holder enters into a betting transaction, but he insures himself from a loss by paying some premium. Insurance premium, as simple as that. Pure betting, sir. Worst case, we forget all this also. Just understand that call option is upside betting, put option is downside betting. This fellow says price will rise, the call option betting. Price will fall, put option betting. Revise all this, sir. Tomorrow we'll have a Very intense session. Well, guys, after discussing the basics of options, that is, who are the parties in an option contract, what are the types of options, what is call option, what is put option, when to exercise a call option, when put option will be exercised, if at all option is exercised, how to compute the payoff, whether payoff is inflow or outflow, how to compute net gain or loss, break even price of the share at which gain or loss is equal to 0, and what is the maximum loss and maximum gain to the holder, and maximum gain and maximum loss to the writer. The basics we have covered. After that, we have started valuation of options. Option valuation, sir, this is nothing but you determining the premium amount. That only is called as option valuation. As such, core models are only 4, sir. It starts with binomial model, theoretical boundaries, put call parity equation, and Black-Scholes model. The first model, as I told you, even though it has come in the exam once or twice, it suffers with a basic flaw that you do not know the discounting rate. Broadly, the fair value of anything is nothing but the present value of future cash flow, discounted rate, required rate of return. Let be bond, share, derivative, or for that matter, a business or an entity as a whole, anything. But options law, the issue is we do not know the required return. Since there is no scientific method to determine required return, we will not be in a position to work out fair value of the option directly. So our direct method, whatever is there, that suffers with a basic flaw. However, the reason for discussing that is in the examination question, once it has come. Second reason is, if not value of the option in today's terms, at least they will ask you expected payoff. So expected payoff, at least a model you have to discuss, because yesterday what did we see in this? If you have to compute expected payoff, there are two possibilities again. If the question gives you future ka spot price versus strike price, you will compare. Accordingly, you will identify some payoff. That is a very straightforward scenario. But if multiple spot prices along with probabilities are given and they are asking you to work out expected payoff, do not work out expected spot price and then compare with strike price. That is wrong. You have to see whether option is exercisable or not at each given possible price. If at all it is exercisable, then we will work out the payoff. A payoff multiplied with probability will give you expected payoff. So for that purpose, we have discussed this. As such, not in the range of other 4 models what we are going to discuss today. Now, let's come to the first model, which is binomial model. Now, this binomial model prima facie comes with a assumption that 0 is today, sir. Maturity date is somewhere, some date in future. This model believes that the spot price of the share today in future can take only 2 possible numbers, either one high price or one low price. But in reality, if you observe, how can you tell that share will either become a high price or low price? Only 2 numbers, it can be any other number. For example, if I plot numbers here, for example, spot price is 100. You are saying that in future market price can be 130 or it can be 80. There are only 2 possibilities for the share price to move, either up or down, and it will go to either 130 or it will go to 80. In reality, it won't be like that, no sir. In reality, it can go to any number, it can fall down to any number, and not only 2 possibilities. Now, how is this model correct? Now listen guys, it is like this. Suppose you wrote an exam and I asked you how many marks are you expecting. You will tell me how many possibilities. That depends, so sir. For example, you are very certain you will come up with one answer. Sir, I will get exactly 73 marks, not more, not less. Fine. Then if you are not very certain about some of the questions what you have answered or some of the MCQs what you have answered, you are not very sure, then you will say conditional things. Sir, if this question is right, then I will get 73. Otherwise, I will get 70 only. Or if these both are right, then I may get 80 also, like that. Multiple answers are possible. This fellow says, don't tell me so many possibilities. Ultimately, freeze it into only 2 possibilities. It's like, I don't want marks. Tell me pass or fail. Only 2 results I want. So like that, even though n possibilities are there, you are supposed to fit this n possibilities into a two possibility model, one high price and one low price. That is the reason this is referred as binomial model. Now, under binomial model, again two methods are there. The first one is called as risk neutral method. A method is very simple, very easy to execute also. Only thing is, if you want to know the logic of this, then you have to think a bit. But as such, question solving is concerned, very simple, very easy, extremely easy. Now, this method says value of option is equal to your expected payoff divided by 1 plus PIR whole power n or e power RT. Now, this looks like yesterday's normal method only, correct? Normal method also we have used the same formula. But what is the difference is, this time this PIR will be risk-free rate. Now, how can you discount an expected payoff with risk-free rate? For that, stories will come. Now, how to compute expected payoff? Sir, when multiple prices and probabilities are given, how are you computing expected payoff? Payoff into probability. Likewise, here also, how many prices are available to you? Share price can either become 130 or share price might fall down to 80. If at all share price becomes 130, what is the payoff you will get? Work out that. If it falls down to 80, what is the payoff? Work out that. So, payoffs multiplied with their probabilities. That is what is your expected payoff. Nothing new. Whatever we discussed yesterday, same thing. So, expected payoff is equal to payoff at high price into probability of high price plus payoff at low price into probability of low price. That's all. So this is also similar to what we have discussed yesterday. There is nothing new. Next thing, probability of high price. Now, how to identify the probability of high price? Now you see, in the questions what we have seen yesterday, probability question they have given. A risk neutral method ka probabilities question will not give. You yourself have to calculate. Now for that there is a formula. It's called as SP into 1 plus PIR minus the low price divided by high price minus low price. If e power RT is used, a 1 plus PIR plus e power RT will come, but as such formula will be same. And obviously probability of low price will be 1 minus probability of high price. That's all, sir. This is outrightly 7 marks worth. All you have to do is, in the question, they will give you some data like this. Today's spot price, future ka high price, future ka low price. They will give you one strike price also, call or put option ka strike price they will give. That's all. You will have to do just this much. In this, if you think steps wise, step number 1, work out this, then work out payoff at high price, payoff at low price. Now two payoffs you know, two probabilities you know, marry them, you will get expected payoff. Question of discounting rate RF will be given to you. Nicely bring it down to today. That's all. Value of the option is ready. That much only, sir. But the thing is, if you want to know how this probability of high price is coming and why risk-free rate you are going to use a discounting rate, then things become heavy. I will discuss that with you right now. But as such, understand that in a given question, your job is very simple. Just work out two payoffs, work out two probabilities, marry them, get expected payoff, discount that expected payoff from maturity date to today's date. Whatever present value you get, that only is the value of option. That's all. Over. Now, a high price, low price will be in such a way that, for example, take a call option. Strike price is 100. A call option will be exercised here and it will be lapsed here. Suppose I change that this is not call option, this is a put option. If put will be lapsed here, it will be exercised here. The high price and low price will be given to you in such a way that at one price option will get exercised, another case option will be lapsed and consequently payoff will be 0. So you will not have both the payoffs in fact. Then why to write means I do not know, sir. If it's call option, here you will have, here it will be 0. If it is put option, here it will be 0, here you will have a number. So for that reason, completeness we write, but as such, this much also will not be there. Okay, now coming to the logic of this. In logic, okay, I will do one thing, just to quickly finish it off. See, ultimately logics are irrelevant now, sir. But if you know, that will help you to connect with next concept, that's all. So the logic somewhere I wrote, from there I will show you instead of doing the whole thing again. Okay. Maybe I did not write also. Okay, I thought already waste. Anyway, listen here. See guys, if you are having 100 rupees, okay, with you today 100 rupees is there, and today risk-free rate is 10% per annum. You want to invest your money for a period of 1 year. So this 100 rupees in 1 year will grow to 110. This is purely investment made at risk-free rate. Forget about that story now. Listen to another story. We'll link up both the stories later. Spot price of the share today is 100, let's say. Is spot price of the share today 100? In 1 year, it can become either 120, which I am calling it as high price, or it can fall down to 90, which might be the low price. Now, we are trying to value for a call option. I'll bring the call option story later on. Now, sir, you go to a stock market analyst, ask him, sir, 100 rupees today share price is there. What is the chance of this 100 becoming 120 in 1 year? That fellow, based on his experience, outlook, and insights into this particular company ka share, he will tell you some probability, that it will be, there is a 30% chance or 70% chance or 50%, something he will tell. That probability, the real probability of 100 rupees share today becoming 120 after 1 year, that cannot be worked out using any formula. If you observe, we wrote a formula for probability. Probability, if I am writing formula, sir, there itself you must understand that is wrong probability. Whatever probabilities you are computing here, our probabilities are not real probabilities. These two probabilities are fake probabilities. They are dummy probabilities. Partially in the books they call it as risk neutral probabilities. They are not a real probability. Suppose I ask you, what is the chance of you passing? You told me 70%. I ask you, prove it. 70%, calculate and show. How can you calculate? You cannot calculate. No, sir. Probabilities are never calculated. Probabilities are assigned. Based on some feeling inside, you will identify one number to it. Same movie review, 3.5. How did you get 3.5? There's no calculation for that. Feeling. That's all. Feeling what formulas are here? This fellow created a formula. There itself you must understand that these are not the real probability. Real probability, how can you calculate, sir? Somebody has to give. A real probability, let's say somebody told me there's an 80% chance. Here the real probability is 20% chance. But you know what? A real probabilities we don't want. We don't want real probabilities. If entire model, why real probabilities are not considered, that you will understand towards the end. Timing, whatever probabilities you are calculating, what is that? Now, I want, if I buy the share today at 100 rupees, hold the share for a period of 1 year, share price can go up, share price can go down. For that, some real probability will be there. I'm not interested in that. My goal is, what is the chance of this 100 rupees becoming 110? So that I make a risk-free return of 10%. My goal is to calculate the probability of share price becoming 120 or the share price becoming 90 in such a way that my objective is to earn a risk-free return from this. That means, 100 rupees, sir, if you have to earn a risk-free return of 10%, your money should become how much now? 110. Is share price ka expected value should be equal to 110 to earn a risk-free return. If your goal is to earn a risk-free return, ఈ షేర్ ప్రైస్ ka high price and low price ka probabilities I want. Indirectly, what am I trying to say is at 1 year time, 120 and 90, ka expected value should be equal to 110. That means 120 into probability of high price plus 90 into probability of low price. This is only expected share price, no? The expected share price should be equal to 110. Sir, why do you want to earn only risk-free return? That I will tell you later on. Now, 120, if I call this as P plus 90, this will be 1 minus P, which is equal to 110. If you open up this 120P plus 90 minus 90P is equal to 110. So here P into 120 minus 90 is equal to 110 minus 90. So P is equal to 110 minus 90 divided by 120 minus 90. 110, how did I get first of all? 100 k added 10%. What is 100? Spot price of the share. So 110 is nothing but 100 into 1 plus 0.10. 90 is 90 only, which is low price. This is high price. This is low price. So this is your formula, sir. Probability of high price is equal to SP into 1 plus PIR minus low price by high price minus low price. If you process this here, what's the answer you are getting? 0.64 or 0.65? 0.67. Therefore, probability of low price is equal to 1 minus 0.67, which is equal to 0.33. You observe till now, I never brought option into picture. I did not bring option ka story into picture. I am only playing with the share. Share price today 100. After 1 year, if it has to give me risk-free return of 10%, then the probability of a share price touching 120 is how much? The probability of the share price falling down to 90 is how much? If the share has to give me risk-free return of 110. That's what I calculated. Now I am telling you, I have a call option with a strike price of 100. Maturity 1 year. Now 0, 1 year. Your spot price of the share today can either become 120 or it can become 90 according to our estimations, high price and low price. Now tell me, sir, what is the payoff from call option given that today call option you are having with a strike of 100? Tell me, call option will give you what? Right to buy. I have a right to buy the share at 100. Market if the share price is 120, my payoff will be 20. But if the share price is 90, I have a right to buy at 100. Will I exercise the option? No, in that case call option will be lapsed. So my payoff will be 0. Now, you already worked out probabilities of high price and low price. What is the high price probability worked out? 0.67. So this is 0.67. This is 0.33. Marry them. So you will get payoff into probability. So 13.40. This is 0. Total it is 13.40. What is 13.40 now? This is expected payoff. The expected payoff, which is standing at 1 year time, this you have to discount it to today using risk-free rate, which is 13.40 divided by 1 plus 10% in this example. How much did you get? 12. 12.18 is the value of your call option. This is how you work out. Now in this, the only thing I have to explain is, why did we use risk-free rate as discounting rate? For that the answer is simple, sir. Let's come back. These are not real probability, the fake probability which is designed by me in order to earn a which return? Risk-free return of 10%. Suppose I take real probability 80-20. Okay, now tell me, sir, what is the chance of you getting payoff of 20? 80%. Chance of you getting payoff of 0 is 20%. So if you now do expected payoff with real probabilities, you will get 16, correct? Are real probabilities when you consider, that is a real payoff only. Now this is a real payoff, this you have to discount it back. I do not know the discounting rate. As I told you yesterday, we do not have a scientifically measured required return from options. Since I do not have a real required return, I cannot take real payoff. So what did I do? I created dummy probabilities which are capable of giving you which return? Risk-free return. So this is not my real payoff. ఇదొక dummy payoff which is capable of giving which return? Risk-free return. Since in that only risk-free return is there, I get a license to discount that at what rate? Risk-free rate. Therefore, the answer is correct. Real, it's not like I can't calculate I can't work out real probabilities. I will ask somebody and get. I will work out real expected payoff also. But the problem is I don't know how to come back. Since I do not know how to come back, there is no point of you bringing real probabilities into picture. Therefore, we use dummy probabilities. These are called as risk neutral probabilities. Our probabilities are not real. We fake probabilities which are designed. Probabilities will never be designed, sir. Probabilities are assigned. Based on your feeling, you will identify probability. You will never calculate probability. If I am calculating itself, you must understand something is wrong in it. What is wrong? You calculating a wrong. I calculating probability with the intention of getting what return? A risk-free return. Therefore, a payoff is not real payoff. That is dummy payoff, which is capable of giving risk-free return. So you should discount that only with risk-free rate, and therefore a final answer is correct. So this is the logic of risk-neutral method, sir. Okay. But despite all this, answer will be only this much. You just have to work out high price probability, low price probability, payoffs at high price, low price, expected payoff, just discount it. That's all. Answer is only this much. In this, one small point. Come here. What's the probability for high price formula? We have written this one. No, for this, there is another alternative formula. This also in some cases will be very useful to you. This is R minus D divided by U minus D. Here R means 1 plus PIR. D means 1 minus downward movement. Percentage decrease in the price. U means upward movement. 1 plus percentage increase in the price. Excuse me. Minus, this is again 1 minus percentage decrease in the price. Sir, why to complicate this? Above formula is okay only. We're just now making peace with it. What is this stupid formula again? Now you see, sir, a formula, even though it looks bad like that, it has got its own advantage. As such, a formula, nothing is there, sir. Come here. E step you see, this step. Okay. E step, sir, numerator and denominator divide with spot price of 100. Numerator, denominator, I can divide with 100. My answer will still be same only. So if you divide with 100, what will happen? P is equal to 100 into 1 plus 0.10, 100 will die. I will have only 1 plus 0.10. 90 divided by 100 will become 0.90. Denominator 120 by 100 will become 1.20. This will become 0.90. So this I can write it as 1 plus 0.10. This is 1 minus 0.10. This is 1 plus 0.20. This I can again write it as 1 minus 0.10. This is nothing but, 10 and 20 is nothing but your upward and downward movement. You are talking about a 20% upward movement or a fall of 10%. At 20/10th, we can create a formula. That also works. You will 100% get the same answer because this formula itself is derived from the original formula. Original formula ka numerator and denominator, if you divide it with spot price, then automatically you will get this. Yeah. That's all, sir. Only this much. Let's pick up some question on this. The derivation was part of the book, sir. I thought it is there. But as such, I removed it because people go and read all that unnecessarily. That's not relevant for exam. You just understand the concept, that's enough. Please take up question number 13, sir. Current share price is 100. So spot price, that is. Risk-free return is 20% per annum, RF given. Find the value of a 3-month call option with a strike price of 100 using binomial model, assuming that at expiration the spot price will be either 115 or 90 rupees. Check your solution using risk neutral method, the method what we just now learnt, and also using portfolio method. Portfolio method is the other method of binomial model that we did not learn yet. Time being, first risk neutral model we will finish it off. Question number 13. Zero. How many months maturity? 3 months. Huh? What's the spot price of the share? 100. It can go up to 115 or it can fall down to 90. So 115 is a high price given to you and 90 is a low price given. And we are having a call option. E call option ka strike price is how much? 100 only. A coincidental. It need not be 100. It can be. It need not match with spot price and all. It can be more or less also. That's not the problem. Okay. So that's purely coincidental. Now, first and foremost, work out probability of high price, which is formula is what? SP into 1 plus PIR minus low price by high price minus low price. So here spot price is 100. Interest rate is given as 0.20%. Adi per annum, sir. You have to do only for 3 months. Minus 90 by 120 minus 90. Okay, 115 correct. I'm still in my old example. Okay, no problem. Probability of high price is equal to exactly 0.6. Therefore, probability of low price is equal to 1 minus 0.6, which is equal to 0.40. Now, first calculation probabilities are ready. Now that probabilities are ready, next you have to work out payoffs. Now, payoff at high price. I have a right to buy the share at 100. Market price is 115. So I'll exercise the option, not exercise. Exercise call option will be exercised at higher prices. So definitely I will get payoff. 115 minus 100. How much is that? 15. And payoff at low price will be 0 because call is lapsed. That means you are having two payoffs and you are also having two probabilities. Now that you are having probabilities and payoffs, work out expected payoff. Expected payoff is equal to 15 into 0.60 plus 0 into 0.40, which is equal to 9. Now that you have expected payoff, expected payoff will be standing at what time? Maturity date it is standing. Premium when you have to pay? Today you have to pay. So value of your call option is equal to expected payoff divided by 1 plus PIR. It will be 9 divided by 1 plus 0.20 into 3 by 12. 8.5. That's it, over. Sorted. This is the most easiest valuation model among everything. Forget about the first model, the waste model, sir. A normal direct method is just given to you so that you will understand the whole picture. Forgetting that, among the last 4 models, this is the most easiest one. Here, now in this, what extra twist they can keep is, instead of normal compounding, they will ask continuous compounding. If they ask continuous compounding, wherever 1 plus PIR is there, you will replace that with e power RT. So that is, you can check out the next question immediately, sir. Same question, similar data, spot price given, high price, low price given, strike price given, risk-free rate given, and he gave e power value. The moment he gives you e power value, you must understand that he is expecting you to do continuous compounding. So same formula, wherever 1 plus PIR is there, replace that with e power RT. See here the formula, e power RT. Rest all same to same. Finally, also discounting time also e power RT tone you have to discount. All similar models, sir. Okay, now in this, there is something called as a 2-period binomial model. This has something to be discussed. Okay, let's come to Question number 19, please. Sir, what is a two-period binomial model? Roughly listen here. Presently in the sum, what we have seen is, you are standing here. This is the maturity date. The underlying asset, which is a share can take two prices, one high and one low. And at these high price and low price, you are working out payoff. You are working out payoff here. You are working out payoff here. You are also working out probability. Then you are multiplying them. Then you are getting the expected payoff. Your expected payoff is now standing at maturity date. The expected payoff, you are now discounting it to today and you are calling it as value of option. That is what we have done. This is called as a single period binomial model. In this, there is another version which is called as a two-period binomial model. In a two-period binomial model, we are not going to do anything differently, sir. Only thing is, here how much period is there? One period will break it into two halves. So if it is a 1 year maturity option, you will have now two periods in it. Once first 6 months, last 6 months. Sir, how is it going to help you? It is going to help me in predict my prices more accurately. If you could take more prices, more better accurate valuation will come. So accordingly, my chart will look something like in these sorts. Suppose this today. This is my maturity. Option can be exercised here only. So let's say this is 12 months. This I will break it into two halves first. 6 months, next 6 months. Now, if the spot price today is 100, then first I will predict what can happen at 6 months time. At 6 months time, it can become 110 or it can become 90, let's say. That's my prediction. If at all it becomes 110 by the end of 6 months, then by 12 months, it can become either 140 or it can fall down to 105. If it is 90 here, then at 12 months time, it can become to 105. You can take any number, some randomly writing some numbers, or it can fall down to 70. Now, normal single period binomial will look like this. This is a two period binomial. Sir, binomial means only two prices should be there. No, you brought three high prices and three low prices. Binomial means there are two outcomes. So here you see, this is one high price, this is one low price. High price, low price. Based on this, one high price, one low price. Everywhere two outcomes are there. That is called as binomial model. So here also same thing, sir. So in this question, what are we gonna do is, we will still work out payoffs here. Payoffs ki probability also will work out. Payoff first I will discount it to here. This payoff also I will discount it to here. Then I will work out the value of the option here. This entire thing again I will discount it here. So instead of coming back in a single go, you will come back in two steps. From here to here, here to here. Number again you have to bring it here. So instead of coming back directly from 12 months to today, 12 months to will come to 6 months. From 6 months again you will come back to today, because there are multiple events. Every probability you have to factor into your valuation. That's all is the objective. Now this, if you see any solution, even the solution after you yourself solved also, it look very crazy and complicated. But while solving, you will understand that it's very fun. There is nothing in that. It's very simple case. So let's come to a question. Take up 19th one, sir. Or else we'll do a better question. Wait a moment. This is good only, but this is put option. I don't want to do put in the starting. Let me check if I have. This fellow is also nice. Okay, fine. Let's do put option only. Later on we'll come to call. Come to 20th one. Equity share of ABC Limited is currently selling at 100. Oh, this is who? Oh, correct only. Currently selling at 100 is spot price. Strike price is 101. Risk-free rate is given to you. Over 3-month period, it's expected to go up 10% or go down by 10%. Going up, going down by 10%. Over the next 3-month period, another 3 months period, it's expected to go up by 8% or go down by 6%. Instead of giving you high price, low price, that fellow is telling upward movement and downward movement. When upward movement, downward movement is given, we have second formula for probability of high price. That is easy for us to use. He's asking, find the value of 6 months European put option. Also calculate the value of 6 months American put option. Now, what is European put option? Is normal options or whatever we are studying. Option can be exercised when only on the maturity date. That kind of options are called as European options, the normal options. In India, you will not have American option. American option means if maturity date is 3 months, you can exercise the option tomorrow also, day after tomorrow also, at 1 month also, at 2 months also, up to 3 months. Any time you can exercise on or before maturity date. That is American option. European option is something which can be exercised only on the maturity date. Flexibility is not there in European option. American option has flexibility. The name is coming from the lifestyle. American lifestyle versus European lifestyle. European lifestyle fixed, rigid, rule based. American life casual, more flexible, more optional. So more flexible American option, less flexible European option. In India, the options which are traded in the market, we do not have American options. We only have European options. But the thing is, exam fellow, he will not make such a difference. All these questions they copied from John C. Hull book, which is derivatives, original master book. In that, both will be covered. These people also will copy as it is and ask off in the exam. So just because India law not there, e question cannot come. Don't have such feelings. Okay, now coming to question number 20. First and foremost, you have to work out a price chart. This only we are also calling it as binomial tree for share prices. What is the maturity period given? 6 months. That fellow will not directly tell you, sir. Lastly, he told, but as you read the question, first 3 months, next 3 months. So, what's the spot price of the share given? 100. You start with 100. Then he says this will go up by 10% or go down by 10%. Again, it can go up, go down. Here also it can go up, go down. Right? Okay. So, tell me, sir, plus 10% minus 10%. So, it will be 110, 90. Here plus 8% minus 6%. How much is this? 180 now? 0.8. This is 103.40. Here also plus 8%. 97.2 minus 6%. 84.6. You understand till here? This is just share prices, sir. Instead of giving prices directly, that fellow told you percentage movements, so we worked out. Now, first and foremost job, let it be any sum, you have to work out probability. So, for first 3 months data, probability of high price is equal to R minus D by U minus D. Sir, I'll apply SP into 1 plus, you do 100% same answer will come. Sir, this formula itself is derived from that. No, why will you get different answer? Same answer only you'll get. But it's easy to apply. You will see now. 1 plus, what is the interest rate given risk free rate? 12% per annum. So 1 plus 0.12 into 3 by 12. Careful PIR. Minus 1 minus downward decrease 10%. By 1 plus upward movement also 10%. 1 minus downward movement. 1.03, 90, 13. Here down under 20, 65. Probability of high price is 0.65. Therefore, probability of low price is equal to 1 minus 0.65, which is equal to 0.35. So, the first 3 months ka probability, sir. Now, next 3 months. See how many high prices are there for me? 1, 2, 3 high prices are there. So I have to work out 3 probabilities. I worked out now only for the first 3 months. Second 3 months will also have to work out. Now for second 3 months, probability of high price, formula same only, sir. 1 plus 0.12 into 3 by 12 minus 1 minus 0.06 divided by 1 plus 0.08 minus 1 minus 0.06. How much is the answer, sir? 64. 29 now, leave it 0.64. Okay, therefore, probability of low price is 1 minus 0.64, which is equal to 0.36. Now, coincidentally, the percentage fluctuation here and here is same. Since the percentage fluctuation here and there is same, even if I work out again for this also, answer will be same. I need not again work out probability of hyper is here and here separately. Normally you have to work out actually, but the thing is, the percentage movements are same, period also is same. So even if I again substitute, I'll again have the same numbers, answer will be same. That is the reason E method is easy here. If you take SP into 1 plus PIR, SP will not be, starting point will not be same, no. So again you will work out unnecessarily. You can skip now. That's the whole advantage. Right. Now let me put some names for them. This is node A, B, C, D, E, F and G. Right. Now next one more tree you have to draw. This time this is called as binomial tree for payoffs and option value. Compared to earlier, we are slightly in a better position now because we know the probabilities of each occurrence. So this is at 0, this is at 3 months, this is at 6 months. Node names are A, B, C, D, E, F and G. Probabilities are 0.65, 0.35, 0.64, 0.36, 0.64 and 0.36. Now, ours is call option or put option, sir? Put option. That too, for the first case, it is a European put option. European means you can exercise the option only on the maturity date, not before that. Okay, now one by one payoffs you have to calculate, sir. Payoff at node ABCD, node D. Node D is this one. Node D, the price is how much, sir? 118.8. Our strike price in the question is given as, very stupid strike price here. Here 101. Put option meaning I have a right to sell at 101, but market low price is 118.8. Will it exercise a lapse? Lapse. Put option knows are high prices it will be lapsed, low prices it will be exercised. So payoff at node D is 0 because option is lapsed. Next, node E will be 0. Here also option will be lapsed. Why, sir? Node E the price is 103.4. Option will be lapsed. But when you come to node F and node G, option will be exercised. So payoff at node F is equal to X minus spot price. What is X? 101 minus 97.22, 0.813.80. And G, X minus spot price here also, which will be 101 minus 84.6, 16.4. As a result, now I have these numbers 0, 0, 3.8 and 16.4. Now your job is extremely simple, sir. E numbers, you have to bring it here, but you cannot directly jump off here. So you tell me, or else wait. With these two payoffs and these two probabilities, are we in a position to work out expected payoff? Of course, that will be 0, but we can work out no. That number you work out and slowly discount this to here. Similarly, you will work out expected payoff for F and G nodes and bring that number slowly into C. Once you get that, then B, C ka value again I will bring it to A. Now, value at node B is equal to expected payoff at nodes D and E divided by 1 plus PIR. But unfortunately what happened is The entire thing is 0. Sir, why is this 0? Sir, put options are high prices, it will not be exercised. That is the reason it is 0. It will be 0. So, E number is ready with me. E number is 0. Next. If you want to work out value at node C, then you have to consider expected payoffs at nodes F and G and discount it back by 3 months because C is 3 months far. So it will be 3.8 into what is the probability we identified? 64 and 16.4 into 0.36 discounted by 3 by 12. 8.09 also we record here. Now observe carefully. What are we doing? E-payoffs we discounted here. Once you discount a payoff, no sir, it is no more called as payoff. It is called as option value. As long as you don't discount only, it is called as what? Payoff. The moment you discount the payoff, it is not payoff anymore. It is option value. What this means is the worth of this put option at the 3 months time is 0 with a 65% chance, or it is 8.09 with a 35% chance. If I do expected value here, what will I get? I will get expected value of option at 3 months time. I want as on today. So what should I do? The expected value of the option will work out now, and this again I will drag it back into this. Sir, exam diagram is not mandatory and all. A diagram is drawn so that you will know the process of computing easy. It makes your life simple. You will correctly discount correct values, correct probabilities. A diagram, there is no marks. A diagram is for your own working note. Your entire thing is in these calculations. So, final answer now. Value of option ultimately at node A is equal to. Now I am not using the word expected payoff. I will use the word expected value of the option. Of course, nobody cares much about grammar, but as such that is true. Expected value of option at node B and C divided by 1 plus PIR. So in our example, it is either 0 with a 65% chance or not right, huh? Correct only, no? 8.09 with a 35% chance divided by 1 plus 0.12 into 3 by 12. 2.7. Okay. That is that. This is your value of your put option. You understand the structure how we are doing, sir. If you look back, it will all look very crazy stuff, but there is nothing that much as it looks. It's not that bad as it appears. Relatively simple only. It just looks like that, unfortunately. The number again, you will drag it back into this. 2 pointers. That's all, sir. Clear in this? Now, what is the meaning of European put option once again? The option can be exercised only on the maturity date. Now, if I tell you, I want the valuation of American put option. If I want the valuation of an American put option ki European ki what is the difference? European put option can be exercised only on the maturity date. American option can be exercised even before the maturity date, correct? Now here in our example you talk. European option you can exercise only here. But American option you can exercise before this also. Before this, if you have to exercise, first of all, prices should be available with you. Since it's a binomial model, you will have prices only at 6 months time and at 3 months time. So even though in reality American option means any time you can exercise, but for the purpose of this model, you can exercise either at 6 months time or you can exercise only at 3 months time because you have only prices at 6 months and 3 months. Clear, sir? So now you have to evaluate that opportunity also. That is the second question, sir. He is asking, what will you do if it is an American put option? Sir, if it is an American put option, my last chart will change. My share price tree, probabilities, these things will not change. These things will remain literally same. Whatever we computed here along with the probabilities as it is will hold good now also. In that there is no change. So this is your binomial tree for share prices. Probability of high price, low price is same as earlier. Now directly we can go to our next tree. Who is our next tree? Binomial tree for payoffs and option value. Easy only, just little bit, one step extra. So if this is your node A, this is your node B, node C, node D, E, F and G. Probabilities are 65, 35, 64, 36. This time just remember that we are talking about a American put. American put comes with a small flexibility that the option can be exercised either at 6 months time or at 3 months time in our example. So this is 0, this is 3 months, this is 6 months. Now payoff at node D 0, payoff at node E 0. Why 0? At D and E, put option, we have a right to sell at 101. Market price is 118 and 103.4. In that cases, put will be lapsed, just like previous discussion. But node F and node G, definitely option will be exercised. Node F, 101 minus 97.2, which is equal to, sorry, correct only, no? 3 point. Node G, 101 minus 84.6. How much is the answer? 16.4. So, E numbers are same like previous case, sir. 0, 0, 3.8 and 16.4. Now, here extra thing is you can exercise the option even here also if you want. You need not check payoffs only here. You can check payoffs at 3 months time also. That means value at node B is equal to some number. There are two ways of doing this. Number one, evaluate exercising the option at node B. Payoff at node B. Why 0? Because at node B, market share price is how much? 110. But I have a right to sell at 101. When market share price is 110, I have a right to sell at 101. Will exercise the put. Put will be lapsed. So here put is lapsed 0. So the option is not exercisable at 3 months time. Impossible. So you have to exercise the option at 6 months time. But at 6 months time, if I exercise, I will get payoffs. How much? 0, 0. So discounted value you have to take. So that will also be equal to 0, or it is expected payoff at nodes, we see, D and E, discounted value by 1 plus PAR. This already we computed, it is 0. Sir, understand this. If you are taking this number, which is 0 here, doesn't matter, but some number if it is there, if you are taking this, that means you are saying that you are exercising the option at 3 months time. If you are taking this number, you are saying that you are exercising the option at 6 months time. Both you cannot do, no. You can do only one. Either exercise at 3 months or exercise at 6 months. You cannot do both. Every day you should not go and exercise, no sir. Only once you have to exercise, either now or later. Now, which one should I do? Whatever is convenient for you, whichever is beneficial for you, therefore you have to select whichever is higher. In this case, coincidentally both are zeros only, so higher number also is 0. Here it is 0. But since it's a put option, you will have significance when you come to the C node. Now look at this. So value at node C is higher of number 1. Evaluate exercising option at C. What's the market price? 90. I have a right to sell 101. Definitely option is exercisable. So X minus spot price 101 minus 90, which is equal to 11. Either this or don't exercise at 3 months, directly exercise at 6 months. If you exercise at 6 months, expected payoff will be standing at 6 months time. Expected payoff at nodes F and G. You have to discount it back by 3 months. Otherwise, they are not comparable. So that will be 3.8 up. Okay, F and G correct. 3.8 into 0.64 plus 16.4 into 0.36 divided by 1 plus 0.12 into 3 by 12. That already we computed earlier also. 8.09. Between these two, whichever is higher, whatever is beneficial, you should do that always, which is how much? 11. 11 will go and sit here. What is the difference between this one and the previous one is, in the previous one, you did not have a choice. You had to compulsorily exercise the option only at 6 months time. So what you did, you computed payoffs here only. Here you never computed payoffs. So whatever payoffs you computed here, that you silently discounted it back here. But here, sir, I can exercise the option here also, or I can exercise the option here also. And I will do whatever is beneficial for me. If exercising here is beneficial, then I will write 11 rupees directly. I will not discount these numbers here. But if, for example, if payoff is not 11, if payoff is some 7 rupees or something, then what is beneficial for me? Exercising at 6 months time is beneficial. In that case, I will not write 7 here. I will be writing 8.09 here. So you cannot exercise at both the times. Whatever is beneficial, you will do that. So whichever is beneficial, you have to calculate. Previous case, a drama is not there because of flexibility is not there for you. You have to compulsory exercise only on the maturity date. Here you have a flexibility. Flexibility, any person with reasonable mind will do whatever is beneficial. So considering that, you evaluate the option. Now finally, what it means is the worth of this option is 0 with 65% chance, is 11 rupees with 35% chance standing at 3 months time. I want to come today. So, which means value at node A is equal to 0 into 0.65 plus 11 into 0.35 divided by 1 plus 0.12 into 3 by 12. 3.75 rupees you are having. This is the value of put option when it is an American option. Earlier answer also is correct. That was with European option. Now, if I change the drama, I'll tell you that this is not put option, this is call option. How are things going to change for you? Tell me. Concept wise, it's same. Where things are going to change is, now that we are saying that it is a call option, options will get exercised here and here options will be lapsed. The story of coming back is same. Whichever is higher, story is same. The manner of computing payoff will change. That's all. Rest all ditto same. So whether you do it for call or put, there is no extra effect. Only thing that will change is the manner in which you compute payoff will change, and the prices at which the option will get exercised, that will be different. Call option, high price rate will be exercised and it will lapse at low prices. Put, high prices low lapsed, here it is getting exercised. That's how numbers will change, but concept is only this much, sir. You just have to work out payoffs, multiply with probabilities, compute expected payoff, bring it back. Single period when we do, sir, life looks very simple like this. Answer is so cute. But when you take a 2-period binomial model, the answer will become heavy. You will draw 2 price charts. You will work out probabilities 3 times. In fact, we worked out only 1 time because probabilities are same. But as such, if the probabilities are different, you have to work out 3 times probabilities. And then slowly you have to cook back the entire thing. Okay, one more we will do on this 2-period and then we'll close up. Okay, 20 is done. Do this one, question number 19. Look at this. The following is a 2-period tree for a share of stock in Cap Limited. Spot price given. S1 price can go to 33. Price can fall down to 27. That means a 10% upward and 10% downward movement. Again, by second period ending, 33 can become 36.3. That is again a 10% upward movement, or it can become 29.7 downward movement out of 10%. So, these some advantages, sir. Everywhere upward downward movements are 10%, 10%, 10%, 10%. Every case you see. That is very advantageous for us. How? If you calculate probability of high price once, that is sufficient. Here in this sum, at least 2 times you calculated. In this question, current question, 1 time if you calculate first period, second period, for all the nodes, same probabilities will work. So that is advantages only. No. Next, using binomial model, calculate the current fair value of a regular call option. Please write there. Regular call option means European call. American call is not regular call option. European call option is called as regular call option. Well, strike price is 28 rupees. Risk-free rate, look at this language, 5% per sub-period. It's not per annum and all. Now, is samla sir, that fellow's overaction you see, e period is how many months? No, he did not tell you. E entire maturity period, he did not tell you. What will you do with maturity period? That is relevant only for discounting. No, a discounting rate he gave 5% per period, directly PIR, that is not per annum and all. He can't give you per annum because you don't know this period. Directly, whatever period is there, period ke they have given. Now, that is that. Now, with the help of this, sir, already question this fellow has given you what? Price chart. Binomial tree for share prices are already given in the question. Never use that. Sir, he is doing favor. No, sir. In that, lot of drama is there. Observe. E27 can go up to where? 29.7. This 33 can also fall down to 29.7. That is a separate node. This is a separate node. Since the number is same, this fellow joined 2 nodes. You observe here, I should have A, B, C, D, E, F and G. E and F ka number is same. Therefore, that fellow created a single dabba for that. That's not how we do valuation of options, so sir. We have to compute on our own again. The trap, sir. He giving you binomial tree is a trap. Don't think he's doing any favor or helping you and all. Nobody will help you. So, careful. You have to work out all this again. Okay, and now that you worked out, you first work out probability of high price, R minus D by U minus D. You got some number. This time this fellow got 75 and 25. Good news is everywhere upward downward movements are same. Therefore, my probability of high price, probability of low price also will be same everywhere. So now you tell me, don't turn the page. What's the strike price given? 28. Now here only you tell me payoffs. I have a right to buy a 28 call option. Market low price is 36.3. Size. How much payoff? 8.3. Here 1.7 because I have a right to buy 28. Market low price is 29.7. Here also 1.7. Here it is 0. Collapsed. Now probabilities are 0.75, 0.25. Now you marry these 4 numbers. I mean individually. 8.3 into 0.75 and 1.70 into 0.25. Total it up. 6 point. What you are having is expected payoff. That number you discount it, divide by 1.05 the discount answer. Divide by 1.05. 6.33. So 6.33 is the value of the option at first sub period ending. Now come to the other part. Here Here also same probabilities, 0.75, 0.25. 1.7 into 0.75. That you discount it back because at 0 into 0.25 don't even do waste, no. 1.2. So again here also probabilities are same only, no. What it means is the option value can be either 6.33 or 1.21 with a chance of 75 and 25. Multiply. You will get value of the option at first half. That again if you discount it back by 5%, 809 something. This should be your answer. Are you getting? Everything is there in the diagram, sir. Don't, I mean to say, a diagram will tell you the route of coming back, but calculations very simple. Normal payoffs, payoff into probability, expected payoff, discounted, ultimately come to today. That's it. What you did so quickly on calculator, that is worth 7 marks. Are you getting it, sir? Let it be single period, 2-period binomial model. There's nothing to be scared. Just draw the diagram and watch the fun. Everything, just roll it back to today. That's all, guys. With this, we are done with binomial model. Risk neutral method is over for us. Okay, next. The next one is called as riskless hedge approach, or also called as portfolio replicating model. Okay. Now, sir, a model ka story altogether different. It's in fact in a way very lengthy compared to the previous method, but is easy to understand. Of course, previous one also is easy. This is also easy, but this is lengthy. Now here, understand this. Now let's take some random numbers and then we'll talk. 0, 3 months maturity date. Spot price of the share today is 100. And this share price can go to either 115 high price or it can fall down to 90 low price. Call option I'm having today. Strike price also I'm taking it as 100. Now, if it is risk neutral method, I will go and work out probabilities and stuff now. E method there is no such drama. E method altogether different version. What this fellow says is, assume that there is an investor. Investor writes a call option. This time you are not holder of call option, you are a writer of call option. Tell me, sir, if you are a writer of call option, with what anticipation did you write the call option? The call option means you are having an obligation to sell, that's okay. But what is your intention? Share price will rise or fall? Pakka? Why? If share price falls, call will be lapsed by the holder. Whatever premium I received, that will become my profit. That is my intention. So prima facie my intention is what? Bearish view. Share price will fall. But share price will definitely fall. Then I'm feeling. That is feeling only. So in this feeling, risk is there or not there? What is that risk? Share price may rise. If share price rises, you will definitely suffer a loss. Correct? So what this fellow does is, to hedge himself, he takes one more action in cash market. Buy share. That means what he is doing is, he is not just a writer of call option, he is also buyer of shares also. Cash market share he purchased, options market call option he wrote. Now what will happen? Think. If the share price increases, then holder will exercise the call option. I have to give him payoff. I am sad in my options position. But share price increase will no. Because of that, my share ka value which I purchased, a share ka value also will increase. So whatever I lost here, I will recover there. So I am basically trying to create a hedging position for me. Do you understand till here? Once again, I am telling, sir, assume that you are a writer of call option. If you are a writer of call option, you have a risk that share price might rise. If share price rises, then the call option definitely will suffer a loss. So to protect yourself, what you have done, you purchased some shares. So you are in two markets now. One, you are there in cash market where you buy and sell shares. There you bought shares now, and you are also there in options market. Your entire goal is you create these two positions in such a way that you create a risk-free portfolio. That is your goal, sir. Your goal is to create a risk-free portfolio. Now, let's see. Value of the portfolio today. You have to identify first. Now, assume premium received oblique, you can also call it as value of call is equal to C. It's looking like D. Okay, C. Next. And assume that you are buying number of shares bought is equal to X number of shares you purchased, and on the option whatever you wrote in that you are receiving a premium of C. Sir, premium don't you know, sir? Array sir, if only I know that, why am I doing valuation of option? My goal is to calculate that premium only. No, do not forget. Our goal is to compute that premium only. If that only I know, why will I compute? Okay, now tell me, sir, what is the price of one share today? 100. You are buying how many shares? X shares. So what is the cost of investment? 100x. But there is one inflow also for you. What is that inflow? Premium. So your value of the portfolio today is equal to 100x minus C, not plus C. 100x is not inflow or the outflow. I have to buy shares. So 100 into x, that much money will go, but I collected some premium. Therefore, net basis, this is my investment today. This I am calling it as equation 1. Later on, we'll use it. Now, at 3 months time, if spot price is equal to 115, if spot price is equal to 90, one is high price, one is low price. Now, since you wrote a call option, you might have to give a payoff payable in call option whose exercise price is equal to 100. Tell me, sir, when market low price is 115, holder of call option, we are not holder, some other fellow is a holder, that fellow will exercise the call or not? He has a right to buy the share at 100. Market low price is 115. He will definitely exercise. How much is the payoff? 15 rupees. For us, the payoff is a outflow. Why payoff is an outflow? We are a writer. And in this case, that fellow will lapse it. And whatever shares you purchased, sell it off. So value of shares. What is the worth of the shares? X shares you purchased. Today market price is how much? 115. So you will get how much? 115x. And here 90x. Because X shares into 90 rupees. So work out the value of the portfolio. 115x minus 15, and this is 90x. What did you say? Your portfolio should be a risk-free portfolio. Risk-free portfolio ka meaning is there is no uncertainty. That means whether the high price happens or whether the low price prevails, your value should be same. Your portfolio ka value should not change depending on some uncertain number in the market. Market, let it be 115, let it be 90. Your portfolio ka value should be same. So if portfolio is a or is to be a risk-free portfolio, then both the numbers should be same. 115x minus 15 is equal to 90x. Therefore, okay, wait a moment. 115x minus 90x is equal to 15. Therefore, x is equal to 15 divided by 115 minus 90. X is equal to 0.6. By the way, what was X for us? Number of shares to be bought is X for us. Okay. Now the question arises, sir, how will I buy 0.6 shares? 0.6 shares you cannot buy now. So what will I do? What is the intention of that is? Tell me, sir, first of all, call option you can buy and sell on one share. Underlying? No, there is something called as lot size. What it means is, if call option you write on one share, background you have to buy 0.6 shares in order to create a perfect risk-free portfolio. But if call option you are writing on 10 shares, background you have to buy 6 shares. Call option you are writing on 100 shares, 60 shares you have to buy. That's the intention of that. So they will ask you in the exam, interpret this point. So how to interpret this is, for 10 shares written in call option, we have to buy. I have a better interpretation, but I can't write that in the exam. We have to buy 6 shares to create a risk-free portfolio. That is the meaning of that. Okay, now. So value of portfolio today you computed, value of portfolio at 3 months time you equated and found out. Now, value of portfolio at 3 months time. So just now only computed. Now I want value at, sorry, if spot price is equal to 115, if spot price is equal to 90. So payoff payable, here 15 outflow, here nothing. Here value of shares is 0.6 into 115. Please do this. 69 now. And here it is 0.6 into 90. 54. If you see now, you are having 54 here also, 54 here also. This is your value of portfolio at 3 months time. They both are same. They will ask you to prove that whatever portfolio you created is a risk-free portfolio. There is nothing to be surprised or happy here. You only equated them. No, why will they not match? You only equated that to become equal. How much is X? We only calculated. If I substitute X again, they won't match. They will match a number I want, and a stupid question they will ask you, prove that this portfolio is a risk-free portfolio. Such a stupid question. Sir, we first equated only and got X. No, if I substitute X back, won't it be equal? Obviously, it will be bloody equal. For that, marks are given. So that's the reason I'm doing. If only my goal is to get the value of portfolio, if 0.6 I'll go and directly substitute in this. 90 into 0.6 is 54 only, no? Directly I'll substitute. Why do the whole thing? Because they're asking in the exam. That's the reason. Anyway, finally, last portion of this is value of portfolio today. Now what you proved with all this effort is, you are standing now at 3 months time, portfolio value, let it be high price, let it be low price, your portfolio value will be 54. The number is not going to change. Now that this number is not going to change, your portfolio is a risk-free portfolio. Now that your portfolio is a risk-free portfolio, I get a right to discount this with what? Risk-free rate of 20% per annum. So, as on today value, I will get. Therefore, value of portfolio today is equal to 54 divided by 1 plus 0.20 into 3 by 12. 51.43. Now, from equation 1, value of portfolio today, firstly you computed, see, this one, 100x minus C. Therefore, 100x minus C is 51.43. X value already we worked out. Minus C is equal to 51.43. Therefore, C is equal to 60 minus 51.43. C is equal to 8.57. This is the value of call premium or call option. This much lengthy effort is there. But earlier method was very straightforward. But there, what was dummy? Probabilities were dummy. Probabilities are not real probability. In this, what is dummy? Entire model a fake. If first step onwards, total fake. Sir, when I write an option, don't I know how much premium am I getting? Normally, if I really write an option, don't I know how much premium I will get? I know. And if I know that share price will fall down later on, why the hell will I, if share price will rise later on, why the hell will I write an option? Actually, portfolio non-existent. The portfolio is not there in reality. No stupid will construct that portfolio. We simply constructed that on paper. In reality, portfolio nobody is creating. Sir, sir, why will I create a risk-free portfolio by doing options, sir? I will invest in bank deposit. No. If I want risk-free return, why will I go to option market, write one option, again buy one share and create risk-free portfolio? Mad or what? No idiot will do this. On paper I am doing. Now when it is a dummy portfolio, he asking you to interpret this is a joke. X is equal to interpret number of shares is asking. How stupid question, sir? Actually, portfolio not there, no. So it's a dream portfolio, 0.6, 0.55, whatever I want I will buy. So for this 1 year interpretation, it has marks. Exam people, sir, once long back, some fellow created this question. Again, changing numbers, asking the same question. Repeat. Last 1 year also question came. Last couple of exams. Same question. Just they'll ask interpretation, neatly write interpretation. Either different people teach in different ways, sir. But whatever I taught you is a original way. That means in this entire logic is visible to you. Not by heart anything. Naturally things will fall in a flow. What this actually means is, the portfolio value is 54 rupees at 3 months time, and it's not going to change whether it is high price or low price. That means the portfolio is a risk-free portfolio. From risk-free portfolio, what return will you expect? Risk-free return. What that means is, for creating this portfolio today, anybody should not invest anything more than 51.43. Beyond this, you should not invest. But today you are buying how many shares? 0.6 shares. What is the value of each share today? 100. So if you have to buy 0.6 shares, what is the cost of investment? 60 rupees. 60 rupees is the cost of investment, but you are not supposed to invest more than 51.43. How much extra did you invest? 8.57. Whatever you extra invested, that money you collect in the form of call premium. That's the whole logic of this. Are you getting it, sir? In this, X number is there, no? 0.6. X is also called as option delta. And option delta ka formula is change in payoff divided by change in prices. If you observe there, I wantedly presented it like that so that our formula is visible to you. Change in payoff means, observe, sir, at high price call is excised, 115 payoff. Low price call is lapsed, payoff is 0. So this is nothing but indirectly 15 minus 0 divided by change in the prices, which is 115 minus 90. This is option delta ka formula. Option delta gives you relation between option value and share price ka fluctuation. If share price is danced by 25 rupees in the denominator, option value is dancing by 15 rupees. So link between value of the share and value of the option, that is called as option delta. Your number of shares to be purchased should match with option delta. So instead of telling you that option delta ka story, I normally mathematically explained it. Now background I am telling you, this is one formula. Some people directly remember option delta formula for identifying number of shares. That is also 100% correct. Happily you will get the same answer. Only thing is, if I tell you formulas and all, no sir, if flow will be disturbed. So we normally started with what? There is a share which can take a high price, low price. Today I am writing a call option on a share. And this option portfolio, whatever I am creating, that should be risk-free portfolio. So it has to be risk-free. Only option if you hold, adi risky. So background lo buy one share, buy some shares also. E shares plus e option return, both put together should be capable of creating a riskless portfolio. Number of shares bought, don't know. How much premium you have collected, that only you have to calculate. That also we do not know. One you assume it as X, one you assume it as C, and therefore work out the value of the portfolio today. And thereafter make it equal portfolio, risk-free portfolio. So work out the portfolio at 3 months time and join them. Automatically X will come out. Now that X is there, if you resubstitute in that, you will get the value of the portfolio. Now that the value of the portfolio is same at 3 months time, irrespective of whether it is high price or low price, it's a risk-free portfolio. Now that it's a risk-free portfolio, you can discount it with what rate? Risk-free rate. When you discount it with risk-free rate, you will understand that the value of investment today should not exceed 51.43. If 51.43, go and equate it to your equation number 1, and X you already know. Now C will come out. That's all, game over. This just now, today's first question, question number 13, we solved it in risk neutral method. Same question, 100, 115, 90. What did we do? Probability for high price, probability for low price. Two dummy probabilities I worked out. Two payoffs multiplied with dummy probability, dummy payoff discount with risk-free rate. You got 8.57. Same question. Now again we have done this under this model, which is riskless hedge approach. This is lengthy. Answer will not change. Answer will be same. Are you getting it? So 13th question, whatever example we have taken in the question number 13, basically. If I call it as question before only, you will look at it with pressure. Example, the pressure will not be there. So I call it as example. That's all, sir. Riskless hedge approach, only that much. But one more question we have to do because it's too important. One more. Where are you? No. Okay. 17th, you can try. 18th one, sir. You can ignore this. The question wrong, sir. Leave it. Exam also printed like that. Means question is correct only. Answer wrong. Suggested answer, wrong answer they printed. I copied that only. Leave it. I'll show you a better question. Come to 17th one. This is source question, sir. 14 years back came CA final. A question with different names they changed, numbers they changed, multiple times repeated. CA also, CMA also. It's source question. Do this one. The equity shares of Endalco Limited are currently selling at a price of 500 each, spot price. The investor is interested in purchasing the shares of Endalco Limited. The investor expects that there is a 80% chance that price will go up to 650 or 20% chance that it will go down to 450 3 months from now. One high price, one low price is given. Next. There is a call option on the shares of Endalco Limited that can be exercised only at the end of 3 months at a strike price of 550. Risk-free rate is given. Now look at this, sir. Question ka language you have to check. If the investor wants a perfect hedge, what combination of share and option should he select? That is, what is he asking indirectly? Just now we have done some no perfect hedge only. No, we did a perfect hedge. If you want, how many shares you have to buy? And he is asking indirectly, is asking option delta. Ix, if you work out, answer is over for you. That also should give you a hint that this sum you have to solve using riskless hedge approach, using portfolio replicating model. Do not go and apply risk neutral model. If you do that, final answer will be same, but marks will strike off. You will not get 1 rupee also for that. Don't do risk neutral method because that is easy, or looking at a trap that question la probabilities are there. So probabilities are there, I'll apply risk neutral model. Avi real probability. Risk neutral model ki no fool will give you probability in the question. If probability also he only gives, what will you do there? Risk neutral method la probability you have to compute. Question will not come and give you. Don't look at that probability and fall in the trap. This is not risk neutral method. Riskless hedge approach. E heading will not come in the exam, but E word is enough for you to indicate that you should not apply risk neutral method. Probabilities are traps, sir. Don't fall into that. That's given for some other purpose, which we will see later on. Now anyway, quickly tell me, sir, what is the price today? Okay, spot price is 500. High price 650. Low price 450. Maturity period 3 months. 3 months. One high price and low price. Now, call option is available today with a strike of 550. Now, first and foremost thing, you have to create a portfolio of buying X number of shares and writing an option, sir, is also called as selling a call option for premium is equal to C. So therefore, value of portfolio today 550x. Oh, sorry. What is the spot price? 500. I'm sorry, ma. 500x. This is your portfolio value as on today. The equation number 1 for me. Next. At 3 months' time, if spot price becomes 650 or if spot price becomes 450, payoff payable. I'm a writer, do not forget that. And call cost strike price is 550. Holder has a right to buy the share at 550. Market low price is 650. He will definitely exercise. I will have to give him payoff of 100. But in the second scenario, holder will lapse. I need not give him anything. Whatever shares you purchased, assume that you are selling it, or simply you can hold also, no problem. So I'm simply calling it as value of shares. That will be 650x here. Here it will be 450x. So this will become 650x minus 100 is simply 450x. This is value of portfolio at 3 months time. Since you are claiming that you want it to be a risk-free portfolio, equate both of them. So which means 650x minus 100 equals to 450x. Therefore, x is equal to 0.5 or 0.5. He's asking interpretation, no, how many shares you should buy and call option so that you'll create a risk-free portfolio. For that interpretation, you have to write. So to create a risk-free portfolio, we got to buy 5 shares for each for 10 shares written in call option. That is the meaning of it. Or you can also say 1 share for every 2 shares written in call option. Anyway, that doesn't matter. Okay, so this is the first question, sir. Second question, what he's asking, let's see. Explain how the investor will be able to maintain identical position regardless of the share price. That means he's asking you to prove that portfolio value will be same whether high price prevails or low price prevails. Why the hell will it not match? Easily it will match. Same thing only, no? So if spot price is 650, if spot price is 450. In the first scenario, payoff is payable. Here 100. Here it is not payable. Value of shares is equal to 0.5 into spot price. How much is that? 325, huh? And it is 225. Both the cases you are having 225. Therefore, the value of portfolio is same regardless of whether high price or low price is prevailed. A conclusion you have to write. Because he's asking, we are doing. Otherwise, sir, Ix, if you go and substitute in this number or this number, directly 225 will come for us. Because he's asking, we are doing this presentation. Next, as usual, he will ask you value of how much holder should pay for buying this call option today. Holder will pay whatever writer asks. So how much indirectly is asking call option ka premium, what is there? So value of this portfolio today 225 is standing at what time? 3 months time. Equation risk free rate is how much, ma? 0.12 into 3 by 12. 1.03, sir. 4 218.45. Now from equation 1, 500x minus c is equal to 218.45, because that is also value of portfolio today, this is also value of portfolio today. If 500x ka value we know, which is 0.5, call premium collected only you have to calculate, that will be 31.55. Correct only, no? That's all. So this is the amount of premium as a writer you will charge and the holder will pay. Next one. Now he says, what is the expected return on the option to the holder? What he's indirectly saying is, if the holder buys this option today by investing an amount of 31.55, how much is the return he is likely to get? Now you tell me, sir, if you are the holder, today you will invest premium. Future, what will you get? Payoff you will get. Of course, payoff you will get only when the option is exercised. So, holder buys option today at rupees 31.55. In future, if spot price is equal to 650, then payoff he will get, because option is excised, 650 minus 550, payoff is equal to 100. For this event, a question tells that probability is 80%. If spot price is 450, then payoff will be 0 because call is lapsed. For this event, probability is 20%. From this, you will work out expected payoff. 0.8 into 100 plus 0.2 into 0. Who is using calculator for this also? 80 rupees. All calculator sound is coming. 80 rupees. That means if you invest 31.55 today, you are likely to get an inflow of 80 rupees. Therefore, expected return from this is 80 inflow. Already invested 31.55. 31.55. You remember mutual funds formula? Closing value minus initial investment by initial investment into 100, that formula. So if you do that, you'll be getting 153.56%. The answer over sum. Now in this, idhe sum, sir, if you do using risk neutral approach, okay, you should not use this 80-20 there. 80-20, they are not dummy probabilities, of real probabilities. Real probabilities, so risk neutral method will not work. Real probabilities, if you take, you want to give me real required return that you do not know, no. So you can't do that. So just like that, sir, casually tell me, what is probability of high price? Formula SP is 500 into 1 plus 0.12 into 3 by 12 minus low price 450 divided by 650 minus 450. Sort out that. 15, 65, 0.65, Point. This is 0.325. It's so sad. Anyway, this is 1 minus 0.675. You see? Adi high price probability, dummy. 80% real. Real you should not take for risk neutral method. You have to take only dummy probability. Now you see, what is the payoff at high price? 100. And the payoff here at low price is equal to 0. Marry these fellows. That's it. Expected payoff 32.5. Drag it to today. 32.5 divided by 1 plus 0.12 into 3 by 12. You don't have a choice. You have to get that. There's no option. This is risk neutral method. You see, sir, how cutely answer came quickly like that. Riskless hedge approach big, but more popular in the exam because they can ask it for 7-8 marks. So they usually ask this one. If they ask this, life is very simple. Answer will be same. You understand, sir? In this, one more point. You took real probabilities. Is it dummy payoff or real payoff or expected payoff? Is it real? Whereas this is dummy. Real, here also I couldn't estimate. Only thing is I don't know how to discount it back. That's the whole problem. Had I known how to discount it, I will consider real payoff only. But real payoff I cannot consider. For example, somebody tells you that your real expected payoff at 3 months time, just now like how you calculated 80 rupees, this is real, and God comes in front of you and tells you that required return is 153.56%. Now you know real payoff, you know real required return. What will you do? You will discount it. Discount and see. 80 divided by 1 plus 1.5356. You will, so the real payoff, the real required return, then correct answer will come. But the problem is God will not come. Required return, God will not come and tell you. You do not know, sir, but how did you write? Because I computed. How did I compute? After computing 31.55, I computed reverse calculation. I did. Once you get this, what is the purpose of, what is the point of you getting required return now? So that's the reason direct calculations is not possible, sir. That's why dummy payoff. If you have to understand risk neutral method correctly, first in normal method also you have to understand. Then if you club both, then you will have ultimate clarity how binomial model is working. This fellow took real payoffs. Real discounting rate also if you give me, I will be able to work out 31.55. But that real discounting rate is not there. That's why risk neutral method, the dummy probabilities we cooked, which are capable of giving which return? Risk free return. Answer is same, no? It's a proof that the answer is right. That's all. With that, we are done with binomial model. So guys, with that, we are done with our binomial model of option valuation. Next part is theoretical boundaries of option. So in this concept, we are now not trying to fix a value for the option, but we are setting up the minimum and maximum limits. Now, the entire concept of this theoretical boundaries is like this, sir. For example, if you take an option ka value, we will now fix one minimum value. That means call premium, put premium should be at least this much. It cannot fall below this. Similarly, we also fix one maximum value. Option ka real market value can be any number in between this zone, no problem. But if actual market price of the call premium or put premium is above the maximum or below the minimum, in this case arbitrage is possible. So here arbitrage is possible if the market price of the option is above the maximum value or market price of the option is below the minimum value. Here arbitrage is possible, whereas here this is no arbitrage zone. Gain may come, but riskless gain will not come. If you want a risk-free gain without taking any risk, freely gain if you want, then a mispricing should be there. The actual call premium or value of the call option in the market should be more than the maximum or below the minimum. If it is in that range, then you cannot perform any arbitrage. For that purpose only, a concept is there. Otherwise, not a very important discussion, to be honest. Now coming to minimum values. So now when you take a call option, minimum value is spot price of the share minus PV of strike price. This is a formula for minimum value of call option. And for put option, minimum value is PV of strike price minus spot price. Maximum value is the first terms only, which means spot price, here it is PV of strike price. In reality, and also in the questions what you see in various books in the exams and all, never the upper boundary is breached. That's impossible, sir. Reality is highly impossible. In books also, you'll never find any question where upper boundary is breached. But you might find some questions on lower boundary getting breached. That means your minimum value, let's say you told me 8 rupees, the actual call premium is only 5 rupees. That means the option is trading at a lower value than its minimum worth also. In that case, obviously arbitrage is possible. Questions also you will not see on option trading at higher than maximum value because it's highly unrealistic. So now what is the logic of this formula? No big logic, guys. Very simple. Means in a very simple terms, if I should explain. Look at this. This is today, sir. This is your maturity date. Okay. Now, your concept is if you know the future ka payoff, a future payoff, if you discount it to today, that will be your value of the option. But the problem is I do not know the discounting rate. Since this discounting rate is not there, I cannot directly discount the payoff to today. So what we will do, we will directly discount the ingredients of payoff. Tell me how to compute payoff normally. It depends on whether it is a call option or put option. Let's say call option. So how to compute that? Spot price of the share on the maturity date minus the strike price, exercise price. Correct? This minus this will give you payoff. A payoff you discount it to today. Then you will get the option ka value. But I do not know any scientific way of discounting payoff to today. So what we will do, I will discount the ingredients of payoff individually. Spot price ka today's value is what? Today's spot price. Because if this is P1 if you discount it to today, that will be P0. So bare minimum it should be at least equal to today's spot price. If strike price ka present value will be present value of strike price. So spot price minus PV of strike price is your value of call option. That's exactly the formula, no? Spot price minus PV of strike price. If it is put option, what's the payoff formula? Strike price minus spot price. So if you discount it, it will be PV of strike price minus spot price today. So like that. That's how a formula basically can be explained. But actual logic you'll understand when I do arbitrage only. So without learning arbitrage ka stuff, a formula ka derivation is difficult to explain. What I told you is not wrong, but more supportive answer if you want, you have to perform an arbitrage situation to understand why these formulas are looking like that. Now anyway, before it go into a question and do one arbitrage situation for you, just tell me, sir. Now let's once quickly jump into cash market. Cash market is not derivative, sir. The plain buying and selling shares. Now, cash market strategies also you should know. This fellow is having a bullish view, meaning he believes that share price will increase in future. If share price will increase in future is what you feel, tell me, sir, what will you do now? You'll simply see and clap. Huh? No, you have to buy now, sell later. So your strategy will be buy now and sell later. The moment you buy now, this is called as you taking a long position. Sir, later on I am selling, no, that is short position. No, sir. Original position ke name will be given. Once you do the opposite action later on, then you don't have any position at all. No, you have basically squared up and you are exiting out of the market. So if you believe that share price is gonna rise in future, so you have to buy now, hold it, and later on sell it. As long as you're holding it, we call it as you are having which position? Long position in cash market. Later on you sell it. Once you sell it, you should not say I'm having short position. You don't have any position, you sold off basically. So long position cash market. So then there is another fellow. who feels that share price in future will fall. So he is having a bearish view. So if share price is expected to fall, whatever price is prevailing today, are they high price? So your strategy is sell now and you got to buy later. Now, today if you are selling off without actually having it, that is possible only when you do a short sale. This is also called as short position. So short sale, how will you do? It depends, sir. For example, you feel that share price will fall. Now I'll ask you, sir, when will it fall? Will it fall today or much time in future? If you say today, then intraday trade possible. Morning you sell, before close of the market, enter into buy transaction, automatically squaring up will happen in the day only. That is easily possible. But if you tell me that, sir, price today is 1000, it will come down to 700, not now, but after 3 months. In that case, you cannot do intraday trading. So you have to do short sale using stock lending and borrowing scheme. Stock lending and borrowing scheme, what will happen? I borrow a share from somebody, a share I will sell it off today. And I'll wait for 3 months. After 3 months, again, I will buy the share in the market, which is at a lower price according to my feeling. I will buy and I will deliver the share. Along with the share, I have to also repay lending charges. That fellow has given his asset to us, no? So I have to give him what? Lending charges. Not only that, in interval period, if the share has paid any dividend and all, a dividend also I have to pay to him. Correct? So this is cash market position or cash market strategies. Now, why I told you this is, when you have to do arbitrage, sir, you need to know these strategies also. So let's start with one question now on call option. We'll do arbitrage, understand theoretical boundaries, and then quickly we will move on to put call parity. The Black-Scholes will do it in a while. Come to question number 27, please. He has given you strike price 90, current price is 100 rupees, spot price is 100 rupees, strike price is 90 rupees, risk-free rate is 10% per annum. He is asking you work out the theoretical minimum price of European call option expiring at 1 year, minimum value. Then he is asking what is given the actual price, whether arbitrage is possible or not possible. That we'll see first. What's the question number we are doing? 27. In 27, tell me, sir, minimum value of call option is equal to spot price minus PV of strike price. Spot price is 100, strike price is 90 divided by 1 plus 0.10, the 1 year. So that will be 18.18. The minimum value of call option. If the call option is 18.18 or above that, arbitrage is not possible. But if the actual market price is below the minimum boundary, definitely arbitrage is possible. Now, second question you read, that fellow is telling that actual value of call in the market is how much it seems? 15. Second bit you read and see 15. This is lower than the minimum boundary of 18.18. Definitely arbitrage is possible. Definitely arbitrage is possible. Now that arbitrage is possible, you have to execute the steps for arbitrage and ensure that a riskless gain is enjoyed. Now, how to do that? First, you have to frame the strategy, which you are calling it as action for arbitrage. Your entire answer lies in these 2 points, sir. If you write the action for arbitrage correctly, arbitrage steps naturally will happen correctly. There is nothing to worry about it. Okay, now tell me, compared to your 18.18, market price is lower or higher? Lower. That means your call option is underpriced. Do you agree with that? So arbitrage is possible. Call option basically is underpriced. Its worth at least should be 18.18, but actually it is trading only at 15 rupees in the market. So call option is cheaply available. When something is cheaply available, what will you do? Buy. The first answer is buy one call option. There is no rush, sir. Peacefully think. Something is available cheap, so I have to buy. And why am I buying? I told you this, since it is underpriced. And also understand, Buyer of call option means you are who? Good. You are holder of call option. Our clarity also you should have. You are holder of call option. Now, arbitrage ka meaning is riskless profit I should get. Now, if you buy a call option, hold like that, and in future if the share price falls, option will be lapsed. If option is lapsed, whatever premium I paid, that's a loss for me. That's called as arbitrage. No, in that risk is there. So first understand what is the risk you have. Call option holder ki risk is market price of the share may fall. That is the risk you have. E risk ki now you have to give a counter action in cash market. Now, if this falls, definitely this will give you a loss. But when this falls, you should get a gain in cash market. Now come back here. When share price is expected to fall, which action will give you gain in cash market? Today you have to sell. So what we will do is sell one share today. To counter this risk. Risk is there. Our risk to counter it, I have to take one position in cash market. People buy heart it in different ways, sir. My idea, do not buy heart it. But if you still want to buy heart it, I'm telling you shortcut also. You're a holder of a call option. Because you're a holder of call option, you have a right to buy share in future. Do opposite thing today. Right to buy share opposite is what? Sell share. You are a holder of call option. No? In future you are buying share, right to buy share. Do opposite of that. Buying share opposite is what? Selling share. Sell share. No. This strategy. But the real answer is even more easier. If you are a holder of call option, your option will be lapsed when share price falls. So in a falling market, I have to hit a gain in cash market. So cash market, which action will give you gain in a falling market is short sale today. That's the logic. The logical thinking. You want to buy hard, that's up to you. Next. Coming to steps for arbitrage. First, determine net cash flow today. You did two things now. One, you bought one call option. Bought means you paid premium. How much premium did you pay? 15. Next, you short sold one share. You borrowed share from somebody and sold it off in the market. Now that you sold the share in the market, spot price money will come to you, which is equal to 100. So on a net basis, you are having inflow of 85. Sir, 85 rupees is there in my hand. What should I do? Risk-free deposit. With this again, share, gold and all you should not buy. Arbitrage, sir, risk-free. Deposit rupees 85 at the rate of 10% per annum for 1 year, because in our call option maturity is 1 year. Third step, withdrawal amount at 1 year. 85 rupees, 10% you will get extra 93 point excuse me at 1 year. Next, at 1 year time, look at this, sir. At 1 year time, first day what did you do? You borrowed share from somebody and you sold it off. You have an obligation to buy that share and give it back to him, correct? So definitely you have to buy share. When after 1 year you go to the market to buy a share, there is a risk. What risk? Share price may rise. If it rises, obviously you have to buy share at a higher price, but this call option will protect you there. How the share price raises, a call will be exercised and you will receive some payoff. You buy share at a high price, but you will also keep on receiving payoff. There will be a compensation effect there. At 1 year, buy share to repay short sale and also settle call option. Sir, this step lo, sir, pakka you will have outflow, because previous step you are having inflow. Now you have to buy share. Definitely you have to spend money. Outflow will be there. So After observing everything, I'm telling you, worst case law also, your maximum, worst scenario only I'm assuming, maximum outflow will be equal to strike price, which in our example is 90. Beyond this, outflow is impossible for you. 1 rupee also extra under sir. This is maximum. Even if you are unluckiest person in the world also, 90 rupees is your max outflow. Beyond that, it will not be there. Proof you can see here. Your wish sir, at 1 year time, spot price of the share, I am taking 50 rupees. Spot price of the share, I am taking 150 rupees. Spot price of the share, I am taking 1000 rupees. Spot price, I am taking 0 rupees. How did you get these numbers? Simply random. My strike price is 90, no? I'm having an option in my hand. So one price I'm assuming below strike price, one price above strike price, one price extremely high, one price extremely low. We'll examine all the 4 cases. You remember, I have to do only 2 things. Number 1, I have to buy share. Next, I have to receive payoff because I'm a holder in call option, and call option ka strike price is 90. Now that I have to buy share at prevailing price, obviously here I have to buy at 50, here I have to buy at 150, here I have to buy at 1000, here I have to buy at 0. Whereas call option, I have a right to buy share at 90, market low price is 50, lapse, I will not receive anything. I have a right to buy at 90, market low price is 150, I'll exercise and I'll receive a payoff of 60. I have a right to buy at 90, market low price is 1000, I'll exercise the option, I will get 10 rupees payoff. Market low price is 0, I will also lapse 0. So if you see your answers now, net outflow minus 50, minus 90, minus 90, 0. Among this, which one will happen? I do not know. Assume worst and go forward. What is the worst thing? 90. 1000. When even if 1000 happens also, your outflow is only 90. So we are taking the exam, you need not proof. This is not for exam. Now, why am I doing this is, just think one thing I have to explain you for that. Second, in 1 or 2 questions, sir, that fellow asked to prove by giving 2 numbers. The numbers I gave casually, our questions that fellow only gave. He gave 2 prices and show, tell me based on this what will be your outflow. You need not even test. Your outflow maximum will be equal to strike price. Beyond that, outflow is impossible for you, because a call option is like an insurance policy, sir. You are going to buy share after 1 year. If share price raises, you have to buy at a high price, but call option will come and protect you. So in no case your outflow will exceed strike price. So that's the whole objective here. Now, from this we can prove that. Okay, so you can observe that here, max outflow, worst scenario also it will be equal to 90. If you are lucky, then it will be lesser than that. In that case, you will get more gain. You forget luck. We are not making luck now. Point number 4. Point number 5. Last final step over. Arbitrage gain is equal to inflow withdrawal amount in step number 3 minus outflow at step number 4, which is 93.50 minus 90. How much gain did you make? 3.5 rupees. Free gain, sir. Free 90 rupees, sorry, 3.5 gain is coming to you after 1 year. In this, sir, technically, if you observe, your 1 rupee also is not there in this. See the first step. What did you do? Your own money, 85. Borrowed share from somebody, sold it off. Money came. A money to 15 rupees you purchased option. Another 85 is there. Bank lo you put. Last you repaid that share ka borrowing and call option payoff and all you settle. Ultimately, you are having 3.5 rupees free gain in your hand. It is arbitrage. You should not come and ask questions like, if you want risk free gain, why to do all this? Go and invest in bank deposit and all. There I have to invest my money. Here I am not involving my money. Freely I am getting money. Okay. Next. What is the fair value of the option you calculated originally? 18.18. What is the market value of the option actually? 15. Go check the gap now on your calculator, sir. 18.18, 18, 18. Fully fill up. 18.1818181818. Fill up. I think minimum that much should be there. But actually so much? 15. Minus 15. To that, add 10%, please. Directly add 10%, plus 10%. 49999. That is nothing but 3.5. ఇది arbitrage gain ka verification sir. Today's mispricing whatever is there, the mispricing of future value only will be your arbitrage gain. That means indirectly when I solved here, I already know the final answer. The mispricing whatever is there, the mispricing of future value only should be your arbitrage gain. So your arbitrage gain is future value of mispricing. Are you understanding, sir? So like that. So basically, where people make mistake is strategy they go wrong. Once you do strategy correctly, pakka answer will come. 100% answer will come. So how to think, I'm telling you. First understand, it is cheaply available or costly? Cheaply available. Now that it is cheaply available, you have to go and buy. If you buy, are you in a safe zone? No. The option also can be lapsed. When will it be lapsed? When share price rises, it will be lapsed. So your risk is market share price may, share price falls, then it will be lapsed. So your risk is share price may fall. In a falling market, this will definitely give you a loss. So in cash market, you should be making a gain. Cash market, which action will give you gain? When share price is likely to fall, short sale. So go and do short sale. Sir, but if I do short sell, today I borrow share, sell it off. In future, I have to buy share. In future, when I go to buy share, share price may rise. That is a risk, no sir? Correct. But if the share price rises, call option will come and protect you, no? So, these two actions are like they are hedging each other, sir. They are hedging each other. Risk, this is the medicine. For this risk, this one is the medicine. So, they both are basically hedging to each other. That is the reason your maximum outflow is locked at. See, share price went to 1000. Now you have to borrow, you have to buy the share in the market at 1000. But call is protecting you with 9-10 rupees payoff. They are hedging each other. A hedging position you have to create. That's all. Okay. Next, put option I will show you the case, sir. 27, 28. Come here, please. You have to tell me strategy correctly. Don't see. Strike price is given 200. Spot price is given 185. Maturity period is 6 months. Risk-free rate is 5% per annum. He is asking theoretical minimum price of a put. Put option price is PV of strike price minus spot price. So, first PV of strike price. Where is strike price? 200. Take your calculator, sir. 200 divided by 1 plus 0.025. 2.5%. 200 divided by 1 plus 0.025. How much are you having? That minus spot price 185. You are having 10.12. 10.12 rupees should be the minimum value of put option. But actual value of put option is 5. Now you will not turn back. Answer here only. Bare minimum a put premium should be at least at 10.12. But actual price of put is 5. Put is overpriced or underpriced? Okay, wait. I will write here. Your put is underpriced. And the put is cheaply available in the market. When cheaply put is available, your action for arbitrage, number 1, tell me, sir, buy one put option because it is underpriced. Now that you are buying one put option, what's the risk you have? Put will be exercised when share price falls, put will be exercised. In that case, I'm happy only. But risk is what? Share price may rise. So market price of the share may rise. That's the risk. When market price of the share rises, definitely put option will give you loss. So I have to do some other action in cash market today only, which will give me gain when share price rises in future. So when share price is expected to rise in future, what action will you do today in cash market? Buy one share, long position you have to take. So the second strategy will be buy one share today. Sir, but if I buy one share today, in future when I want to sell, a share price if it falls, risk is there. But at the time put will get exercised, put will come and protect you. If put is getting lapsed, this fellow will protect you. If share ka value is falling down, put will come and protect you. Are you getting it, sir? So like that, okay, hedging position if you create, the magic starts from hereafter. Tell me, sir, buy one put option means inflow or outflow? No? Outflow, you are a holder. Buy one share is also outflow. Both are outflows only. For put option, you will buy at 5 rupees. Share, you will buy it at 185 rupees. Total outflow will be 190 rupees. You should not invest in your own pocket. Borrow this money from somebody. 190 rupees, borrow from somebody. At what rate? Risk-free rate to borrow. and repay that borrowing at 6 months time along with interest. So your outflow is 194.75. Sir, if I have to repay that, first of all, inflow should come. No, sir, how will I get inflow? What did you do with the borrowed money? You bought a share. Go sell off the share, bring money. Sir, what if share price falls? No problem. Put will come and protect you. So you have to sell the share. You have to also settle the put option. You will be landing in such a situation where bare minimum your inflow will be equal to strike price. Like how earlier worst outflow was what? Strike price. Here worst inflow is strike price. If you are lucky, you will get more than that. Forget about luck. Worst case also your inflow will be equal to strike price. In our example, strike price is 200. So what I have done, I have taken some prices and I've shown you. See here, 360,100. Put option here will be lapsed, excise. Based on that, some payoff, sale of share. So ultimately, if you see, bare minimum you will have an inflow of strike price. Below that, inflow will never go, sir. See, each particular table is done assuming physical delivery. Even if you take payoff settlement also, 100% answer will be same. Whether you do gross settlement or net settlement, that is not going to have any differentiation on your answer. So this is inflow. Previous step 194.75 is outflow. Inflow minus outflow will be your arbitrage gain. Of course, the arbitrage gain can be verified also. Mispricing whatever is there, 10.12 and 5 rupees. How much is the gap? 5.12. Add 2.5%, 6 months. You will have your final answer. Roughly it will match. Rounding of error. Right. Now, in this one special case, sir. A special case important actually. Carefully see. Suppose guys, is it today? This is after 1 year, which is my maturity date. On this date, some spot price, future spot price will be there. From that, I will remove the strike price in order to get the payoff in my call option. Based on all this, today I have to work out call option ka value. What are we doing? If future spot price ka proxy today is what? Today's spot price. Strike price is a certain number, so present value of strike price. If I take the difference, SP minus PV of strike price, that is giving me my minimum value of call option based on previous calculations and all. Okay, now one extra adjustment now. At 6 months time, let's say, a share is expected to pay some dividend. It's very important, sir. This is important for options also, futures also, same concept. During your maturity period, underlying asset share is going to pay some dividend. Now you have to answer me a simple point, sir. E dividend, okay, will it be included in this spot price? Share valuation chapter is over for us. The value of the share is nothing but present value of future dividends. So all the dividends till infinity will be naturally captured in the spot price today. Are you understanding this? Right. Now, E dividend, will it be there in this spot price? No, because from future spot price point of view, this is a past dividend, correct? Share price is a function of future dividends, not of past dividends. So E dividend will not be included in this spot price. If E spot price dividend is not there, tell me, E payoff calculation ki dividend is relevant or irrelevant? Irrelevant. Correct? That means E payoff is least bothered about this dividend. But what are you doing? E spot price ka proxy you are taking today's spot price. E spot price dividend is included. And if dividend is included in this spot price, indirectly you are including dividend in your call option value also. But whereas your payoff is not dependent on that dividend. So this dividend, whatever is there intermediate, this is not included in this. But this is included in this. Your future spot price, which is the reason for your payoff, does not have impact of dividend. But today's spot price, the dividend is there. And our spot price, you are using it for valuation of option today, which is not right. So what you have to do is, you have to eliminate the impact of dividend. Now, how will you eliminate the impact of dividend is, if dividend is there, no sir, this dividend, I will discount it to today. then I will get present value of dividend. I will minus that from the spot price. This we will call it as revised or adjusted spot price. And instead of SP, you will use RSP everywhere now. Wherever SP is there, you will use RSP. You should not consider the impact of dividend if the dividend is declared or expected to declare during your maturity period of the option. It is very popular adjustment for option valuation also, futures also. Futures how to do that I will tell you when we go there. Time being, remember like this. So because of this now, if somebody asks you what is the minimum value of call option, I will call it as RSP minus PV of strike price. Similarly, minimum value of put option is PV of strike price minus RSP, where RSP is equal to SP minus PV of dividend. Question la 100% they will give you dividend amount, discounting rate and all. You just have to discount it correct. Are you understanding, sir? So once again, I'm telling you, if dividend is standing during the maturity period, dividend is function of today's spot price, but it will not be part of your future spot price. But your future spot price only is used for your payoff calculation, and based on payoff only call option value has to be determined today. So what you have to understand is, for this payoff and for this call option value today, dividend should not be included. But naturally, dividend is part of today's spot price. So you have to consciously go and eliminate it. But they are standing at two different points of time. So discount it and eliminate it. Price is called as revised spot price. In some books, they also call it as adjusted spot price. They both are same stuff. So whenever you are doing any option valuation, any method, let be binomial also, wherever SP is there, that should be replaced with RSP if dividend is there during the maturity period. For example, I tell you, dividend is not there here, but dividend is there here. This is not there. Then adjustment is required or not required? Not required. Why? Dividend is part of this spot price also. Dividend is part of this spot price also. So in that case, you do not have an issue. Future dividends are obviously included in your spot price, but past dividends will not be included. So you have a problem when dividend is dividend is expected to declare during this period. Not before, not later. That kind of stupid question is also there, where dividend is there, but here, a trap, you should not adjust it. Are you getting it, sir? Chalo. On this, one question will do, but this time put option wala sum I will do. Wait a moment, where are you? Come this one. A put option has a strike price of 200 and an exercise period of 1 year. The spot price of the share today is 180. So strike price is given to you. Spot price today is 180. The share is expected to pay a dividend of rupees 10 at 6 months time. The amount is given to you. Excuse me. Minimum value of put option is asking. Given risk free rate is 10%. Then arbitrage possibility also he is asking. Anyway, question number 30. The moment you see dividend in the question, you have to first work out revised spot price is equal to spot price minus PV of dividend. Spot price is how much? 180. Dividend is 10 rupees, but it's expected at 6 months time. 1 plus 0.10 into 6 by 12. 170.48. This is RSP, sir. This is not value of option and all. Now you have to use this to work out minimum value of put option, which is equal to PV of strike price minus SP. Normally I will write, but now I will write RSP. Strike price is how much here? 200. What is the maturity period of the option? 1 year. 2. Minus RSP, just now calculated, 170.48. 11.34. 11.34 should be the bare minimum value of put option. But go to second bit. That fellow is telling actual put premium is 8. It is below the lower minimum, lower boundary is less than 11.34. So what can we say? Put is Overpriced or underpriced? Underpriced. Definitely arbitrage is possible. Now you will fast tell me action strategy. Action for arbitrage. This is proper thinking, sir. Thinking if you learn now put call parity again arbitrage will be there. Futures again arbitrage will be there. If you learn once, everywhere same thought process. Don't buy heart anything. Logically come. So something is cheaply available. So you have to buy one put option since it is underpriced. And also don't forget that if you are buying, who are you? You are holder. Holder of put option means he paid premium and he is buying one put. Put will be exercised when the share price falls. In that case, he is happy only. But what is risk? Risk is marketless share price may rise. Market price of the share may rise. That is a risk. If that happens, definitely this fellow will suffer a loss. So I have to do one more action in cash market, which will give me gain if share price rises at a later date. Which action? Buy one share today. So the easiest way to think, sir, because in this there is no shortcut. You are not by hearting anything and all. But if you like by hearting, buy one put option is your holder of put option. Holder of put option has got a right to sell share in future. In future, I'm selling share. Do opposite today, which is buy share. That also will work. Shortcut also will work. What is the original? Sure, action for arbitrage is over. Now coming to steps for arbitrage. First one, identify the net cash flow today. See, you have to buy one put. Put premium is how much? 8. Don't write 11.34 and all. 11.34 paper calculation. Reality lo market price of put is only 8 rupees. And you also have to buy one share. What is the share cost spot price? 180. Both are outflows only. 188 out today. E money, just because you are rich and all, you should not use. So this is borrow 188 at the rate of 10% per annum for 1 year. Now repay that borrowing. 185. Correct only, no? 188 into 0.10. Tell. 206.80. This is your outflow at what time? 1 year time. Sir, if this much outflow is there, where is money gonna come from? Sir, you bought a share. A borrowed money to, sir, you did not spend it off. No, sir, you purchased a share. A share you will sell now. A money to you will repay this borrowing. So, at 1 year time, sell the share and receive payoff in put option. Of course, only when it is exercisable. Pakka you will have a inflow, and bare minimum, worst case also, inflow will be equal to strike price. Strike price is how much? 200. If you want, you can verify. Take some random numbers. Pakka it will match. Minimum 200. Pakka it will come. Even if you assume share price is 0 also, you will sell the share at 0. You will not get any inflow. But putla, sir, you have a right to sell at 200. Entire 200 rupees payoff will come. 100% 200 rupees minimum. If market share price is more, you will get more. Like that. So that is one thing. Now coming to arbitrage gain. Arbitrage gain is your inflow in step number 4 minus outflow in step number 3. Your inflow in step number 4 is 200. Outflow in step number 3 is 206.8. Looking like a loss. Impossible. Loss will not come. Since you purchased the share today and you are selling the share after 1 year, in between period, sir, you received what? Dividend. The dividend also you have to factor, no? So plus dividend received 6 months compounded to 12 months. Why am I compounding it is, see sir, this is cash flow at 1 year. This is cash flow at 1 year. But at 10 rupees is standing at 6 months time. That also I have to invest it for another 6 months. So plus 10 rupees into 1 plus 0.10 into 6 by 12. So 200 minus 206.8 plus 10.5. Final answer. 3 point. That's all. The 100% correct answer. Proof is this. Take the gap. 11.34 minus 8. Add 10%. 1 year now. You should get that. 100% you will get. Rounding off error may be there, but 100% you will get. That means even before I framed action for arbitrage, I know my final answer. Even if you do wrong arbitrage somewhere, wrong action, wrong steps, somehow you will adjust and get back there. Final answer I know, no sir. Here only I know my final answer should be how much? 3.7. So somehow arrive at that. Basic, you know what is the structure, action, steps, final answer. Final answer number is given to you. Now, sir, one action in options market, another action in cash market, spot market. Sir, why I should put my one leg here, one leg there? What's the reason of that? Reason nothing, sir. Look, come to the formula. If formula, put option formula, what is there? Who are all the ingredients you see? Strike price. Okay, strike price. PV of strike price annam kada. So risk free rate. Spot price. RSP dividend. Using these 4 numbers only, no? You calculated 11.34. Correct. 4 numbers, so whatever you calculated and what is there in reality, which is 8 rupees, they are not matching. There is a mismatch. A mismatch, if you want to enjoy, you have to take some action where you will be touching all those numbers in reality. Strike price, if you want to touch, you have to enter into options contract. Risk free rate, if you have to touch, either you have to deposit or you have to borrow. Spot price and dividend, if you have to touch, definitely cash market lo share, either you have to buy or you have to borrow from somebody and sell. Are you understanding, sir? See, all these numbers, if formula level you are seeing now, but if formula whatever you computed and what is actual, the both are not matching. If you want to enjoy this difference, then a formula should become reality for you. That means if formula ingredients who all went, all that should be real cash flows for you. Then 11.34, 8 is also one real cash flow, 8, a gap will come into your hand. So that's why one leg in cash market, one leg in options market. So 11.34, all these are there. Strike price, buy option or sell option. Risk free rate, deposit or borrow. Spot price, share, you have to buy or sell. Dividend, when you buy or sell share, automatically dividend impact will be there for you. So one action in cash, one action in futures market, sorry, options market. Then you will get this. Now, when you are studying options, sir, why should I go and take one position in cash market? Give the answer. A formula, spot price is there. Unless you make this 11.34 in your action somewhere, 11.34 k 8 k difference, why will it come to you naturally? It won't come. You have to do something. 11.34, who are all there? Spot price is there, dividend is there. All that if you have to experience, you have to go to cash market. That's why one strategy in options market, one strategy in cash market. Well, so that is the end of our theoretical boundaries on options. That takes us to put call parity theory. As such, there is nothing very great in this, sir, but it's a wonderful theory. Conceptually, it's a very great thing, but from your point of view, it is not difficult to learn now. Look at this. A put call parity theory establishes a relationship between identical call and identical put. Identical call and put options. Sir, what is the meaning of identical call and put? Sir, between two options, everything should be same except their nature. One is call, one is put. Twins, but one boy, one girl. That kind of twins. We have one pair like that in my home. Okay. So that means option with same underlying asset, same exercise price, same maturity date. With this data, I want one call option and we want one put option. The call option put option ki relationship is framed by put call parity theory. Casually in any sum you cannot use. If you want to use this relation, call and put should have same underlying asset, same strike price, same maturity date. Everything should be same, just nature different. One is call, the other one is put. This kind of identical option ka relationship is called as put call parity equation. Now, so a put call parity equation or relation is value of call plus PV of strike price is equal to value of put plus spot price. This is a formula, sir. This is the relationship of put call parity. Sir, how do you remember all the formula? I don't. You also will not. Now, forget about the stupid relation. Come here. Tell me, minimum value of call option formula. Bare minimum value. We just now discussed. Tell that spot price minus PV of X. This is minimum value, correct? To this, go and add put premium. If you add put premium, you will get the exact value of call option. This is what? This is not call option ka value. It is call option ka minimum value. I want exact call premium. Then take the minimum value, add put premium to that. Then you will get call option ka value. Similarly, put minimum value, PV of strike price minus spot price. To this, go and add identical call option ka premium. Automatically you will not get minimum value now. You will get the exact value of put option. This only is this relation. You will see now. This one, throw it that side. How will it look? PV of strike price. So call option is equal to minimum value of call option plus put premium. Similarly, this one, throw it that side. PV of strike price minus spot price. That is what? Minimum value of put plus call premium is put option value. Do you understand, sir? Earlier, whatever formula we discussed, that's not for call option value. The call option ka minimum value. This is call option ka exact value. Put option ka exact value. That's how this formula is work. It formula has to be interpreted. If you can remember this original formula, that's it. If you don't remember, use this technique. No, it will work. 100% it will work. Okay. Now, sir, okay. You are saying that there is an identical call, there is an identical put. Identical call, identical put will enjoy this relation. You observe both the formulas are same. First formula, second formula, they both are same only. I'm just presenting it differently so that it's easy for you to remember. Now, a relation, how will I use? How will I use this relation? Means how is it advantageous for me to learn this? For that, the background comes like this, sir. So, when I write call option ka formula, which is SP minus PV of X. Tell me, SP stands for what? Spot price. Marketless spot price I can verify now. A number as it is you take. Optional strike price will be there as a fixed number. That is not something which I can change and all. As a contracted price. That to discount it with risk-free rate. Risk-free rate is RBI ka treasury bill rate. I cannot manipulate that also. That means E number and E number, whether you calculate, I calculate, in this country anybody calculates, answer will be same. To that, you go and add put to value premium, not fair and all, actual put premium. Actual put premium in the market. Stock market put option value will be there. No, bring that number and add. That means, observe, none of the numbers I am cooking. This I picked up from the market. This risk-free rate to discounted strike price. This also market ka value. These three numbers are picked up from where, sir? Market value. There is no theoretical calculation and all here. Whatever answer you get now, that has to be and should be the value of the call option in the market. So this is called as fair value of call option. Actual market loss, sir, real call premium should be whatever number you calculate. Should be, and we are saying no, therefore this is fair value. Actual, it may match, may not match. If it matches, no problem. Does not match, arbitrage is possible. Again, watch 1, 2, 3, 4. 4 ingredients are there. In that 3 actuals I take. Fourth one also should match with actual, ideally. Therefore, we are calling this as fair value. Standard. Ideally, it should be this. If it is not matching, definitely arbitrage is possible. 100% arbitrage is possible here. Similarly, if fair value of call, what I will do now, compare with actual call premium in market. When you compare, what will you understand? Either call option is correctly priced, or call option is underpriced, or call option is overpriced. So in this, 3 results are possible. Call option is correctly priced, call option is underpriced, call option is overpriced. If it is correctly priced, no arbitrage. No arbitrage is possible. But in these 2 cases, definitely arbitrage is possible. In the question, what you will see in the exam, arbitrage will be possible. That fellow will 100% ask you to execute the steps for arbitrage. That's all. Sir, why did you find out only fair value of call option? We should not find out fair value of put option. Of course. Please be my guest. Value of put option is equal to PV of strike price. I won't cook this at the naturally market available. Spot price market available. Value of call option, take actual call premium in the market. Whatever answer you get now, that should be the fair value of put. After you working out this, what will you do? You will compare this with actual premium in the market. When you compare, you will see whether it is matching or not matching. Matching, arbitrage not possible. Not matching, pakka arbitrage is possible. You need not be innocently checking this also, not required. You check one, take a call, take a put, any one you check. If one mispricing is there, automatically other fellow is also mispriced. Call option is correctly priced, put also will be correctly priced. Call is mispriced, put also will be mispriced. Now, this will look something like this. This is call, this is put. That's looking like seesaw. It's looking like one because if call is correctly priced, put is also correctly priced. Now, what are the 2 other events that can happen? Call is underpriced, which means this scenario. If call goes out of balance, put also will definitely go out of balance, but out of balance will be on the opposite side. So here, if call is underpriced, put is overpriced. And the other event is call is overpriced, then put will be underpriced. This is very important, sir. If you do not understand this one, as arbitrage action also you cannot frame. Why? Because one option when it is underpriced, the other fellow is overpriced. One option you have to buy, another fellow you have to sell. If you do not know this fundamental point that one is mispriced, other one is also mispriced, but it's mispriced in the opposite way. You see some model, it will work. We can prove also, taking any numbers, we can prove this, sir. That's not a big deal. Directly in the question, I will prove this and show you. Okay. For proving this again, one more number, investment of time is waste. Directly in the question, I will show you how one mispricing will lead to mispricing in the other also. That's all is relevant, sir. Nothing more. You just have to understand that if this is correctly priced, this is also correctly priced. If call option is overpriced, put option is underpriced. If put option is overpriced, call option is underpriced. That's all you need to know. Sir, action for arbitrage, steps, all this you have to practice, but there's nothing to by heart in that. Understand, practice, leave. Exam also thoughts naturally will come to you if you originally practice it well. These are things which you don't see in the last moment by heart and write somewhere and all. Actions and all, you should not by heart. Feel, understand, leave. And naturally it will come to you. 100% will come to you. Chalo, on this questions. Come to question number 34, please. This is very good question, sir. Copying this only, June 18, they asked one question. That's a cheap sum compared to what I'm going to solve now with you. So anyway, come to this one only. It's a lengthy question, but in this everything is covered. Please take up this. The following table provides the price of option on equity share of X Limited and Y Limited. The risk-free interest rate is 9%. You as a financial planner are required to spot any mispricing in the quotation of option premium and stock prices. Suppose if you find any such mispricing, then how can you take advantage of this pricing position? And then he gave you some data regarding X Limited share and Y Limited share, spot price given, strike price given, maturity given, call premium given, put premium given. That's all. If sumless you just to see, sir, whoever framed this question, how cunning he is. Nowhere put call parity and a word is used. Nowhere arbitrage word is used. Now how will I get idea? Idea is like this. They gave you call premium and put premium for the same underlying asset with the same strike price and the same maturity. If three things are common, then they are identical call and identical put. Automatically put call parity will come into play now. The question will not tell you directly. You must understand all that. Underlying asset same, X Limited share, maturity period same, strike price same. That means that call and put both are identical. Now that they are identical, you have to apply put call parity equation. Similarly, in the sum two questions are there. Next is Y Limited custody. So there are two questions in this sum. One is with X Limited as underlying asset, one is with Y Limited as underlying asset. One by one we'll handle. Next, mispricing ka advantage is only called as arbitrage. A point we should already know. Then only a question will understand first. Now how to solve the next level. Not difficult at all. It's just that peacefully you have to solve. Question number 34. Next. First one, we'll do call and put options on X Limited's share. X Limited share is the underlying asset. Using that fellow as underlying asset, call and put options ka verification we are doing. Okay, now, sir, you can work out fair value of call also, fair value of put also. That is your wish. Okay, I am working out fair value of call. Tell me, sir, we call formula now. Tell minimum value formula, tell SP minus PV of X. To that, you have to add value of put option. That's it. Now, SP, how much? 160. Strike price is 100. Maturity period is 6 months. So, 100 divided by 1 plus 0.09 into 6 by 12. Plus, put the actual premium you have to bring, 4 rupees. Put premium is 4 rupees. Process is fast. Very nice. 68.31. Sir, this one is fair value of call option. From the question you can see, that fellow gave you actual call premium is 56. You observe, according to our calculations, call ka value should be 68.31, but actual call option value is 56 rupees. Call option is underpriced. Therefore, call option is underpriced. Which means that your put option is overpriced. You have to remember, but we can prove also in this sum. Example don't do, but normal I'm doing it now. Value of put option is equal to PV of strike price minus spot price plus value of call option. PV of strike price is this only, 100 divided by 1 plus 0.09 into 6 by 12 minus spot price is 60. Call ka actual market value ma T6. You'll get some negative number, I guess. 8.31. Positive or negative? Negative. See, options value will never be negative. If it is bad, option value will be 0. Option negative ka meaning is what you know? If I buy an option, I will only get money. That is the meaning of option value becoming negative. For buying an option, ideally we have to pay premium. No. Negative value means what, sir? We only have to pay premium. Will it be like that? Huh? No. In that case, option value will be 0. Option values will never be negative. Indirectly, what I am trying to say is fair value of the put. How much is fair value of the put? 0. But actual put premium is 4. Can't you see now? A put option is worthless. Its worth is 0. Market stupids are buying that put option at 4 rupees. Don't you think the put is overpriced? Clearly put is overpriced. For proving it, I did, sir. Exam you need not do. You just check either call or put. One you do, other one you can guess. If this is underpriced, that will be overpriced, like that. This is just for proof I have done, sir. The exam you need not do. One definitely you have to do, because otherwise you don't know which side mispricing is there. Now, coming to action for arbitrage. You code this correctly, answer is ready for you. Okay, which option is underpriced for us? Simple. Something is underpriced. Buy one call option. Wait a moment. Since it is underpriced. Buy means you are a holder. Next. Call option is underpriced, you bought, but put is overpriced. What's the meaning of that? A put is worthless, sir, but some stupid in the market is buying that put option at 4 rupees. You also go and sell it to him. So, sell one put option. Now that you are seller of a put option, you are a writer. You should not forget this. Seller of option is nothing but writer positions. Now, 2 positions you have taken. Now, you will definitely have one risk. Now, nothing to hurry. Peacefully think and answer. You are a buyer of call option, means you are holder of call option. Holder of call option, option will get exercised when the market price rises. In that case, the happy situation. But if sad situation means what? Share price should fall. If share price falls, what will happen? Your call will be lapsed. So you are facing one risk, that market price of the share will fall, may fall. That is a risk. For the first case, come to second one. You are a writer of put option. Tell me, you want option to be exercised, not to be exercised? Not to be exercised. So what is the risk? Option getting exercised only. When will put getting exercised? When price falls. Observe. For both these actions, risk is same. Both the positions will give you loss if one event happens in the market. What is that? Share price falls. If share price falls, call option you will lapse. Put option your holder will exercise. So you will lose on both the ends. You are a holder of a call option, but you are not a holder of put option. You are a writer of put option. If share price rises now, sir, both happy. Here you will exercise. That fellow will lapse. Both the cases gain. But risk is what? If share price falls, you will suffer a loss here also. You will suffer a loss here also. Both sides you will lose money. So, third step. Sir, why third one again? Array, sir, come to formula. Who are there in this? Tell me. spot price, strike price, put premium, call premium. All four should be there in my action. Otherwise, difference, how will you enjoy, sir? 12.31 difference is there, no? A 12.31 difference with the time value of money, if you want to enjoy, you have to do transaction of 56 rupees also. You have to do transaction of 68.31 also. 68.31, how did you get? Spot price, strike price, put, call. All four you have to do. Now, call option, put option actions you have taken already. Spot price action also you have to take. Spot price means what? Share ka price in cash market. You have to do something there also. Now tell me, what should I do? In future, if share price is gonna fall, I have to make a gain. Which action? Short sell. Sell one share today. This is obviously short sell. Selling one share means short sell only. Sir, but here one risk is there. So you have to sell two shares. No, no, sir. The idea is when you do on your own, you will get. No, only one share you have to sell. Why? In no price, at no price, call put both will get excised. Either call will get excised or put will get excised. Because call will get excised when share price is above strike price. Put will be lapsed. Put, if it has to be excised, market price should be below strike price. Then call will get lapsed. So both the options will not be excised. Only one will be excised. You have to sell only one share for that. Two shares you should not sell. The experience you will know, sir. Steps for arbitrage. Okay. First one, net cash flow today. Cash flow is neutral. Inflow, outflow in a word I will not commit because I don't know the answer myself. Buy one call option, you have to spend money. What is the call premium? 56. Sell one put option means writer of put option, you will receive money. How much? 4. Then sell one share ka meaning is what? Borrow share from somebody in the market and sell it off and receive spot price. How much spot price? Net or not? Or not it? 108 net you are having a inflow. Inflow is there, so deposit this money, rupees 108 at the rate of 9% per annum for 6 months. Withdraw deposit 108 into 1 plus 0.09 into 6 by 12. Please tell me this. 112.86. This will be your inflow at 6 months time. Fourth step. You basically borrowed share from somebody and sold it off. You are duty bound, obligated to buy the share in the market and deliver to him. So at 6 months, buy share in market and to repay the short sale and also settle call plus put options. Call option you are holder, put option you are a writer. Earlier also when we did arbitrage, this step what was our answer? Strike price. Strike price was our answer, correct? But at that time I told you the worst possible scenario. If you are receiving money, lowest inflow. If you are paying money, maximum outflow. Minimum inflow, maximum outflow is equal to what? Strike price. In this case, your inflow will be equal to strike price. Sir, minimum or maximum? Nothing, sir. Just inflow will be equal to strike price. How much is your strike price in this sum? 160. Yeah? Sorry. 100. You will not have 1 rupee more than 100, 1 rupee less than 100. Sir, why, sir? Because I am having call also, put also. Both sides I am protected. You will not get more than 100. You will not get, sorry, you have to pay not more than 100, less than 100. So randomly, two prices I'll just show you quickly. If spot price is equal to 50, if spot price is equal to 1000, one very small price, one very high price. Tell me, sir. Payoff received in call option, strike price is equal to 100. That will fill up at once. Wait. Then payoff paid input option, strike price is equal to 100. Number 3, to repay the short sale, you have to buy one share today. Let's start with the last one. It's easy. Whatever market share price is there, our price have to buy the share and deliver the short sale fellow. Next, come to the first one, sir. I am a holder of call option. I have a right to buy the share at 100, but market price is 50. I lapse it. Second scenario, I'll exercise it. I'll get an amount of 900 over call option. Next, put option. I am not holder. I am a writer. Put option, somebody else is holder. That fellow is having a right to sell at 100. Market price is 50. That fellow has a right to sell at 100. He will definitely exercise. Payoff is how much? 50. I am writer. For me, it is a outflow. Second scenario. The other fellow has a right to sell at 100, but market price is 1000. He will lapse. Since he will lapse, I need not give any payoff to him. That's all. Let and see. You take another 10 combinations also. 100 rupees exactly. Your outflow is locked, sir. Earlier, maximum inflow, minimum outflow was there. Here, exact inflow will be equal to strike price. You need not prove this in the exam. That's not required. Directly write strike price. Why will you prove, sir? You already know the final answer. No. You're worried. Arbitrage gain 112.86 minus 100. Step 3 minus step 4. How much is that? 12.86. Sorry, 12.86 I can verify. Of course, you can verify. 68.31 minus 56 into 1 plus 0.09 into 6 by 12. Has to, will, should, has to. 100% will match. Pakka it will come. The arbitrage ka the advantage. Even if you manage half of it also, full you can do. Because final answer you already know. If the formulas originally correctly you post, this and this ka difference in the final answer, sir. 12.31 came difference. But after all the magic I do, I'll get the gain after 6 months. So I will get this difference with the time value of money. That's all. This is the cmainterdt story. If you take Y limited share as the underlying asset, now another case is also there. No, in that case, what will happen is, I'm not solving that. In that case, what will happen is, call option here it's underpriced, put is overpriced. No, in that some reverse situation also you will see. There are only two possibilities. No, either call will be underpriced or it is overpriced. Example, it is underpriced and put is overpriced. In Y limited, call is underpriced. Sorry, call is overpriced, put is underpriced. In that case, you have to tell me the strategy. Wait a moment. Now tell. This is Y limited share. Look at this, sir. Call is overpriced, put is underpriced. Tell me. Call is overpriced. What will you do? Sell one call. Next. Put is underpriced. Buy one put. That means you are a writer of a call option and a holder of put option. Okay, what is the risk? Share price rise is the risk. If share price rises, call option ka holder will exercise the option, we will feel bad. And my put option, whatever I bought, that I have to lapse. Clear? That means, what is the risk you are having? Market price increase is the risk. So in a rising market, cash market, you have to get a gain. For that, you have to buy one share today. That's the strategy. Automatically answers will come. Now, what I wanted to show you, I forgot. Look at this, sir. On the maturity date, when you see, you will never have a scenario where you will receive payoff also, you will pay payoff also. That's impossible. Both the options will not be exercised at once. One option, if it is getting exercised, another option you are lapsing. You're getting it, sir? That is the reason you are selling only one share today, not two shares. Both the options will not be exercised. Here you see, call lapses, put that fellow exercised. Or we exercised call, in that case, that fellow will lapse the put. Both call and put cannot be exercised at the same time because strike price is bloody same. Strike price is same. How can they both be exercised at the same market price? Impossible. That's why one share is enough to counter that risk. That's how the logic flows. Anyway, the second one you manage. One or two chiller questions are there, sir. Like, look at this fellow. he gave you put option, call option, same expiry date 6 months, and same strike price of $10. The interest rate is 12% per annum, continuous compounding. Now that he is giving continuous compounding, 1 plus PIR must be replaced with e power RT. Now, he's asking first question, put premium he has given, put ka market price is $2. Stock is worth $8, which is nothing but the spot price. What is the value of call option? Call premium he is asking. You tell me, sir, call premium ka formula is what under put call parity? Fast. Value of call option is equal to spot price minus PV of strike price plus value of put option. You understand, sir? V put if you don't add, that will become minimum value. V put if you add, it will become actual value of call option. In fact, fair value of the call option, assuming correctly price, are the actual call premium. So spot price in the sum is given as 8. Strike price here is given 10 divided by e power R, 6 months maturity. R is 0.12 into 6 by 12. Okay, fine. Put premium 2 rupees. 8 minus 10 divided by e power 0.06. E power 0.06 is 1.06184. I by hearted few. I know. Normally you have to work out. So if you solve all this, you will get 0.58. This one I did not by heart, I saw. Like this. The first question, sir. Second question. Again, put premium he is giving. V put given. Call premium also given. V call given. He is asking spot price. Now he is playing hide and seek. See, all you know is only one formula. First question, these three given. He is asking this one. Second question, this one given. This one is available with you. They are asking spot price. Third question, he is asking this one. These three given. All you see, there is only one formula, sir. E formula. This only can interchange here and there and use as I want. Or don't interchange, keep it like that only in use. The answer will be same only now. Next. Your exam fellow got somewhere creative, sir. Wait, I'll show you. We do. Come to this one. December 2023. Suggest an answer what is printed. I am not responsible. Okay. Question is a good one, so I am just talking. The shares of Goxin Limited are presently trading at a price of 540. What is this spot price? At 3 months, the prices will either be 600 or 480 with some probabilities given 60-40. One high price and one low price. There only must understand is the binomial model. In no other model, high price, low price will be given. High price, low price is given means a pakka binomial model only. With the probabilities of 60 and 40. 60-40 are real probabilities. Don't apply risk neutral method and all. We dummy probabilities. If you want to, real probabilities. If you want to apply risk neutral method, apply. But you have to cook your own probability. Not that one. Real probabilities. Don't use that. There is a call option on the shares of Goxin Limited that can be exercised only at the end of 3 months at an exercise price of 510. Strike price is given to you. Risk-free rate is given. Continuous compounding and he is telling. Dividends are not there. If dividend is there, what I will do? SP place I have to take RSP. That's the only thing that you need not do in this sum. This fellow is asking determine the value of a 3-month call option using, had he stopped there, no sir, without writing the bracket whatever he wrote, I can apply either of the methods. Either risk neutral approach or riskless hedge approach. Any model you can apply. But that fellow did not keep quiet, no. He said something, delta method. Delta method means which one, sir? Riskless hedge approach. A number of shares is nothing but option delta. That's the reason you have to do that. Suggested answer, stupid applied risk neutral probability. Wrong, no, sir. He is asking delta approach. That means you are supposed to work out call option value in riskless hedge approach. Stupid worked out in risk neutral method. Answer will be same only. But how can you ask this and give this suggested answer? This is technically wrong, sir. Now, what can I fight with people whom I don't know? Okay. So, the delta method means riskless. Don't see just because suggested answers are not God and all, the wrong answer. You have to do riskless hedge approach only. Very clear. If that wording is not there, you do any method, that's okay. This fellow sat and worked out risk neutral probability. Wrong, no sir, you should not work out like that. The probability of high price and all he's getting, and ultimately he'll obviously get the answer. What is the answer will be same only, we already proved that. Next. So what will you work out ultimately? Call option ka premium. This fellow is now asking, get me put premium. What is just a put also will work out? No. Using put call parity low you have to get. Meaning call premium already you have. Spot price you know. Strike price you know. Risk free rate you know. We put formula you can apply and get the answer. We put formula is what now? PV of strike price minus spot price plus value of call option. That is what he is expecting it to. Worst presentation, don't mind. So we put your size transfer only. PV of minus spot price plus V call. So ix e power RT, whatever model they are having, ignore that. PV of strike price. What is strike price in this sum? 510 divided by e power. R is how much? 6% and maturity is 3 months. 0.06 into 3 by 12 minus spot price 540 plus call option value t.36. Sir, how did you get that? I copied from here, sir. 50.36. Where else? Some answer will come 12.7, sir. Our formulas and all, they don't look good, sir. That's the reason I changed all the notations. The correct easy one too. Actually, sir, his sum has got some one range. He spoiled the entire thing by giving risk neutral method. What is that range is? You tell me, when we discussed riskless hedge approach, I asked you to create one portfolio. A portfolio, what and what are there? X number of shares you purchased, and you also wrote one call option. Correct? With that only we did one example. Then we did one question also. You remember, I did not do put option on that. Riskless hedge approach, the put option model I did not show you. You know why? A model is not applicable for put options. A model can be done only for call. Sir, then put option value how? If they ask put option value, first to work out call option, then apply put call parity and convert the number. That is the logic. That's the reason that fellow asked delta method like calculation, and then next question is asking put premium using put call parity. Why can't I work out put directly? Not possible. Risk neutral method possible. Riskless hedge approach low, not possible. That's why call premium we work out and then we apply put call parity and convert it. That fellow did risk neutral method. The wrong answer. The question purpose is something else. He spoiled the entire thing. Anyway, let him die. So guys, that is with your put call parity. So what did we cover? Normal method over for us. Binomial model over. Theoretical boundaries over. Put call parity, arbitrage is also over. We are left only with Black-Scholes-Merton model. Black-Scholes model formula and basics you learn now. Questions 1 or 2 next class we will do. Just formula work you will learn now. Now, there is a small issue here. The Black-Scholes model, if you have to learn, you need 2 basics. One, how to see normal distribution curve and table. This you should know. But while doing capital budgeting chapter, I have shown you normal distribution curve, how it looks and all. But roughly, I'll just quickly recap it. Sir, normal distribution curve means it looks like this, where we believe that predominantly data or outcomes will fall in and around the mean value. In middle whatever is there, that is mean or expected value. The right side can go as high as plus infinity. This can go as low as minus infinity. Now, depending on from which area to which area you want probability, then depending on that I have to work out a z line and I have to draw there. So, in normal distribution curve ka purpose is what, sir? Give probability for a range of data. So for that, your z value can be either a negative number like this or a positive number like this. So this is your z negative, this is your z positive. And what extra points we should know? From here to mean and from here to here, your probability will be how much? 0.5, 0.5. And of course, the total probability will be 1. If you know this much, next part of the story is, once you get the z value, is z value in the table how to plot. Now there are how many tables we have seen? 4 tables are there. In that, the first table, you just have to understand what the table speaks. The first table is called as standard normal distribution table. E table, if you identify the probability, it gives probability for area between mean to z line. This is very, very important for you. What each table speaks, that's very important. What you want might change, but what the table speaks will never change. So when you look at the first table, a first table will give you probability for mean to z line. If this is your normal distribution curve, if your z value is here, if this is mean, then E area is your table probability. If z is positive. If z is negative, then this is mean or expected value. This is your desired value z, and in that case, a table is giving probability for this area. Is the table probability. What the table speaks, you should have utmost clarity, otherwise confusions will happen. This is standard normal distribution table, first one. Second one is called as one tail table. A one tail table gives you probability for the area between z line to nearest to infinity. Whatever infinity is nearer to there, it will give. So first scenario, I'm assuming my z is positive. Second scenario, I'm assuming my z is negative. If this is mean, this is my z line, this is nearest infinity. So what the table speaks is E area, sorry, from z to infinity. Z is negative from z to nearest infinity. Wherever your z is there, from there to nearest infinity, whatever infinity is there, up to there. Two tail table, not relevant much, sir. Ignore it. It's a sum of two one tail tables basically. That's irrelevant, not much used. Come to the last table. Last table is called as standard normal cumulative distribution table. E table is exclusively created for Black-Scholes model only, created by the same people also. But very rare that a table will be given to you in the exam, because if it is given, directly answer it. You need not even draw the diagram. Just straight whatever ND1 probability you want, that is that only. Directly you have to pick up. But you should know the existence, because MCQ they may ask. We never know. So that's why. E table gives probability from your z line to minus infinity. Not nearest infinity. Outrightly minus infinity. From wherever you are standing, from there to minus infinity. This is my mean line. If this is my z line, ఇది positive infinity, ఇది negative infinity, is z will be for this entire period, entire place. This is probability from z line to minus infinity. This is stable probability. If your z is positive, that is this case, z positive case. If your z is negative, like this scenario, then negative infinity is this one, then your table probability will be this area. This z negative. This is mean. You must have a clear-cut answer, clear-cut understanding of what the table speaks. What you want in Black-Scholes model, I'm telling you, sir. Every Black-Scholes model, I want from wherever you stand to negative infinity. I want this area. If your z is positive, I want this entire area. If z is negative, I want this area. This is Black-Scholes model requirement. But question of what they will do, they will give you this data. They will give you this data. Your z is here. I want this entire area. They will give you first table. So what you have to do, this plus this is 0.5. But if your z is negative, they are giving this area. I want only from here to here. What should I do? 0.5 minus this area you have to remove. What you want in Black-Scholes model is z line to minus infinity you want. For that, direct answer is last table. A last table questions they may not give. So irrespective of whatever table they give, you have to work out what you want. So this is one thing you have to learn, sir, which is normal distribution curve and table. Second basic you have to learn is how to compute a natural logarithm. Natural log you have to calculate. Now what is a natural log? If you have to understand, make you understand first what is the meaning of normal logarithm, you should know. Now, you know, once upon a time, you know. You will tell me now, wait. Tell me, log 10 to the base 10 is how much? Just now only you told you don't know. Okay, let's try again. Log 100 to the base 10. Just now you told you don't know logs. 10 power 1 is equal to 10. 10 square is equal to 100. One more. Practice. Log 1000. Now you tell me, sir, what is the meaning of logarithm? Logarithm ka meaning is base ki how much power I should put if I have to get this number. 10, how much power you should put if you have to get 1000? A power is there, no? A power is the logarithm. Logarithm means how much power I should put to my base to get the desired value. Logarithm is nothing but a power ka answer. Are you getting it, sir? Right. This is normal log. Now, if same logarithm, sir, of 1000, if I ask with E base, what is E? 2.71828. E is equal to 2.71828. It's called as Euler's number. Anyway, irrelevant. So the log x to the base E. When base is not 10, but base is E value, then it is called as natural logarithm. Natural logarithm is called as normal logarithm with a base E. So you must just understand one small point. Natural log is equal to log with base of, that's it. Now, one example you have to solve and close for today, sir. ln of, go to the book last, sir. Some time value of money tables are given. E power value tables and all will be there. Last page, last natural log table will be there. In that, any numbers, your choice. This and this will do. Okay. X, ln of x. Okay, nice. Okay, sir. You have to fetch me ln of 1.1255 is equal to how much? Logarithm of 1.1255 with the base E. That's called as a natural log. You can search in the table 100 times, you won't get it. What you will get in the table is ln of 1.12 you will get, which I just now saw, no? 0.11333. Then we have 1.13, which is 0. A number is tempted, sir. 1, 2, 2. Okay, fine. So this is, so whatever you want is lying in between these two. So Interpolate, what else? Now tell me, sir. For a 0.01 change here, this side, how much gap is there? Do the math fast. 0.88. Only that much, huh? 889 is also there, huh? Okay. 889 is increasing or decreasing? When I increase this, this is also increasing. Our relation important, sir. Otherwise, it will be wrong. Now, what do you want? You want to increase, not by 0.01, but your desired increase is 1.12. How much was it? 55, huh? 55 minus 1.12. So I want to jump up by 0.00. Wait, 55, huh? 55, correct. 5, you're right. So this side, how much I should increase? Proportionate calculation. 0.00889 into 0.0055 divided by 0.01. 0.00? Okay, fine. Okay, this is the final answer, huh? No, this is the amount what you have to raise. ln of 1.12, all stupid numbers only, I'll ask 1 to equal to, what is the basic number? 0.01133 plus 0.00488895. Tell. Slowly, 0. This is called as natural logarithm. Obviously, you did not like it, I know. But you see, sir, what choice you have? You have signed up for this when you registered yourself as CMA. Guess what? Shortcut is there. Sir, enough, sir. This is no. Write on your notes. Calculator, sir. 2.71828. 2.71828. What is this? My lucky number, huh? E value. Square root it 12 times. Very well. For all your frustration in life, don't run calculator. 12 times square root it. You got some number? Minus 1 is equal to m plus. Okay. Up to m plus you did a hold like that only. You want E value for which number? 1.1, sorry, ln value for 1.1255. That you write. Directly press 1.1255. Nothing will happen. Square root it 12 times. Why are you hiding your calculator? M plus is not there, huh? It's there. Okay, 12 times you did, okay. Same thing, minus 1 is equal to divided by MRC is equal to, how much are you having? There is no table, nothing, direct answer. So, but you have to remember this. So, take E value, 12 times square root it, minus 1 is equal to M plus. Same thing you have to do up to here. Basically, this answer divided by step 1 you have to do. Step 1 answer is already stored in MRC, no? So, divided by MRC. Many people, what mistake they do is they divide by MRC, after that equal to they don't press. Then what will happen? MRC answer only will be there. The wrong answer. You have to press equal to also. Then you will get exactly same answer. 100% will match. No question will give you LN tables. Example Black-Scholes is asked. CMA final definitely it's asked. CA final they're not asking, but CMA final definitely they're asking. And I'm not sure whether they'll give you this or not. This they anyway they won't give. At least they should give. No, not giving. You plan your own. This is not optional. Compulsorily you have to learn that. And this is also not optional. Diagrams, colors and all you have to learn. That's all. The basics are enough. Formula, questions, practice, next class. With that, Black-Scholes, we are done with options completely. We'll move on to futures. That's all, guys. See you. So, well, guys, in the last class, we have just trying to give introduction for Black-Scholes, where we learned two small concepts which are relevant, without which Black-Scholes model of option valuation is not possible. Other than Black-Scholes, remaining models we have already covered. Binomial model, two methods are there, both are over. Theoretical boundaries we have seen. How to identify the action for arbitrage, we have learned that. Then we have seen put call parity equation. And now we have to do the last one. With that, with this model, our entire option valuation is going to be complete. Now, there are two things which we need, sir. One is normal distribution curve and table. The other one is natural logarithm. Now, normal distribution curve table, earlier while doing capital budgeting also, we have applied this once. But as such, it is like whenever you want probability for a range of data from one outcome to another outcome. For this range of data, if you want probability, then you have to use normal distribution curve. The curve, as it looks like this. Now, what you have to do is you have to first plot a z line. Z line means what is the exact point what you want. So from here, you might want this area ka probability, or you want this area ka probability, or this you want this entire area ka probability. Whatever you want, you can find out. But first, you have to identify one line. A line is called as z line. Now, once you plot the z line, then is z value whatever is there, that you have to go and check in the tables for identifying the probability. But the thing is, there are 4 tables actually. Popularly, only 3 we will be using most of the times. Now, if tables will talk about probability of one particular area. If you know what the table is speaking, then what you want, that can be adjusted for. So in that, the first table is standard normal distribution table. This table gives you probability for the area between mean and z line. If your z is positive, then it will form on the right side, right tail, and this area will be your table probability. If z is negative, then your z line will be this, then your table probability will be this area. Am I clear here? This is first table. Now coming to one tail table. One tail table gives you probability for the area between z line to the nearest infinity. If your z is positive, so it will fall like here. The table gives you probability for this area. If z is negative, then the table gives probability for this area. Next, there is something called as two-tail table also, sir, which I did not discuss in the last class. But the two-tail table, if you see, what will happen is that will give you the sum of the area between z2 plus infinity and minus z2 minus infinity. A combined area you will get when if you see a two-tailed table, z2 plus infinity minus z2 minus infinity. E area ka sum total you will get. That is called as two-tailed table. That is not very popular, sir, so I did not discuss. But as such, you can understand. One tail is giving E triangle ka probability. Two-tail means if both the triangles ka combined probability it will give. That's not very difficult to understand as such. Next. The last table is standard normal cumulative distribution table. This table gives you probability for the area between z line to minus infinity. Wherever your z is there, from there to minus infinity. So this is one part of our basics. Next part of the basics is natural log. Natural log is normal logarithm only with a base of e value. Normally, if ln see normal logarithm we write as log log. If you don't write anything, it means that there is a base of 10. But natural logarithm, it is normal logarithm only with a base of e, and this is denoted like ln. We don't write log of 1.1255, we'll write ln. ln itself means that log with a base of e value. Now how to find out this? If you want exactly this value ka ln, that you will not get in the tables. Tables will talk about ln values only for 2 digits after decimal. So you will have either this and this. So you want some number in between these two, then you got to do interpolation. That means for this much change here, if this much change in the value has happened, so for 0.01 further change, how much will it happen? Like that you have to work out. Or you can employ the shortcut. What is shortcut? Take e value, square root it 12 times, minus 1 is equal to m plus. And whatever value for which you want to work out ln, take that number. Again repeat all the steps. Whatever answer comes, that answer divide with MRC. That means step number 1 though you have to divide. Then automatically you will get this answer. Without the help of calculator, you will be in a position to work out natural log. So up to here we have covered, guys. Okay, now coming to official Black-Scholes model. Black-Scholes model for stock options. Stock option ka meaning is a normal option only. Underlying asset is share. If underlying asset is not share, underlying asset is some index or something, then how to do we will see later on. So first basic we will develop for share options. Now value of call option is equal to, tell me what is the formula for minimum value of call option? Spot price minus present value of strike price. A spot price you will multiply with one probability which we call it as ND1, and this you multiply with another probability called as ND2. That's all. This much only is Black-Scholes model. Now value of put option. What is minimum value of put option formula? PV of strike price minus spot price. This one you will multiply with 1 minus ND2. This one you will multiply with 1 minus ND1. ND1, ND2 are basically probabilities, guys. Okay, now that we will see how to work out that. Now, I know if formula is easy to remember, this is not looking so easy. Do not remember, not required. Remember only this. If they ask put option, you first work out call option, then substitute that call formula, call answer in put call parity equation. Automatically answer will come. 100% answer will come. In fact, the formula itself is derived like that. That's the reason I'm telling you. If you don't like this, don't remember. This one only you remember. Even if they ask put option also, you first work out call option answer, go and place it in put call parity equation. Automatically put premium will come out. The formula itself is designed that way. Anyway, now in this the notations are important, sir. For example, D1 and D2s are there. In D1 and D2 they are Z values. Normally, if you remember, while doing capital budgeting, I told you Z ki one formula is there. Desired value minus expected value divided by standard deviation. But when you come to Black-Scholes model, a formula will not work. For D1, D2, you have to code a separate formula. So, D1 is equal to ln of SP by X. What is SP? Spot price, market price of the share today. X is exercise price. A fraction you have to take a natural log plus RF plus sigma square by 2 into T divided by sigma into root T. This is the formula for D1. The formula, sir, if at all in this entire Black-Scholes model, if you have to remember something, that is this. This I told you it's minimum value of call option formula multiplied with ND1, ND1, ND2. This is easy only. D1 formula alone, if you remember, rest all will be very simple for you. Now, coming to D2. D2 is equal to D1 minus sigma into root T. That means E denominator. The D1 ka answer whatever comes, that answer minus this denominator. That will give you your D2 ka value. Okay, now here obviously SP is equal to spot price, that is evident. X is equal to strike price or exercise price. Okay, ln you understand. Next, RF is risk-free return in risk-free rate per annum only you have to rate in decimals. If you rate whole number there over some, tata, bye bye. Risk-free rate per annum you have to rate. Your call option might be having a maturity of only 3 months. So be it. You still rate per annum interest rate. Reason, outside 3 by 12 I will rate. So here interest rate 12% I will rate. Here I will rate 3 by 12. So thereby effectively 3 months rate only will come. Okay, so don't rate PIR and all, RF. Sigma is standard deviation in decimals. Whole number, wrong answer. T, maturity period in years. 3 months, 3 by 12. 6 months, 6 by 12. 2 years, 2. 5 years, 5. 1 year, 1. Like that. So convert everything into years. Sigma into root is there's nothing to explain. D1, D2 are over for. Now the D1, D2 is over for us. ND1, ND2. ND1 means this is probability of area between D12 minus infinity, and ND2 is probability of area between D22 minus infinity. Normal Z-line formula whatever we learn, that is not applicable for Black-Scholes model. That only is now replaced by D1, D2 formulas. Now that you identified Z-line, what's the purpose of Z-line next? To identify the probability only. A Z value, if you go and see in the table, you will get one probability. Our probability, sir, with that normal distribution curve, you have to adjust and see what area ka probability you want. In this entire Black-Scholes model, we want probability from D1 to minus infinity. And similarly, if it is D2, then D2 to minus infinity. From wherever you are standing till minus infinity, that is what we want. Then PV of strike price. Sir, why is this required? Because that is part of the formula, no sir. Strike price of present value we want is equal to, take the strike price divided by e power RT. Don't use 1 plus PIR. In Black-Scholes model, only continuous compounding or continuous discounting, as you want, is used. So 1 plus PIR, so don't divide it. E power RT only got to use. R obviously is risk-free rate. T is time in years, that I need not tell you. Next. If dividend is expected during maturity period, when dividend is there, what will happen? Spot price place you have to take adjusted spot price or revised spot price, correct now? So use RSP in place of SP. Now RSP is equal to whatever spot price is there, that minus present value of dividend. A present value calculation also you have to do using e power RT only. No 1 plus PAR business, entire Black-Scholes model. That's all, sir. Over Black-Scholes model for you. Now, if at all dividend is there, then SP place you have to use RSP. Now, RSP where you have to use is come to the above formula. Here, spot price place it will be revised spot price. Not only that, even D1 calculation, sir, here SP place you have to use RSP. Now, when you are looking at any question of Black-Scholes model, your steps or your thought process should run like this. First thing you have to check is if dividend is there. Then you have to compute RSP. That is your first step always. Why that is our first step is, normally, sir, our first step should be D1, D2. Okay, without D1, you will not be able to work out ND1, ND2. Without ND1, ND2, main formula you cannot substitute. Obviously, D1, D2 will be your first step. But in D1 calculation, SP is there. But if dividend is there, I cannot use SP. I have to use RSP. So your first step is go check, is dividend there in the question. Dividend there, okay. Dividend not there, then RSP, SP both are same. Then there is no issue only. Okay, compute RSP. Step number 2, compute D1 and D2. Step 3, you determine the probabilities now. ND1 and ND2. PV of strike price. Finally, value of option. This much only, sir. Now, what is difficult in Black-Scholes model is where students find difficulties. First of all, the formula looks very ugly. That's one reason. I'm telling you, no, sir, this is not looking good for you. Ignore this one. Focus only on this one. This is normal minimum value of call option formula, nothing else. Multiplied with the two probabilities, ND1 and ND2. And regarding probabilities also, which area you want probability, that is clear only. What I want is from wherever I stand to minus infinity. So what I want is clear. But the D1, D2, where to stand, a number, a formula alone, you have to remember this one. You will get used to it. There is nothing great. One or two sums you do, automatically will stay with you. In duty key, another formula is that D2, where instead of plus, you have to put minus. Same formula actually. With minus it is D2, with plus it is D1. Okay. So, but after simplifying it further, it boils down to this. This is easy, no? We'll continue with that. Chalo sir, hit the questions. Please take up question number 22, please. We have been given the following information about XYZ companies, shares and call options. Now, current share price is given 165. So, this is your spot price. Excise price is strike price. Risk-free rate, that's not rupees, just 6%. Option expiry maturity period, 2 years. Volatility standard deviation is given 15%. Calculate the value of option. Which option, by the way? Call option. Okay, fine. Chalo sir, question number 22. So my thought process will be step number 1. Is dividend there? Dividend is not there. So no dividend is expected. Since no dividend is expected, RSP and SP both are same. Step number 2. You have to work out D1 and D2. So D1 formula, ln of SP by X. See and tell me what is SP 165. X is 150. SP by X plus RF. How much is RF? 6%, 0.06 plus sigma square 0.15 whole square divided by 2 into time maturity period, that is also 2 divided by sigma 0.15 into root 2. So your job is work out that ln. Keep the shortcut in front of you, work out how much you did. 1.5 1.1 1.1, or you can see in the final table also. Meanwhile, somebody process this part and tell me. First do this, divide by this, plus this into this. Fast, 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 fast. You tell something. 0. Okay, denominator. 2 1. Exactly. Okay, one more ones. ln 1.1 you get me. If you want, you can work out on calcium or go to the last page, sir. In that ln table is there. 1.1 directly only you will get. Last page means last page. There. 0.01. This one. Okay. One is also there. Huh? Okay. You identified, huh? No. Okay. Tell me. D1. 1.12. adjust D1 to 2 decimals always, because our table you won't get beyond 2 decimals. So that is about D1. Now coming to D2. D2 is D1, the denominator, sir, which is 0.2121. 9079. That's always D1 and D2 are ready for us. Now the D1 and D2 are over. Now we have to identify probabilities. These are Z lines, no probabilities. Step 3, computing ND1 and ND2. Now which table you have to use? See guys, in the exam question, depending on probabilities from which table they are giving, accordingly our interpretations will change. Okay, so here in this question nothing is given, so we will assume that first table is given in the exam and we are solving. So here I am writing using standard normal distribution table. Now table probability for D1 1.12 is equal to see 1.12 means 1.1 is here, this is 1.12, 0.3686. Okay, so this is mean. Your Z is positive, sir. Your Z is positive. Your table probability is from mean to Z line, because you are seeing first table. A table probability is 0.3686. What I want is from this entire area I want. So you have to add 0.5 for that. So this is my desired area. So ND1 is equal to 0.5 plus 0.3686, which is equal to 0.8686. So in this, the trick is you knowing that from here to here, the entire total probability of left tail will be 0.50 with that. Similarly, table probability for D2 0.91 is equal to, for 0.91, this one no, 0.3186. See, your D2 is also a positive number only. Even if I draw a graph also, that also will look in the same fashion. Okay, so here also adjustment will be same. So ND2 will be equal to 0.5 plus 0.3186, that's 0.8186. Well, ND1 and ND2 are also done for us. Step 4, PV of strike price. PV of strike price is equal to, strike price is 150 divided by e power 0.06, 0.06 into how many years? 2 years. So 150 divided by e power 0.12, 150 divided by 1.1275. I power 0.12, you know, you can work out, or you can see in the table also. To the best of memory, that is correct only. Anyway, just for checking, I will check also, but as such it should be right. X e power x 1.1275. Okay, tell me the answer now. 133.130. Okay, very well. Step 5, which is value of the option. In the given, see, whether it is call option or put option also is irrelevant for you up to step number 4. Whether it is call or put, all the ingredients, all the steps will be same. If it is call option, one formula, put option, another formula. That's all. Step number 5, you can see which option are you talking. Value of call option is equal to SP into ND1 minus PV of strike price into ND2. 165 into 0.8686. 133.04 into 0.8186. How much? 31.41. Okay, this is your value of call option. Now, using the same data, we can also work out the value of put option also. Okay, so the put option formula you apply, which is V put is equal to PV of strike price into 1 minus ND2 minus spot price into 1 minus ND1. PV of X, we already worked out 133.04 into 1 minus 0.8186 minus 165 into 1 minus 0.8686. Two point 457. Or alternatively, what you can do is value of put call parity. Put call parity formula is what? Minimum value first rate, PV of strike price minus spot price. To that, just go and add value of call option. So in this example, PV of strike is 133.04, spot is 165, call value is 34.41. 100% you will get, you have to get. A formula itself is derived using this put call parity. So that's the reason dot to dot will match, of 100% will match. So in case you do not like the put option formula, it's okay, no issues. So this is without dividend, plain sum, call put both are over. Okay, now with the dividend one sum we will do. What's the current question number? Okay. Please come to 24, sir. A share is trading at rupees 100, spot price given. Dividend of rupees 3 each is expected at the end of 3 months, 6 months, 9 months, 12 months from now. Okay. Previous some dividend is not there. Now suddenly there are 4 dividends. The risk-free rate of interest is 12% and stock price has a volatility of 25%. What is the value of call option with a strike price of 100 and a maturity of 12 months? Now, literally similar to previous sum, only exception is dividend. So all you have to do is one step extra. What is that? RSP calculation. But if you have to calculate RSP, first you have to work out present value of dividends. How many dividends are there? 4 dividends are there. All the dividends discounted to today first. Because this is not normal discounting. Now you have to apply continuous compounding and do use that e power. So 4 dividends are there. All 4 dividends you have to bring it back. Normally cash flow divided by 1 plus PAR, here e power RT. So 3 by 12, 6 by 12, 9 by 12, 12 by 12. Like that if you work out, you are getting here 11.14. This is PV of dividend. This if you remove from spot price, you will get RSP. From hereafter, you will be using only RSP in place of SP. So even in this formula, even formula also, even in the final answer also. SP place you will be using RSP. That's the only difference. There is nothing great, nothing extra and all. Very, very normal. Okay, now this you can handle it on your own. Just discounting is the extra step. I'll go to next concept. Look at this. Now, Black-Scholes for option valuation, where underlying asset is share, only this much, sir. Either with dividend, without dividend. In this, there is no twist possible. It is maximum, whatever you are seeing. But now, next we have to learn in the order index option. If you have to learn index option, you must also know what index is and how index is computed. Roughly, at least we should have an idea. Now, guys, for example, take the Indian scenario only. We have two major stock exchanges. One is Bombay Stock Exchange, one is National Stock Exchange. In each of the stock exchanges, sir, thousands of company ka shares are listed. Thousands, around 3,000, 5,000. These regular companies are listed. Now, 3,000, 5,000 companies may be there, but 3,000, 5,000 businesses are not there. No? That means in that multiple companies will be doing more or less the same business or related business. Okay. So what they have done is from each business sector, each business segment, they have selected one or two companies and they created a group of 30 companies. These 30 companies are best performing company in each of their respective industry. In terms of their P ratio, in terms of their profits, in terms of their sales growth, in terms of their link with the current economic situation, everything they will consider, and the index picks up or the stock exchange picks up 30 companies which is covering all the sectors. That means, for example, in automobile, Bajaj is picked up, Bajaj Automobile. Like, car service, Maruti is also part of it. Next, when it comes to bank, SBI is part of it, ICICI is part of it, then Asian Paints is part of it. Coming to software companies, Infosys, TCS are forming part of it. HDFC is part of it. Like that, they pick up 30 companies. These 30 companies, they gave one group name. That group name is called as Sensex, which actually means sensitive index. Okay, similarly, National Stock Exchange also, they framed a group of 50 companies. And this group name is called as a Nifty. This is supposed to indicate national index for 50 stocks. So Sensex and Nifty, they are not share ka value and all. Adi a group ka name. A group ka performance is captured into one index. A index number is called as Sensex or Nifty. Now, sir, if Sensex has to increase, what should happen? The 30 company ka share price should go up. Similarly, Nifty also. So, imagine, sir, if 30 companies are not belonging to the same business, no, they're representing all the businesses. If these 30 company shares are going up, it more or less indicates that all the companies in that respective industries are also going up. So that's why when Sensex points increase or Nifty points increase, we say that market is going up, market is going down, because we are not tracking all 1,000 companies in the market into the Sensex or Nifty. We are capturing the best performing companies, and we believe that rest of them are also ideally supposed to move like that. Okay, so that is how we compute this. And next, there is a term called as market capitalization. Market capitalization means total number of shares in the company into market price of the share. Then there is another concept called as free float market capitalization. Free float market capitalization meaning is, instead of taking total number of shares, we take only free float number of shares. Now, what are free float number of shares is, for example, in a company 10 lakh shares are there. At 10 lakh shares, major shares will be there with the promoter, his family, relatives and all. Those shares will not come to the market for trading purposes, correct? They own that share so that they can control the business. Our remaining 20-25% shares, whatever are there, that are held by general public. These people keep on buying, selling shares. Some people will hold it long term and all. So even though a company 10 lakh shares are there, in the market only 2 lakh shares are trading. The remaining 8 lakh shares are there with the promoter group. Unless they decide to sell or offer for sale and all, our shares will never come into the market for trading. So whatever share price you are seeing today in the market, that is a share price considering the availability of only 2 lakh shares. If all 10 lakh shares are there in the market, again demand supply positions will change. Our price might not be holding good also. So what this stock exchange feels is, total 10 lakh shares are there in a company, but 8 lakh shares will never come into the market for buying and selling, which means whatever share price we are seeing in the market, that is for the remaining 2 lakh shares. If these 8 lakh shares also will join, will the price change? Means price might change, because if another 8 lakh shares supply is there in the market, maybe demand is also there, then the price might rise also, price might fall also, or if they both are matching, price may not change also. But presently whatever share price is there, that's not for entire 10 lakh shares, that's only for 2 lakh shares. So this is the total shares minus, you have to remove promoters holding. Any other strategic holdings also you have to remove, which will not enter into the market. So if you remove them, our remaining shares are called as free float shares. Our free float shares ka market value is only called as free float market cap. Now why are we learning about free float market cap is, index whatever Sensex and Nifty is there, in Nifty points, Sensex points are computed using free float market cap of 30 companies, free float market cap of 50 companies. Now company 1, company 2, company 3, like that, company 50 companies. For each company, free float number of shares, market price of share, this into this, you will get market cap. Of course, free float market cap. I'm randomly reading some numbers, sir. You do the product and tell me, okay? 100 lakh shares are there, which are all not total shares, free float shares. Into market price of the share is 20. So market cap is how much? 2000 lakhs. Now here, let's take 50 lakh shares. This you take 100. So 5000 lakhs free float market capitalization. So here it is, let's say 200 lakh shares, 15 rupees, 3000 lakh shares. Let's say here 600 lakh, market price is 90. 54,000 now. Too much, no? Okay, it's okay. 54,000 lakh. Now, like that, I have taken randomly few companies. If I take all the 50 companies, then I'll get some total. Imagine the total is 8,50,000 lakhs. If 4 companies ka total don't do, because in between you do not know, no? Okay, so this is free float market cap of one particular day. Now, next day, market price. Next day market price will be same or will it change? Will definitely change. Let's say E20 became 25. E20 place now it is 25. E100 place lesser, now it is 105. E15 place lesser, now it is 11. In 90 place lesser, it is, let's say, 92. Now again I can calculate market cap next day. If I calculate, don't simplify that, leave it. Suppose a total number from 8,50,000, suppose it has gone up to 8,53,000 lakhs. What does it indicate, sir? Compared to yesterday, today market capitalization has increased. Does it necessarily mean that all the 50 company shares are increasing? No, because if you observe, this share price has gone up, this share price has gone up, but this one has gone down, this one again has gone up. In that 50 company shares, some shares will perform better, some shares will not perform better, but overall what is happening is, on a marginal level, Nifty might slightly increase or slightly decrease, A percentage points in the market cap you have to calculate. Tell me the percentage calculation. 0 point? Only that much. 3,000 by 8,50,000. 352? Okay, 353. 0.353 percentage. There is a increase in the market compared to yesterday. Now, if yesterday Nifty is equal to 24,000 points, then today Nifty is equal to 24,000 points plus 0.353 percentage. 0. This is how Nifty points are calculated, sir. They don't calculate the end of the day and all. Spot. As the share price dances, market capitalization changes, total will change compared to yesterday. Percentage calculation, automatically Nifty gets updated. They will all happening on a dynamic mode. Sir, how did you get yesterday's points? Based on the previous day. Like that, if you roll back. First day, how did you get? First day base point was 1000. First day, they took base point as 1000. That 1000 has grown to 25,000 level as on today. First day, whatever market cap is there, a market cap, they have given an index point of 1000. So 1000 became 1010. 1010 became 1025. Like that, over a period, it became today around 25,000. The Nifty level. Like that, Sensex also. Till here, clarity is there. Now, for example, today, Infosys share is trading at 1600. This fellow is there. He is thinking that Infosys share ka price will go up. So he is having a bullish view. So when he knows the share price is going to go up, what should he do? He should go and buy Infosys share in cash market. Fantastic. He bought. Next. Today, Nifty points is 24,000. This fellow feels that Nifty will go up. Ideally, he has to go and buy Nifty and sell Nifty later on. But this is not possible. You buying Nifty is not possible. Why Nifty buying is not possible is, imagine sir, Infosys is one company. A company has some assets, liabilities are there. Equity share of that company is an asset for you. That asset you can buy, you can sell. But Nifty is not a company. Nifty is not a share of any company. That is an indicator whose number changes. That's okay. You feel that Nifty might grow, all that, that's fine. But still you cannot buy Nifty. Why? That is not share of any company. Representing Nifty, there are no assets and all. Even if you buy Nifty also, you don't become owner anywhere. So who will buy this? So Nifty buying is not possible. Sir, but I for sure know that Nifty will rise. So I want to do trading in Nifty. That's a different thing altogether. So buying Nifty is not possible, sir. That's 100% not possible. Now, if you want to trade in Nifty, there are two ways. To trade in Nifty, there are two options. Option number one, create a portfolio of all 50 company shares in same ratio as they are included in, or which ratio? Come here. 8,50,000 calculation, what is the ratio? 2,000 is to 5,000 is to 3,000. A ratio is there, no? A ratio, you also create some money. Suppose you are having some 10 lakh rupees. In 10 lakh rupees, to buy all 50 company ka share. In each company, how much you should invest is, a ratio you go on investing. If you invest like that, your portfolio of 10 lakh rupees got spread across 50 companies in the same manner like how it is included in the Nifty. So if Nifty goes up by 1%, your portfolio value also will go up by 1%. Nifty falls by 5%, your portfolio value will fall by 5%. Like that, a synthetic Nifty you yourself create, but direct buying Nifty impossible. This is one option, sir. Then there is another choice which you can do. Invest in mutual fund operating a index fund. If you cannot create, suppose you said, sir, my capital is only 5,000 rupees, but I want to invest in Nifty. Sir, even if I really allow you to buy Nifty also, you can't buy, no, because Nifty ka point is how much? 24,000. All you have is 5,000. Nifty anyway you cannot buy. Sir, then, but I want to buy Nifty. Then what you can do is, you can go and invest money in a mutual fund who is operating an index fund. Like how you create a synthetic Nifty, like that mutual funds already are doing it. So go and buy units of that fund. If Nifty goes up by 10%, your unit value also will go up by 10%. You will have a feeling of buying, selling Nifties. So that is another route. So buying Nifty, selling Nifty directly not possible, indirectly possible when you yourself create a Nifty or you invest in an index fund. Okay, next. So this is one point. Then there is another point. However, Nifty and Sensex are used as underlying assets in options and, for example, you tell me what is the meaning of this? Call option, underlying asset is Nifty, strike price is 25,000, maturity period is 3 months hence. Interpret this. What is the meaning of this? Call option will give you right to buy. Who is right to buy underlying asset? Nifty. So I have a right to buy Nifty when? After 3 months. At what rate? At 25,000. Suppose at 3 months time, Nifty goes up to 27,000. But I have a right to buy only at 25,000. So I'll exercise a lapse. I will exercise. Therefore, call option is exercised. Now that call option is exercised, you will get some payoff. Payoff formula is what? Spot price minus strike price, which is equal to 27,000 minus 25,000. So you are winning the bet by how much? 2,000 rupees. 2,000 rupees you will collect in cash. You cannot say want physical delivery of Nifty. Possible a physical delivery of Nifty? Physical delivery of Nifty is not possible. So you simply have to do a net cash settlement. What is net cash settlement? Payoff the other party will give you in cash. Since net cash settlement is also permitted in the stock exchange, Nifty and Sensex, though you cannot take deliveries, they can be used as underlying asset only because the net cash settlement is done. So real buying, selling of Nifty is not possible. However, Nifty and Sensex are used as underlying asset in option contracts and future contracts. Suppose, sir, tell me, who will buy a call option? Somebody who believes that price will rise. Bullish view only, that fellow only will go and buy a call option. Earlier, why did you want to buy a Nifty? Because you believed that Nifty is going to rise, correct? So when Nifty is going to rise, you wanted to buy Nifty, but buying Nifty is not possible. Then I told you two routes. You did not like it. Then come buy a call option on Nifty. If you buy a call option Nifty, what will happen? If Nifty rises, option gets exercised, you will get your money. Are you understanding, sir? See, you want to gain, no, sir. Nobody wants to hold Nifty. Nifty is not your girlfriend, no. So you just want to get a gain. You are going there for a gain or loss. So for that gain you are going, you don't mind suffering loss. Instead of buying Nifty, directly not possible. Indirectly also, why to do directly enter into call option on Nifty? Sir, but call option premium is there. I don't like to pay premium. Okay, then enter into futures contract on Nifty. That is also possible. Of course, what is futures we will officially discuss in a while, but as such, you can enter into a futures contract on Nifty. Am I clear till here, sir? So, in Nifty, Sensex, direct buying, direct selling not possible, but they are used as underlying assets in options and futures contracts. Now, coming to Black-Scholes model on index options. Sir, all formulas same, sir. Only thing is use RSP in place of SP. That's the only thing you have to do if it is a index option. So, sir, but index, will it pay dividend? Index, will it pay dividend? Index is company. You have to pay dividend. You are all shareholders, sir. No. So dividend adjustment is required or not required? Not required. Ideally, it should not be done. But observe these points. Is this Nifty point, whatever you are seeing here, in Nifty points are based on this market cap? Correct. If share ka value changes, market cap also changes. If market cap changes, Nifty points also will fluctuate. Till the clarity is there. Now, Nifty won't pay dividend, but the companies in Nifty will pay dividend. If they pay dividend, the price will change or not? Price will change. When that price changes, market cap also changes. Market cap changes, Nifty also changes. Now tell me, sir, dividend is having an impact on Nifty points or not? Yes, Nifty won't pay dividend, but the 50 companies in the Nifty will pay dividend. Because of that, Nifty points will change. So dividend adjustment has to be done. But it is not like how we do for normal share, because normal share cases are how much dividend the share is expected to pay, you can guess, you can estimate, adjustment you will do. But now you are not talking about a single share, you are talking about a group of 50 companies. And moreover, spot price directly removing and all is not possible, because your spot price first of all is not price. The namesake is spot price we are calling, but actually the points, so index points. How can you remove dividend amount from that? That is not right. So what adjustment we do is very smartly. RSP is equal to, we'll take spot price divided by e power dy into t. What is dy is? Dy is equal to dividend yield percentage, dividend yield per annum. Now, dividend yield you need not calculate, sir. The 100% question they will give you, but just like that, I'm telling you how that is computed. This is total dividend on all shares divided by total market capitalization of all the shares. All means 50 companies. All means again not every 1000 companies, not like that. 50 companies ka market capitalization, the denominator, numerator la 50 companies ka expected dividend into 100. If you remember, share valuation chapter, bond valuation chapter, current yield formula is there. Interest divided by market price of the bond, the current yield. When you went to share valuation, expected dividend divided by market price, the dividend yield. That only, this is only thing is not one share, but for the entire shares. The dividend yield. E percentage 100% question they'll give you, sir. A percentage, so you discount spot price. If you discount, what will happen is, you are not bringing to present value and all. You are eliminating something which is already there in the spot price. Sir, how is discounting eliminating? Look at this. Let's say you are having 100 rupees, sir. You invested this 100 rupees at the rate of 10%. So it became 110. So 110 interest is there or not there? So now what I am asking you to do is take 110 and discount it with 10%. If you discount it with 10%, what will happen? 100 will come. But fine, that came to present value and all, agreed. But apart from present value, observe, this is including interest. This one is the interest rate. When any cash flow includes interest and you go and discount that cash flow with the interest rate itself, the final answer excludes interest. Correct? Like that only. Is spot price dividend is included in the next 1 year, dividend will be included in that. That I discount it. Sir, where is 1 plus PAR? I will not do 1 plus PAR because this is Black-Scholes model. You have to do only E power RT. So here R is nothing but dividend yield for us. Not take risk-free rate and all. No, so dividend rate you have to take. The dividend yield you have to do. That's all. Rest all same to same, sir. Same as stock options. So when it is index, instead of minusing PV of dividend directly, you discount it. That too not plus 1 plus uh, interest rate, you have to discount it to the e power dy into t. By discounting, you are eliminating the dividend impact basically. Well, sir, only that much. Come to this question. Nifty is currently at 4,500, spot price given. If the risk-free rate of interest is 8% and continuous dividend yield on Nifty is 3% dy given to you, what would be the value of a 3-month call option with an exercise price of 4,600? The volatility of Nifty is placed at 25% per annum. Standard deviation is also given to you. So, question number 25. So, first and foremost, RSP you have to calculate. RSP is equal to SP divided by e power dy into t. What is the spot price in this sum? 4,500 e power. Dividend yield 0.03. How many months maturity? 3 by 12. 4,500 divided by, process this month. Okay, sorry. E power 0.0075. You can process this, see the table you won't get 0 e power 0.0075, table you will not get. You have to calculate, sir. 2.71828 whole power 0.0075. If you process this, since the numerator is since the power is very small, an approximate 1 plus 1.005, maybe one more digit will come. Answer. Four thousand 443. This is your RSP, sir. This is your first calculation. Second calculation, D1 and D2s. D1 ln of RSP. RSP is 4466.37 divided by, what is the strike price given in the question? 4,600 plus RF. What is the risk-free rate given, sir? Risk-free rate is, where is this? Here, 8%, 0.08 plus sigma 0.25 whole square divided by 2 into t, 3 by 12 divided by sigma into root t. Okay, so this is ln of 0.97095. This entire point 0.02. Okay, denominator please. Correct. 0.125. Solve the ln. 0.02. Sort out this. Final answer. Huh? Two decimal you adjust it. So guys, this is your D1 number. Now the D1 you have, D2 is easy only. D2 is equal to 0.4577 minus 0.125. 0.3327 or simply 0.33. Now the D1, D2s you have. Next you have to work out ND1 and ND2. Earlier we used first table, now we'll use last table, sorry, one tail table. Table probability for D1 0.46 is equal to one tail table is this one, sir. 0.46 is 0. Is which table? 0.4 0.3228. Now you tell me, sir, what adjustment we have to do. Sir, your Z is positive, that is, this is your D1. Nearest infinity is plus infinity, this is minus infinity, this is mean. Your table probability is this one. This you know, which is 0.3228. What we want is this entire area, sir. How to get your desired area? 1 minus. So ND1 is equal to 1 minus 0.3228. How much? 0.67? That is that. Similarly, table probability for D2 is 0.33 is equal to 0.33, this one, 0.3707. So ND2 is equal to same adjustment, 1 minus 0.3707, 6293, like that. Sir, if you by chance, now that you are anywhere there in the same table, go to last table once. Last table, please. 0.46. 0. Plus 0.46. Last table is the only table where plus or minus are separately given, sir. 0.46. You will directly get, because our last table directly gives you value from Z to minus infinity without any adjustment. Final, whatever ND1 you want, that only you will find here. Similarly, for 0.33, 0.629, directly you will get. E table, if they give, there is no adjustment, direct answer. That's the reason usually they don't give. But if I am setting the paper, I'll give. At least in MCQ, I'll give that and ask Black-Scholes model. The rest of it is not difficult. No? So, next. PV of strike price. Strike price in this sum is 4,500. 600. E power R is 0.08 into 3 by 12. 4,600. That is E power 0.02. E power 0.02 is 1.0202. 4508.92. That's all, sir. Final answer. Value of call option. Now, instead of SP, you have to use RSP. RSP into ND1 minus PV of strike price into ND2. RSP we computed already somewhere. 4466. 4466.37 into ND1 0.6772 minus 4508.92 into 6293. Process is fast. 187. There you go. So if they ask you for put option, you just change the formula or apply put call parity equation, get it somehow. Why is answer not matching? Got 2 1 2. That much gap should not come now. ND1 ND2 are negative. You got D1 negative, sir. Don't tell me. One second. Because if your D1 is wrong, everything will get messed up. Check out once. Here, ln value is negative 0.0294. Is it negative? You do not tell me that. See, because of that entire thing, you have to rework. Solve again, all of you. Check this once. Negative only. How much are you having? Minus 0. Okay. Only the sign is wrong. That's enough. 0.0294 is 0.027825 divided by 0.125. 0 minus 0.0127. So your D1 is equal to minus 0.01. Okay. Now that your D1 is gone, D2 is also gone automatically. So this entire thing you have to scrap and work out. D2 is equal to minus 0.01. How can you be so stupid here? Can't you see? Already you are not working. Already calculator also, if you don't know how to use, so many people are there. Why are you even there then? Fine. Your D1, D2 is this. Now this ND1, ND2, you have to rework now. See, your ND1 is minus 0.01. One tail table only you use. Zero point 0.4960. See, you will not find minus 0.01. Observe here the modulus. Whether it is plus or minus, you will have the same number. So 0.4960. But you should know that your Z, that is your D1, is negative. So your line will fall there. So this is already giving you probability from here to nearest infinity, which is coincidentally also the probability what you want. So this is the table probability also. This is your ND1 also. So no adjustment is required. So the final answer is that only 4960. Similarly, for D2, which is 0.14, 0.14, 0.4443. Here also no adjustments, sir. D2 is also negative only. So same adjustment will be there for you. So which will be 0.4443. So this is your final answers. 0.4960, 0.4443. Yeah, work out this. 0. That's okay. Chalo. This is how you gone to. See, in this case, your D1, D2 both are negative. So you got one tail table, and one tail table will give you from Z line to nearest infinity. Coincidentally, you also want the same thing without adjustment. You passed off. Last table, if you see, same answers will be there. But first table, if you see, you will get probability for this area. Whereas you will be wanting this area. So what will you do? The entire thing is 0.5, a 0.5 minus you have to handle there. Suppose your Z is positive, then the table will be giving this one. What you want here? 0.5 plus. That much basic if you are able to do, that's all. Well, sir, with this, broadly our discussion on valuation of options is over, because Black-Scholes model is the last model. Okay, now little bit of points are there. Listen carefully. Sir, there is an option. The option ka strike price is 300. Maturity is 3 months later. The option today you cannot exercise. You can exercise only after 3 months. Strike price is 300. Okay, now I am telling you data. This is call option. And today spot price is 330. The one case. Today's spot price is 260 and it is 300. Now tell me, sir, compare this strike price with today's spot price and tell me whether the option is likely to be exercised or likely to be lapsed. Okay, tell me, sir. Call option will be give you what? Right to buy. Right to buy at what rate? 300. Today market price is 330. You cannot exercise lapse today. You cannot. That's what. Don't fall into the trap. You cannot exercise or lapse today. Maturity period is when? After 3 months. These after 3 months. Today. Maturity date is not today. Maturity date is after 3 months. This is not after 3 months and all. It is as on today. Maturity is after 3 months. Okay. Now compare this versus this. Don't tell me lapse exercise. Likely to be lapsed, likely to be exercised. Tell me. I have a right to buy at 300. Today only share price is 330 in the market. So after 3 months, what will happen? I do not know. But at this price, is it looking likely to be exercised or not? Yes. So this one is likely to be exercised. Come to second one. This is likely to be lapsed. Now, sir, if first scenario where the option was likely to be exercised, this is referred as in the money option. The option is called as in the, see, market today 3 spot prices will not be there. Only 1 spot price will be there. But a spot price when you compare, either you will be likely to exercise or likely to lapse. The second scenario, likely to be lapsed. This is called as out of the money option. The last one where both are same, this is called as at the money option. So ITM, OTM and ATM. The ITM, OTM, ATM are status of the options, whether option is likely to be exercised, likely to be lapsed, or exercise price and market price both are same, so we can't say anything. So this is called as status of the option. Okay, now similarly, if I tell you that this time it is put option, spot price is same, spot prices I'm keeping. Tell me, sir, what is the first scenario? Put option means we have a right to sell at 300, but today market price is 330. Tell me, sir. This is likely to be lapsed. Since this is likely to be lapsed, this is out of the money option. Next, I have a right to sell share at 300, market price is 260 today. So this is likely to be exercised. Since this is likely to be exercised, this is in the money option. When they both are same, anyway that is at the money option. There is nothing to remember. This is higher, lower. Don't remember anything. Just compare the strike price with the prevailing spot price. You feel to exercise, call it as ITM in the money. Likely to be lapsed, call it as OTM. Both are same, call it as ATM. That's all. This is called as status of option. Status of option. Now, why the status of option we learn is so that the option value, which is nothing but your call premium, put premium, is further broken down into two parts. It's broken down into intrinsic value and time value. One is called as intrinsic value of option, the time value of option. Now, how much is intrinsic value? How much is time value? Intrinsic value is to the extent the option is in the money. If it is OTM or ATM, then this intrinsic value, whatever is there, that will be 0. So, the option ka premium can be broken down into two parts, intrinsic value and time value. But intrinsic value will be there only if option is in the money. If option is out of the money, then intrinsic value will be 0. At the money also intrinsic value will be 0. Then entire amount, whatever you pay, that will be towards time value of option. Time value of option is not time value of money and all. The balancing figure, something which has to be recovered over a period of time. In the example, if I put it, it will be more easy to understand. So take this scenario. Take a call option. Strike price is 100. Today, spot price is 120. Call premium is 35 rupees. First observe, is option in the money, at the money, out of the money? You cannot exercise now. Don't even have any doubts. Exercise will happen future. This is today's spot price. Maturity is 3 months later, not now. Today's spot price. Likely to be exercised or likely to be lapsed? Likely to be exercised. This is called as what? In the money option. If you have to buy this option today, you have to spend how much? 35 rupees. If 35 rupees when you are spending, think from an investor angle, I am spending 35. I have a right to buy now share. At what rate? 100. But today market share price is how much? 120. Outrightly how much benefit is visible to you? 20. But you are paying how much? 35. You are paying 35 when benefit visible to you is only 20. For a extra 15 rupees, how will you recover? And if you ask that fellow will say, this another 15 rupees, whatever extra I am paying, I believe I will recover in future. Why in future? Because another 3 months time is there. Next 3 months, this fellow believes that his share price will even increase beyond 15 rupees also. And he will recover his entire premium cost. That is a feeling. Time value of option is not time value of money. What it says is, it is that price fluctuation which I expect to happen over a period of time. That is called as time value of option. Suppose, if I tell you, this is when if spot price is 120. Okay, now in this case it is very clearly in the money. Suppose I tell you if spot price is 100, this is at the money option, and for at the money option intrinsic value will be 0. If I ask how much benefit is visible, no benefit today. So whatever you are paying, that is totally towards time value of option. Similarly, if spot price is 80 rupees, it is out of the money. Now also intrinsic value is 0. Whatever you are paying is towards time value of option. So how to split intrinsic value and time value is, if we exercise now, how much benefit is visible, that is called as intrinsic value. If you can't exercise, then it is 0. Simple. Time value of option is always the balancing figure. This is one split, sir. On this also questions are there. Cheap question only, but still it is there. No, that is there. Once I have to solve, no, otherwise you will not. Come here, third question, fill in the blanks. You can answer. Consider the following data relating to stock contained in the following table. Determine both the intrinsic value and time value in each of the cases. See each row and try to answer. First one, sir. You should know how to read this. Call option means what? Right to buy. Right to buy at what rate? 90. I have a right to buy at 90, but market price is 100. Tell me, sir, is the option looking attractive or not? Yes, this is called as in the money option. Now that it is looking attractive, definitely some benefit will be visible to you. How much benefit is visible? 10 rupees. But what is the option premium? 15. I extra 5 whatever is there that you are paying towards time value of option. Are you clear? Right, next one, try again. Again call option. But this time we have a right to buy at 110, but market price is only 100. Looking attractive? No, not at all. OTM. This is 0. Entire amount will be towards time value. Next one. Put. Put means we have a right to sell. We have a right to sell at 200. Market price is only 100. Very attractive. How much benefit is visible to you? 100. What is the put premium? 135. So 35 extra we are paying, that is towards time value of option. Next. Again put. I have a right to sell at 90. Market price is 100. So not attractive. This is out of the money. Now that it is not attractive, automatically intrinsic value will be 0. Time value will be a remaining amount, which is 4 rupees. Next one, sir. Put option. I have a right to sell at 150. Market price is how much, sir? 125. Clearly looking attractive. So that is ITM. How much benefit is visible to you? 25 benefit is visible. Extra I am paying 5. That is time value of option. Next one. Call option. I have a right to buy at 150. Market price is 125. Not looking attractive. OTM. 0. Whatever I am paying is towards time value of option. This is the split of intrinsic value and time value. For this, what formula will you remember, sir? If you want, I can give you formulas there also. That's waste. A formula, memory waste. Very simple. If benefit is there, intrinsic value will be there. And if benefit is there, I will call it as ITM. Well, next. Now, last point, sir. With this, our option discussion we can close. Sir, if this fellow is the holder of call option, then opposite he will have another party who is the writer of call option. Do you agree if I tell you that in this entire options, if he is making a gain of 30, then he is making a loss of 30. Do you agree with that? Because whatever is inflow to holder, that is outflow to writer. Whatever is outflow to holder, that is inflow to writer. Do you agree with that? Any doubts? Slight doubt. No problem. Take this. Exercise price 100 Bitcoin, sir. Some premium 10 rupees. Let's say at maturity, spot price is 140. Tell me, sir, you are holder. If you are holder, you will exercise the lapse sum. You will exercise call option, right to buy at 100, market price is 140. Definitely you will exercise. So how much payoff will you get? 40, no sir. 40 minus premium paid 10. So net your gain is 30. But if you take writer, for him premium received is a 10 minus payoff given, which is how much? 40. Net he will have a loss of 30. Always holder gain will be equal to writer's loss. Writer's gain will be equal to holder's loss. It will be matching like that. If you tell me that, sir, holder, writer both belong to the same house, then from house point of view, gain or loss is 0. Individually, whatever he gains, this fellow loses. But overall, there is no gain, no loss. From house point of view. Clear? Now, why I am telling you this is 0. Here, call option value 30 rupees. This fellow became a holder of call option. 3 months maturity. Let's say this is 31st March maturity. Holder of call option. Who will become holder of call option? That fellow who believes that share price will rise. Like he anticipated in cash market. In cash market, spot price went on increasing. So today it is 2 months. The same call option, whatever he bought, whatever he is having, our call option ka market value today is 70 rupees. But this fellow still has a maturity of another 1 month. Today, this fellow wants to exit. He says, sir, I am already happy that share price increased, my option value also increased. I want to get out. How to get out? This is exiting before the maturity date. Now, how to exit before the maturity date? Simple, guys. Whatever is your original position, just to take opposite position. What is your original position? Holder. Since originally you are a holder, if you want to exit on this date, all you have to do is just like forward contract cancellation, go and take a opposite position. So that means this fellow will now become writer of call option. If you become a writer of call option, you have to pay premium, you will receive premium. You will receive premium. So premium received. How much will you receive? Today's value is how much? 70 rupees. But once upon a time you paid 30. So what is your gain? 40. 70, 30 rupees you paid, purchased an option, held the option for 2 months. After that you squared up the option, you sold the option, you became a writer of the option. 70 rupees you received. You are out of the market now. Sir, how am I out of the market, sir? In this contract, I am a holder. In this contract, I am a writer. How am I out of the market? Because you are holder plus you are a writer. If you are holder and writer in the same option, same underlying asset, same maturity date, same strike price, your gain or loss will be 0. That's the whole point of telling you this. You becoming holder, you becoming writer, both, then what will be overall gain or loss? Your overall pay of settlements and all will be 0. But the amount what you paid premium, the amount what you received, they are not same, they are different. Our difference will be your gain or loss. Paid 30, received 70. Sir, what about payoff and all? That and all will not apply for you because you are somebody who is holder as well as a writer. Therefore, a payoff things and all will get squared up, sir. These payoffs and all will ultimately die. They will not have any impact on you because you are a holder as well as a writer. Now, instead of calling this fellow as holder, if I go and call him as buyer of call option, do you have any problem? Because holder only is buyer. You bought an option. You don't want. What will you do? Sell option. Just like how people buy shares and sell shares, like that this fellow is buying option and selling option. Buy rate is how much? 30. Sell rate is how much? 70. Automatically gap is 40. That is your gain or loss. Sir, always I will gain. Sir, if always people will gain like that, I will not be teaching here. Always gain, why will it come? Gain here came because he anticipated that share price will go up and really share price went up. That's the reason. If share price has fallen down, then the value will not be 70, it will be 7. He purchased at 30, market price is 7, he sells at 7, 23 rupees loss only will come. Are you getting, sir? Gains are not assured and all. Gain is assured. Why, what are we doing here? Okay. So this is how you do, sir. Okay. Now people trade in options by buying and selling options. Now here only one point you have to take care is, when I ask you to become writer of call option, Some writer you should not become. You are holder of call option in one share, let's say Infosys share. You should become a writer of call option only in Infosys share. The original option ka maturity date is when? 31st March. Today you are standing on 1st March. So you should enter into opposite position in a contract for the remaining maturity only. Sir, I originally entered for 3 months. Now also I'll take opposite position for 3 months. Take. What will happen? Instead of exiting, you entered into another position. You want divorce. For that, you take divorce. You should not marry somebody else. Then you are stuck with 2. So instead of getting out of the existing position, you will be taking another extra position if you don't match with the original terms. Original terms contract expire in 31st March. Opposite contract also should expire on 31st March. Original contract is on TCS. This also should be on TCS only. This you should not play on SBI share and all. Then again, same thing. And strike price also should be same. Strike price, if it is not same, then also problem will come. Then you are not exiting. It is separate position, separate position. Everything should be same. Only thing which will not be same, even if you want, is this one. That will not be same. That will change off. Market premiums fluctuate. That's all is the position. Now you answer this. I'll tell you original position. You tell me action to exit. I am a buyer of call option. What should I do? Buyer of call option means who am I? Holder of call option. I want to exit before the maturity date. What should I do? Sell the call option. You should not buy put option and all. That's wrong. Call ka opposite put, not like that. Buyer ka opposite position. Call is sir. That you cannot change. So sell the call option. Sell the call. That means I am asking indirectly to become a writer of call. Okay. What if originally only I am seller of call? My original position is writer. What is the opposite? What is opposite of writer? Reader, huh? Holder. So now, buy the call option. So or become a holder of call. The opposite position also, same underlying asset, same maturity date, same strike price. Premiums will be different. A premiums ka difference only is your gain or loss. That's all that is there in your options.